Hello everyone, welcome to this course on using financial concepts for project management. So, before we dive deep into the course, let me just give you a small heads up what this course is going to cover. Now, as we progress throughout the course, you'll come to know that how financial concepts are important for any project, irrespective of the field you're operating. You may be a marketing project, it may be an IT project, developing in apps, web application, anything, any XYZ projects in hand. You'll understand there is always a financial implication involved in the project. And as a project manager, as a project lead, it's important for you. Forget about being a project manager or project lead. Even if you're a team member, it's important for you to understand the implication of the financial concept so that what benefits can you derive from that? We're going to be discussing in a couple of minutes. Before we go ahead, let me tell you what concepts we're going to cover throughout this lecture, throughout this course. The first itself is going to be introduction to financial concepts. Now, if you are from a financial background, you can just briefly run through this whole lesson, you can say, in a way, because it just gives you a basic insight as to the various financial statement components, various use of those components, what is their purpose, and so on. But if you are from a non-financial background, I highly recommend this lecture for you because this gives you an introduction, a quick glimpse into the world of finance, you can say that way. Next, we're going to be seeing forecasting. Basically, how do you forecast? How do you present your various scenarios, what if scenarios, and derive at the financial outcomes for that? Next, we're going to be seeing budgeting and variance analysis. So once you have forecasted and decided on a particular course of action, a particular project to be pursued, and once you proceed with that, you obviously got to keep a track of what was the budgeted revenues cost you had decided for that project and what's actually happening, and the variance that has to be analyzed. Where are things moving as expected? Are they moving in a positive direction? Are they moving in a negative direction? And whatnot. Next, we're going to see ROI and cash flow. This is the most important thing for any project, guys. Mark my words. ROI basically is return on investment. The whole world of finance and analysis revolves around this concept, ROI. And next is going to be cash flow. The cash flow is one of the most important asset, or you can say one of the most important statement of financial statement, which is required by entity, because irrespective of the fact, whatever profits are there, if you do not have a positive cash flow, you're going to be screwed later then or earlier stage, depending on how much cash you have in your bank. Next is going to be performance management. What are the various techniques by which you manage the performance? You measure the performance of various projects. How do you manage their performance? How do you improve the performances, and so on? And lastly, we're going to be seeing different methods of project evaluation. What are the different methods on the basis of which you evaluate a project, which is to be taken up, which is to be dropped off? What's the benefit of taking one? What's the benefit of dropping other, and so on? Because understand this thing, organization is always constrained on two things: time and resources, for sure. Everyone wants to get the maximum output achieved in the minimum amount of time with the minimum spending of resources. For that, this different methods of project evaluation are a crucial thing to be understood. Okay, with this background in mind, we'll move ahead and we'll start with the introduction to financial concepts. Now let's begin with an introduction of the financial concepts. First of all, before diving deep into the financial concepts, let's understand a short description of what is a project manager. First of all, who is a project manager? When do you define yourself as a project manager? What are your roles and responsibilities? What are your liabilities for being a project manager, and stuff like that? So that gives you a brief insight into the life of a project manager, and then you can take a much better effective decisions as to what financial implications you need to be analyzing as a project manager. So let's begin. First of all, let's answer the simple question: who is a project manager? Oh, I beg your pardon for my grammatical mistake over here. It's supposed to be who are project managers or who is a project manager. Okay, coming back to the subject, guys. A project manager is simply any person who has been given a charge of a project. Okay, he is responsible, he is in charge of a particular project. Now, that project can be in terms of anything. It can be a financial project, non-financial project, any kind of project. But always remember this one thing: whatever the project will be, it will always have a financial implications. It can be a non-financial project like, brand advertising, launching a marketing campaign, and so on. But the end goal is always to generate revenues, profits, and all, and it ties back to the financial implications. Okay, so the project manager simply is a person who is given a charge of a project. That's one thing. Now, he is also the guy, or you can say, with this charge, with this responsibilities comes a lot of factors. He's accountable for a lot of things. He is responsible for the successful initiation of the project, successful planning, design, execution, monitoring, controlling, also closure of the project. A project cannot be open till infinite time. There is always supposed to be a due date, a closure date. Now, the project manager is responsible for making sure the project closes on time. The output is delivered to the client or the company or whoever is working on time. Now, making sure it has been contributing positive results to the organization, both in terms of financial aspects, that is measured by way of profitability, positive cash flows, as well as in terms of non-financial aspects. If the project has another KPI, or you can say key performance indicator, in terms of non-financial aspects, that can be by way of a brand image building, increase customer satisfaction, reduce customer complaints, anything. So, to give in a nutshell, a person can have any kind of activity as a project and is responsible for starting till the end of the project, also making sure he achieves the objectives with which the project was launched. Next we come is the roles and responsibilities of project manager. Now, the project manager's primary responsibility, the primary duty is recognition of the risk that directly impacts the likelihood of the success of a project, and that risk must be both formally and informally measured throughout the lifetime of a project. So what do you mean by formally and informally? Formally means, documenting every evidence that this is the risk which is going to come in, this is the risk which can going to come in. Like you can say a recent change in government policies might make the entire project obsolete. So he has to document that thing formally. Informal risk can be, you can say, if he has got some news by way of the gossips around the corner or grapevine communications that some XYZ competitor is going to launch a similar campaign in the next a week before he plans to launch the product campaign. That is an informal way of documenting the informal measure of a threat to a project, informal risk to a project. Those all the things he needs to consider because they all have a likelihood or they all have a possibility of impacting his work. Okay. Now, to put in a nutshell, the responsibility of project manager can be many activities, some of which are like planning and defining the scope of the project and the activities to be performed, actively planning and sequencing of the activities to be performed, resource planning, time estimations and preparing the schedules of the project, developing the budget for the project, preparing forecast, actively keeping a track on the project, documentation of the progress and important events for the future references. This is also one of the key aspects. Most of the time people forget to document the various steps they have taken, the various challenges they faced in the project, the various milestones they hit, when did they hit, what steps did they take to overcome the challenges and so on. If the documentation is readily available, if the project is repeated in the future, that can serve as a reference guide for himself if he's taking the project again or to anyone who is going to come up in his place and take up the project. Next, he's also need to be aware of the risk analysis, managing the risk, that is a SWOT analysis, strength, weakness, opportunity, threat kind of a thing for his own project. Risk analysis, monitoring, reporting progresses, team leadership, strategic influencing, vendor relationship management, quality control, and whatnot. You name it and it can come up. So you can say the project itself can run as an entire organization activity, where everything that is possible for the organization can be possible for a project manager also, because he's performing a part of the organization's core role. With that, we come to the next part, that is liabilities of a project manager. Now, the project manager, as we have been emphasizing, is responsible for the entire execution to the completion of the project, initiation till the completion of a project. But now let's look at a deeper way. What is a liability of project manager? Now, the project manager is responsible to make sure that his entire project is completed within the estimated budgets and the other guidance and company standards are adhered to. Obviously, every company has their own set of standards, their own set of policies, their own set of rules and regulations. So, the project manager needs to make sure that he completes the project within the budget allocated to him and also following the company standards, rules, regulations, so that company's image is not shattered by by him going out of the way. Even if he has to go make an exception, make sure you communicate with your top management, you speak up to your seniors who are involved in the project, your management team, and only after cautious approval, go ahead with that. With that exception. But most of the time it's not required, because companies who are authorizing the project, they do know what challenges can come up, because already most of the projects will have been done in the past with the companies. Even if they are not done, if it's a one-off thing, it's a new thing, they'll still have, you can say, people are much experienced to evaluate what are the various pros and cons, whereas possibilities, probable possibilities that can come up in the project and so on. Now, if any targets or deadlines are missed, then it is a project manager's liability to make up for the additional cost unless it was something beyond his control. So you can say, in a way, if the project manager knew that the cost can exceed because of a certain risk and he did not take up the adequate steps to mitigate that risk, it is obviously his liability. He is liable for the entire additional cost incurred by the company, additional loss of revenue by the company, and so on. But if it's something which is not in his control, like we said, if a company wants to do a marketing campaign by Facebook, Twitter, and suddenly government comes up with a rule that social media handles are no more allowed to be used in a digital marketing, bang, the whole project is screwed up. But that's nothing beyond it, nothing in its control. The project manager cannot control that campaign, that government's outcome. So those are the factors which needs to be considered, and accordingly he is made liable for those things. If it is in his control, he needs to make sure he takes adequate steps to mitigate the risk, to make sure projects are complete on deadline, to make sure they can be complete before the deadline, and makes the company a good amount of profit in terms of financial aspect as well as non-financial aspects also. Profit in terms of financial aspects, I believe we all understand: gross profit, net profit, increased revenue, cash flows, and so on. Non-financial aspects: increase customer satisfaction, reduce customer complaints, positive brand image for the company, and so on. Now, even though there will be technical challenges in completing the projects, which are justified many a times, it may happen that the project manager is not able to defend himself. The primary reason being that the project manager in most of the cases do not have a financial expertise. Okay, sometimes even the basic financial knowledge is lacking on their part. They might be experts in their field, they might have the whole Wikipedia published in their minds on the particular field in which they are working. It can be in terms of marketing, IT, web application development, mobile application, and so on. But because of this lack of the financial knowledge, sometimes they screw up on very badly. And the top management, or you can say the management, is mainly concerned with achievement of the numbers in most of the cases, while this guys, whenever the management approves the project, the end goal that they have in mind will always tie back to any sort of profit for the company. It can be in terms of financial measures and non-financial. Even if they are targeting a non-financial achievement, it all ties back to a financial number only. Think of this thing: why does the company want to take a project which is increasing their brand reputation, which is reducing their customer complaints, which is increasing their customer satisfaction, all just to pump up the sales number, all to derive a new revenue streams, all to get the customers' loyalty so that more sales can happen, ultimately all tying back to increasing profit for the company, right? So coming back to the point, so it happens that many times the technical experts are not able to justify the delays or additional costs involved for the project, and so on. Besides, precisely, they are not able to defend themselves when any kind of delay happens in the project. And because top management, or you can say the management, is mostly concerned with numbers, and these guys don't have the expertise, it becomes a real challenge for the project managers to defend themselves, to justify themselves. In that case, having a basic knowledge of the financial concepts helps these guys, helps the project managers go way beyond and defend themselves properly. Not only defend themselves, but give proactive suggestions, give proactive reports and analysis that this is why the project should make sense to you company and we should carry on. It's all a bit boring theory right now. I get the point, guys. Hold on a while. This lesson, once we complete this introduction to financial concepts, it's all going to be fun, the numbers and analysis, and you're going to love that thing. But before that, we need to understand what is the importance of this thing. Now, till now, whatever we have studied or whatever we have gone through, based on this, we can conclude that everybody, whether belonging from the accounts and finance background or not, he is going to manage a project at some point of time in their career. Okay, now everyone is going to manage a project at some point of time in their career. They will have their own team members, they'll have their own team, they'll be a team leaders, they'll report to someone, and it's going to happen. You will take up a project in your life irrespective of the fact you know it or you don't. But every project involves a cost on which a return is expected. Now, it is hard for the project managers from non-financial background to evaluate the financial progress of their projects and take corrective actions before it's too late in some cases, right? So, therefore, this course will help you in gaining that basic financial knowledge, and it will provide you, and I'll make sure that it provides you the tools and methods you need to evaluate the progress of your project. At least in terms of the financial experts, because that's where my domain lies, that's where my expertise lies. I'm not from a non-financial background. I have expertise only in the financial aspects and the accounting aspects. If you ask me, to be honest, what does digital marketing campaign and all mean, I'll be like completely blank because it's never done tried out. But yes, I can evaluate the financial aspects of that, and that's why I'm trying to share my knowledge and get you up and running to some speed. Now, with this, we complete the whole understanding of the project manager. What are the roles and responsibilities, what are the liabilities, and how everybody is going to be taking up a project at some point of time in their career. And this course will help you to be ready beforehand, before you at least start a project, or even if you are having a project or you have already been doing the projects, I'll make sure you get some useful benefits by studying this course and understanding how to imply those concepts in your actual ongoing project. And for those of you who have not started a project, this is a golden opportunity for you to learn to manage a project, at least in terms of financial and accounting aspects, so that you are more ready. Imagine this thing, your technical expertise plus the financial knowledge, combining the two different domains, that will give you a cutting edge in being a project manager. I'll see you in the next session where we're going to start with the financial concepts actually now. Now we'll begin our understanding with what is a financial statement. So before we go into the depth of understanding what statements or what reporting statements comprise of financial statements, let us understand what is a financial statement basically first. In a simple layman term, you can say financial statement are those statements which contain the financial information about an organization. Now the financial statements, they are the primary means of communicating financial information to the users of the users of the financial statement, and the users can be an external user as well as internal user. We're going to come that in a couple of minutes from now and understand who are external users and who are internal users, from what point of view both of them are going to be studying the financial statements. But as of now, understand this thing, the financial statements, they are the primary means of communicating the financial information to external as well as its internal users. Additional information that is not provided in the financial statements, that cannot be quoted in number format, that cannot be given in the financial statements, they are given as a note format, a financial statement notes. Supplementary information are also included in the financial statement, such as management discussion and analysis, other disclosures that are typically disclosed in the notes, which are essential to understand the financial statements, and so on. So that is the purpose of financial statement. In short, to communicate the financial information of an entity to its users, and the users can be external as well as internal users. A full set of financial statement comprises of a statement of financial position called as a balance sheet, income statement known as a profit and loss statement, statement of comprehensive income. The statement of comprehensive income includes all those income and expense figures which cannot be put in the profit and loss statement, that is your income statement. Statement of changes in equity, that is the owner's money. Okay, what is the change in the owner's money, owner's equity since beginning of the year at the close of the reporting period. Next is statement of cash flows, and lastly notes to financial statement. Together, these 6 things comprise a full set of financial statement. I'll repeat those 6 elements or 6 statements once again. Statement of financial position, also called as balance sheet, income statement, also known as profit and loss statement, statement of comprehensive income, statement of changes in equity, statement of cash flow, and lastly notes to the financial statement. However, from a project management perspective, you only need to be aware of 3 key statements, which are balance sheet, profit and loss, and a cash flow statement. Balance sheet will represent the assets and liabilities. Okay, how much the company owns in terms of assets, how much is company liable to pay to the external parties, what is the owner's equity in that. Profit and loss statement, income earned for the period, expense incurred to the period, net result, whether the income earned is higher compared to the expense incurred, are we in a profitable stage, whether the expense incurred is higher compared to the income earned, are we in a loss making stage. And lastly, cash flow, at what point of time cash is expected to come in, expected to go out, and so on. But 3 key statements are required to be understood from a project manager perspective. Balance sheet, that is also known as statement of financial position, income statement, that is also known as profit and loss statement, and lastly statement of cash flow. So these were the 3 key statements which we need to be aware of and which we're going to study in depth in a couple of minutes from now. Before that, let's understand who are the users of financial statements. So as we just discussed a couple of minutes ago, there are 2 users, external and internal. The external users are the one who are interested in doing business with the organization, and use of these financial statements will help them evaluate whether they should be going ahead with the doing business with the organization, whether it's beneficial for them to do business with the organization or not. For instance, your investors, the company's investors, are external parties who need the information to decide whether to increase, decrease, or invest in a firm. Okay, or even sometimes to decide whether to take the investment from the firm. The creditors of the company, they need information to determine whether to extend a credit period to the company organization, under what terms to provide the credit, for how much period of time to provide the credit. The financial advisors and analysts who need the financial statements of the organization to help their investors evaluate a particular investment. When the financial analysts and investors financial analysts and advisors, they take up the company's financial statement, they study, they do the complete postmortem of the financial statements and come up with useful relationships, meaningful data that they give to the investors readily, and based on which the investors decide whether they should invest in a particular company or not. Also, the stock exchanges need financial statements. Okay, yes, you heard right. The stock exchanges need the financial statements to evaluate whether to accept a firm's stock for listing on the stock exchange or to suspend the stock tradings or not. So basically, all the compliances flaw, the stock exchange also determines the compliances flaw from your financial statements. That's why it's mandatory for a publicly listed companies to upload their financial statements with the various regulatory authorities at least every quarter. There are different laws and compliances, but let's not get into the depth of this whole scenario, or else it will be a never ending session for us. But I hope you got the basic gist that external parties are all those ones who are interested in knowing the financial status of the company to decide on to make their own decisions, whether to invest in the company, whether to trade with the company, whether the company is complying with the applicable rules and laws, whether to trade the stock of the company, whether to suspend the stock of the company, and so on. Next, we come to the internal users. Now, the internal users, they are the one who use the financial statements to make decisions that are going to affect the day-to-day operations of the business. Okay, they are basically the persons who are within the organization who are going to use the financial statements. Let's say, for example, management. Management needs the financial statements to assess their financial strength and their deficiencies, to evaluate the past results and decide on the future course of action. Okay, what steps, how well have they performed in the past, how well are they able to meet their expected budgets and develop the future course of action. Do they need to raise the bars, challenge higher themselves, or are they underperforming, so they need to take precautionary measures, active measures to make sure they are at least meeting the budget, the targets which they are setting for themselves. Next is the employees. Yes, now if you're wondering why will the employees want the financial information, they do need. Employees want the financial information to negotiate their wages, their fringe benefits based on the increased productivity and the value they are providing to the company. So let's say if the company is keeping on generating more and more profit, but employees are not getting any raises, any pay increment in the paychecks. Obviously, employees will want to determine how well is the company performing and why are their promotions and appraisals not happening as compared to the increase in the productivity, in the value which they are generating to the company. And how can they measure the value they are generating, the value they are providing to the company? The first means will be a reflection on the financial statements. If the company's profit are increasing drastically day by day, it's obvious that the company employees are doing a great job day by day. But if they are not being appraised, appraisals are not happening, if they're not being provided promotions and respective pays, they will figure out that their market value, their value is not being considered by the organization as they should. And that's why they also need the financial information. So with this thing in mind, with this background, I hope you got a clarity on what is a financial statement, what statement comprises of financial statements, and who are the users of financial statements. Once again, a complete set of financial statement comprises of 6 elements. Number 1, statement of financial position, also known as balance sheet. Number 2, income statement, also known as profit and loss statement. Number 3, statement of comprehensive income. Number 4, statement of changes in equity. Number 5, statement of cash flows. Number 6, note to the financial statement. But from a project manager's perspective, at least if you are belonging to a non-financial background, you need to be aware of at least 3 financial statements, at least 3 elements of the financial statements, at least 3 components. Number 1, statement of financial position, also known as balance sheet. Number 2, the income statement, also known as profit and loss statement. And number 3, statement of cash flows. Now, with this thing, we end a concept of financial statements introduction. Now, with the understanding of the financial statements in mind, what comprises of financial statements, who are its users, in that in mind, we're going to see what are the objectives of creating a financial statement. Okay, why is it so important for entities to create financial statements project-wise from the entity's perspective, as well as what are the benefits a project manager can derive by understanding the financial statements, how they work, how are they evaluated, and so on. So first, look at it from the entity's perspective, for the company's perspective. What are the objectives of creating the financial statements for individual projects, for the organization as a whole, for the company as a whole? First is they are able to track the ongoing projects on a real-time basis. So if the financial statements are being prepared on a regular basis, say every weekly, every 15 days, every month at least, so the company gets an insight into the individual projects going on a real-time basis. Any organization will not have just one project to be carried out at one point of time. They will be having a multiple project sequence going on simultaneously. Hence, it is important for the company to know at least get a key insights into how each project is performing, and then take the future decisions with that regard. Next is determining if the project is meeting the standard returns. Okay, by standard returns, we don't meet the market standard returns, we mean the standard set by the company. So what is basically standard returns? Let's say government tax risk-free bonds gives a standard return of 6%. Okay, that is, you invest in your fixed deposit, your government bonds, and you're able to get a 6% return on that investment without any risk. You have a portfolio where your portfolio manager is able to derive a return of 15%. That is, by investing the various surplus cash in stocks and shares of other companies, by doing the bond tradings and all, he's able to give the company a rate of 15% annually. Now, if the project on hand is generating just a return of 12%, higher than the risk-free return but lesser than the portfolio manager's optimum return, do you think does it make sense for the organization as a whole, as from the point of the organization, to invest in the project which is giving just 12% returns? No, right? Because they will say, when the funds can generate a return of 15%, why should we invest in 12%? Unless there's some intangible benefit which is being proved, it's mostly rarely going to be happening, right? So you get the point. I hope you get the point that the company needs to determine whether the project are meeting their individual standard returns, their standard returns. If no, they need to divert their resources for a better utilization, for a better opportunities. Forecasting the outcome of the project. Okay, by forecasting the outcome of the project, we mean that if we have a continuous real-time data, and if suddenly the environment in which the project is operating changes, like some new regulation comes into picture, suddenly a new competitor comes and launches a similar product on which the company is already working. Here, the company can quickly take a decision whether to divert the resources from the existing project, whether to deploy more resource on the existing project, and such actions which will not only help the project manager but the entity as a whole to make sure the project is going to give the maximum return it can in the future when the project is completed. Divert resource from existing low return to high return projects. Let's say a company is having an ongoing project which is still going to take a sufficient amount of resources to be deployed to generate a return of 18%, and the company founds a new project, a new venture in which it needs to just invest half the amount of the project and generate a return of 25%. So here the company needs to think about whether to go ahead with the existing project or to divert the resources in the new project. If the existing project does not have a great bright future, promising future, the company will definitely put it in the new project, because the higher return, because of the higher utilization of the resources, better utilization of the resources, the higher return, and so on. So shutting down the existing low return project does make sense for the company. Let us say we'll continue the previous example of the forecast one. A company is already developing its unique prototype product in which it has invested $1 million till now. It's expecting to realize a revenue, or you can say a return of 17% on the entire $1 million, but with the condition that it needs to invest additional $500,000. And here the company finds another opportunity where they can just invest $500,000 and generate a return of at least 25%. What do you think the company is going to invest in? It does make sense from the financial perspective to invest, from the organization as a whole to invest in the new project, because that's more promising, has literally 1/3 of the investment cost, and gives much more higher return. So those are the decisions which the company can quickly take if it has a real-time financial statement prepared, or you can say these are the objectives for preparing a financial statement for individual project-wise for the organization. And lastly, identify the key performance across various projects. So over here, the intention is not to eliminate the low performers, but to identify the key performers who are performing at their peak capacity in any projects, and adopt their best practices, adopt their strategies, and apply it to the other projects being taken on within the organization, so that every project can perform to its peak capacity, to its highest capacity. Obviously, sometimes the intention of the management goes in a negative direction, but if you are a project manager and not able to give the optimum return, the best performance, and you can see that some other guy in the company is performing to his, it's generating much more higher value for the company when the same project or different projects, it does make sense to know his strategy, his understanding of the project, adopt those practices for yourself, for your betterment at least. If your project catches up with the other projects, it's great. Even if it does not, you'll at least learn the best strategies for project management, for a real, how to, analyze the financial statements and prepare your financial statement for project as that, in that line. So those are the benefits which the organization can implement from its own side. Now let's look at the benefits of, or you can say the objectives of preparing financial statements project wise for the individual project managers. Okay, why is it so beneficial for the project managers to prepare the financial statements for their projects? So before that, I hope you understand this one thing. All these objectives are being diverted towards one single objective, enhancing profitability of the organization. So that's why it's very important for the project managers to understand how the various methods of tracking the performance of his projects are working, a function, so that he can make himself aware of those methods and educate himself, and make sure he presents the financial statement, he prepares the financial statements on his own end using those methods and derive the following benefits. Take corrective action. By taking corrective action, we mean that taking corrective action before it's too late. Like one day you realize your project is not performing, the financial statistic of your project is not in a company's acceptable parameters, and they decide to shut down the project. Now suddenly you got off guard because you were not prepared for those kind of answers. Had the project manager had the basic awareness of the financial statements, had he prepared those financial statements in line with the company is going to evaluate, he could have taken proactive measures initial itself and modified his project according to the needs of the situation, and made sure his project would have survived to the end with generating a great positive returns also. Explain the top management of the future course of action. Now, if the project manager is able to create his financial statements on a real-time basis, he has a much better insight into what's going on and what should the future course of action be, so that his project will achieve the expected returns and the objectives with which it was started will be accomplished for sure. Develop better forecast and budgets. If the project manager has a good understanding of developing financial concepts, he can develop a better forecast, a better budgets for the projects, and deploy his resources and time for achieving those budgets and give a good return to the company, thereby establishing his valuable credential as a project manager and setting an example for the whole company, as setting an example for his other project managers. Like we just discussed a couple of minutes back, the companies do take the high performing project managers and set an example, and try to publish their methods, strategies which they use to other project managers, so they can also be brought up to the speed. Lastly, they are able to project the existing project profitability by analyzing the project's ROI, return on investment, and this is a favorite computation for any analyst, any investor analyst in the whole world. So by this we mean that the project manager can himself evaluate how much amount has been invested so far in the project, how much cost has been invested, what is the expected return of the project, and are there any other opportunities which can generate the same ROI. So the project manager himself can go ahead and sell the company that, look, this is a new opportunity which I found. Compared to the existing projects, this project has a good amount of return on investment. If we divert our resources there, we have a beautiful, great outcome, and the management may appreciate that and take his decision. And thereby he sets himself a great credential that when time was right, he did not get too emotionally attached to his existing project. He was willing to drop it and take up the new opportunities which were benefiting the company as a whole, thereby not just satisfying your ego but thinking about the company as a whole. A project manager is able to establish his credibility, trustworthiness much more, rather than sticking to the existing project which is not giving the optimum ROI, optimum return on investment, as compared to the other projects in other opportunities available. So with this, I hope you have a clear understanding of what is the objective of preparing the financial statements for a project, individual projects. What are the benefits of our project managers to understand the financial statements, how he can take corrective course of actions, utilize better opportunities, hunt for better opportunities, utilize a better forecasting, prepare better budgets, and achieve his targets within the set time frames, and thereby develop a good reputation, a good credibility for himself across the organization. So now we're going to start with understanding of the financial statements which are required from a project manager perspective. That is a balance sheet, income statement, and statement of cash flow. First, let's begin with balance sheet, or commonly known as statement of financial position. So what does a balance sheet represent? The balance sheet, which is also called as statement of financial position, this represents the amount of assets, liabilities, equity, and their relationship at a specific time, mostly at the end of the year. So we can say that balance sheet is just representing the statement of financial position, the condition of the financial position of an entity on a particular point of time. One transaction and the entire balance sheet can change. So if you have ever noticed a balance sheet in your life, or I'll just suggest go ahead and see any balance sheet. It will always say balance sheet as on dash day. It always says as on a particular day. It never says for the period so and so. It never covers any amount of period. It just states balance sheet as on a particular day. So the balance sheet, it helps the users to assess the liquidity, the financial flexibility, the risk the company is carrying, and so on. By balance sheet, the companies get an idea how much amount is the company carrying by way of loans, how much has the owners invested in the entity, how much assets they are holding, how much their data is outstanding, how much cash, bank, liquid cash is there with them, and so on. The elements of balance sheet are assets, liabilities, and equity. And there's a golden rule is that there's a relationship defined between the various elements of balance sheet, which is assets will always be equal to your liabilities plus your equity. Basically, this means that all the assets are going to be financed by your liabilities and your equity. Equity is basically the owner's money, stockholders' equity. It comprises of various elements and all of that, but I just don't want you all to be bothered with the entire depth of financial statements because that's not relevant from a project manager perspective. But however, what's relevant will be covered for sure. So, first of all, let's understand what is assets. The assets are the resources controlled by the entity or owned by the entity as a result of the past events. They represent the future probable economic benefits the assets are going to give to the entity. This was a bookish definition. To be honest, assets are those elements or those benefits which the company has accrued over the past by performing its past events, by performing the activities till now, whichever they perform, and gotten itself in the condition that they hold the assets now. Example will be the inventory. Entity purchased the inventory in the past and now it's controlling the inventory as of now. That's why it's there on their financial statements. A result of past event, benefit for the future. The property, plant, and equipment, the investment, account receivables, everything is linked to performing some activity in the past because of which the ownership has passed the entity as of now. That's why they are coming in the asset side of the balance sheet. Similarly, liabilities, they are the present obligations of the entity arising from the past event. Their settlement is expected to result in an outflow of the economic benefit for the entity. Example includes the loans, bond issued by the company, accounts payable, vendors of the company. Company purchased the goods on credit in the past because of which it has to pay its vendors on a balance sheet date. Hence, they are a part of liabilities. Generally speaking, equity is the balance of the liabilities amount reduced from the asset. In other way, you can say the assets which are financed by way of liabilities, balance in that is equity. That is, they are financed by the owner's money, the equity of the company. Example of equity includes the common stock, preferred stock, retained earnings, and such things. Retained earnings is nothing but past undistributed profit. Remember this golden thing. Retained earnings or reserves and surplus basically means past undistributed profit. The company had generated profit in the past period, but they did not distribute to the owners. They did not put it to some other use, and that's why they are lying in reserves and surplus as of now. So, I hope with this you got a basic idea of what is an asset, liability, and equity. This is what comprises your balance sheet. Now, before we go ahead, I just want to take you into a depth of assets and liabilities. How are they classified first? Assets are classified as into two categories, current assets and non-current assets. Current asset is classified as a current asset or you can say a current item on the statement of financial position if it is expected to be realized in cash or sold or consumed by the entity within their operating cycle or 1 year, whichever is longer. So before we go ahead, let me just give you a quick description of an operating cycle. Operating cycle is a point of time when the company purchases it completes its one operating cycle. Basically, from the point of time a company is purchasing its inventory to the point of time it's sold and cash is realized against that sale, that is one operating cycle for an entity. So suppose in case of a manufacturing unit, let me just put this way. Suppose if a computer chips manufacturer, they procured the inventory on 1st of Jan. They prepared the computer chip by 15th of Jan. The chips were sold on 20th of Jan and the cash was realized on 30th of January. So in this case, the operating cycle lasted for a period of 30 days, that is 1 month. From the point of procurement of the chips to the point of realization of that chip or the final product, that is one operating cycle. So now if you remember, I had said this thing over here. The asset is classified as a current item on the financial statement if it is expected to be realized in cash or sold or consumed within the entity's operating cycle or 1 year, whichever is longer. That is, if it is probable that the asset is going to be converted into a cash or benefit is going to be realized within the next 1 year or the operating cycle, whichever is longer, then it's an current asset. Now, if you have a strike question in your mind that at what point of time can the operating cycle be more than 1 year? How is it possible that company takes more than 1 year to develop the product and sell it? You're on the right track. You're getting a good hang of the financial statements now. But let me tell you this thing. There are certain exceptional industries where it takes more than 1 year of time to convert the asset to a finished product and sell it and realize the cash. The best example will be a construction industry. Imagine this thing, construction of a high-end tower, okay, a skyscraper, which is going to have a residential flats as well as commercial flats, commercial spaces and everything. But will that construction be complete within the 1 year? Will the construction commence on Jan 1st and guaranteed complete on December 31st? In 99%, it's not going to be done, right? So there, the operating cycle is definitely going to be more than 1 year because the manufacturing or the preparation of the raw materials with the finished goods itself is going to take them for more than 1 year of time. And because of that, their operating cycles is going to be the higher of the 1 year side. It can be 3 years, 5 years, anything, till the point they are sure that this is a time by which we realize to expect collect the cash. So in those exceptional industries, the operating cycles do go for more than 1 year. Now the major categories or the major items which are included in the current assets are cash and cash equivalents because they are readily realizable in cash. They can be realized as in how you want to sell them. Certain individual trading items, that is the securities which are available for sale and they are held for trading part, like a company invested in the share of a certain company just to play the price. It intends to sell it in the next 15 days itself, so it's going to be available for sale. The held for trading, the intention itself is to trade it on a regular basis. Inventories, the prepaid expenses, because they are paid in cash but the benefit is expected to be realized in the next 1 year itself. Those are the kind of current assets. Non-current assets, now these are those assets which do not qualify as a current asset first of all. So any item which is not qualified as a current asset comes in the category of non-current asset. Ideally, in a way, assets which are going to take more than 1 year or the operating cycle to be realized. Now, the major category in these non-current assets are investment and funds that are intended to be held by the entity for a period of more than 1 year or the operating cycle. So, investments in securities made to control or influence another entity and other non-current securities. So, whenever companies invest in other entities' securities, other entities' shares or investment in their bonds, and when they issue debentures and so on, the intention is to hold them for at least a 5 to 10 years period till the time they're going to be realizing a good amount of returns. So those investments which are not going to be sold or realized in the next 1 year, they are going to be your long-term asset, basically non-current assets. Next is a property, plant and equipment. Now, property, plant and equipment, these are the tangible operating items that have been recorded at cost and they are reported at a net of accumulated depreciation basically. So suppose you have a machinery that has a life of 5 years. It's already running in the third year. Do you think it's fair to report the value at which you purchase a machinery back before 3 years, supposing for $100,000, and the end of 5 years, the machinery value is going to be $0? So, does it make sense to report the machinery value still at a value of $100,000 at the third year end also? No, it doesn't, because you need to show the realistic cost the machine can realize if it's sold. That's why every year you take out a part of the machinery cost by way of depreciation, and that is called as the reduction of the asset basically. So in the third year, the machinery will be recorded at just $40,000. That is $20,000 reduction for 3 years period. Remember this thing: every property, plant, and equipment will be is subject to depreciation, except for one: land and natural resources. They are not subject to They are not subject to depreciation. They are subject to depletion. In case of land, mostly even that depletion is not allowed because land value is appreciating day by day. It never depreciates, to be honest. The land is the only scarce resource which is, even in the remotest corner of the world, it has an increasing value only. And the third category of the assets are intangible assets. Now, the intangible assets are the financial assets without any physical substance, without any physical existence. They cannot be seen, they cannot be touched, they cannot be felt. An example of that, best example of that, is a goodwill. The company's goodwill. Many times the company purchases another company by paying an additional cost above their fair value of the assets and liabilities. That is towards the goodwill, the brand which the reputation which the company has bought. So that is an intangible asset. The patent, the trademarks which the company carries on for itself, those are all a part of the intangible assets. Similar to this thing, even the liabilities are classified into two categories: current liabilities and non-current liabilities. The concept remains the same. Current liabilities are those which are expected to be settled in the ordinary course of business during the longer of 1 year from the balance sheet date or the operating cycle. The major categories of, I'm not going to go in depth to explain you now the whole concept of operating cycle. I believe you're aware of that by now. So I'll just quickly dive into the example, what kind of current liabilities are there, what kind of non-current liabilities are there, and then we'll go and look at an example on a balance sheet. Current liabilities majorly include trade payables, that is your vendors, the other payables arising from operations such as accrued wages, salaries, rental payables, royalties payable, income tax payable for the current year of operations, and so on. The unearned revenue, that is basically collection of revenue in advance from customer. This is mainly in case of subscription business model where customers pay you a 6 months of subscription in advance. There, because you have not delivered your service, the sale is not yet actually happened, you need to record it as a liability. Suppose in case you're not able to fulfill your promise, you need to return the money back. So that's a liability you're carrying on till now. But because it's due within the next 1 year, you classify as current liability. If it's more than a year or the operating cycle, you put it in the non-current liability section. Even that's one important thing to note. Now, the non-current liabilities are those which are basically, going to be, which are not current liabilities. The same concept over here. Non-current liabilities are those which are not basically current liabilities. These can include the bonds payable, bonds issued by the company, the debentures issued by the company, advance from non-current customers. Like, as I said, if the advance subscription is received for 2 years, you're going to split it into two parts. Half of the part goes to the current liabilities, half goes to the non-current liabilities, because that's due after the next year. With this thing in mind, I hope you have a clear understanding at least a basic understanding of what does the balance sheet look like, what are the financial statements, what is the statement of financial position going to comprise of, and so on. Now, it's not necessary for you to understand the entire balance sheet in depth. There are many more elements to cover in that if you go in that area, but it is advantageous to know the basic concept of a balance sheet, because that helps you to understand how your project is going to be evaluated, how your project is going to come in the company's books of account, how at the end of the term, end of the reporting period, how is your assets and liabilities utilized by you, created by you, going to be reported in the company's books of account. Now, we'll quickly look at an example of a balance sheet, and that should help you to make your concepts much more clear. So this is an example on a balance sheet over here. If you see the fact over here, the asset section comprises of three things: current and non-current assets. The non-current are classified further into investment, the fixed assets, and the intangibles. That is, all this area, investment, fixed assets, and intangibles, they comprise the non-current assets. Over here, the current liabilities and the rest is non-current liabilities. And another component which comes over here is the shareholders' equity. And the total of the assets is equal to your liabilities plus your stockholders' equity. So let's quickly go to the items one by one to get a quick understanding of why this item forms a part of the current or a non-current section. Okay, in the asset side, we have the cash, obviously readily realizable. Debtors due within the next 1 year or within the operating cycle. Prepaid expenses realizable within the next 1 year. That's why these all form a part of the current asset. Investment, plant expansion fund. The company has been keeping a part of the earnings aside to and has been investing in another profitable securities, and that intention is just to replace the plant. So many times it happens that the companies have purchased a plant which has useful of 10 years, but the cost to procure the plant is huge and it takes a big amount of cash flow to generate the whole amount in one shot. So companies every year for the next 10 years will put a part of the amount inside, so that at the end of 10th year, when the existing plant is retired, they have readily available new plant. Sorry, they have the funds available with them readily to purchase a new plant. Then investment in marketable securities. Here the surplus cash, surplus funds are invested for generating better returns, but the intention is to hold them at least, or sell them after completion of 1 year, and so they form a part of investment. Fixed assets, land, building, machinery, all are fixed assets. And make sure you note one thing: these are reported net of depreciation. That is the actual realizable value. Intangible, as we said, that's just one example of your goodwill. Company purchased the assets, or procure another company, and the additional cost paid towards its net book value assets is classified as a goodwill over here. In the current liability section, we have accounts payable, salaries and wages due, income tax payable. So all these three, they are due within the next 1 year or within the next operating cycle. Hence, they form part of current liability. In the non-current liabilities, we have the long-term bonds, the debentures issued, that is all due after a period of 1 year. Lastly, we have the shareholders' equity, that is a capital stock, retained earnings, and so on. That gives you the total stockholders' liabilities and stockholders' equity. Before we proceed to the next part, there's one important note which I wanted to make. A balance sheet is always prepared at the corporate level, so it is difficult to break it down to individual project level. So the point is that it's literally not feasible enough. It is possible, but it's not feasible enough to prepare the balance sheet at a individual project wise. And the main reason over here, if you notice that In the liability section, we have this long-term bonds. Now these bonds can be issued to raise a capital which is accessible for every project the company has undertaken, as well as for the common activities for the organization also. Let's say a part of the bond is utilized for procuring a new office, expansion of the office where every employee sits, okay, for bringing every employee to the centralized location. So in that case, it's difficult to allocate the uh, part of the bond to the projects over here. So that's why balance sheet is always prepared at the organization level, not at the individual project levels. Okay. With this thing, we complete our concept on balance sheet. In the next session, we're going to start with the income statements. Now we're going to look at the next component of the financial statement, next element of the financial statement, that is income statement, commonly known as a profit and loss statement. So we'll just try to study it on the same lines of balance sheet, like, what does it represent, what is the purpose, how is it useful for the project management wise, and stuff like that. So first of all, let us understand what does a profit and loss statement represent. So as the name suggests, the profit and loss statement represents the profit or loss earned by the entity over a period of time. Now that time can be a daily basis, weekly basis, quarterly, monthly, yearly, anytime. Unlike balance sheet, it is not required that a profit and loss statement has to be there for a one particular day. Profit and loss statement can represent any given time frame. It can represent up to a period of 10 years, 1 year, 5 years, anything you name it, you can make it. Okay. So that's what is profit and loss statement. It represents the profit and loss, or you can say in a way it gives you the net results of your activities done for a period of time, and that activities will comprise certain income generating things, certain expenses. The net result will be either profit or a loss. So that's what is done by the profit and loss statement. The profit and loss statement elements are revenues. Now these are the inflows, or you can say the earnings arising by performing core operations of the company, not any other activity, just core operations. Let's say if the company is engaged in the business of providing service, education, coaching, okay, but if in case of that education coaching, it had an auditorium and it leased it out and it gave it out for some corporate events and stuff like that, those income from the renting out of the auditorium won't come in revenue, they will come under gains. So gains are basically those inflows arising from performing activities other than revenue generating activities, whereas revenues are those inflows which arise from the core operations of the company, undertaking the core activities of the organization. On the same line, we have the expenses and losses. Now expenses are basically the outflow, the reverse of the revenues. They are the outflows which are occurring because of performance of the core operations of the company. Okay, because the company is involved in education service, it needs to pay its content developers, so that is an expense for the company. But because the company is letting out the auditorium on a weekly, on a rental basis, as per the occasions, as per one-off thing, it needs to pay an additional housekeeping guy to clean the auditorium. So that is a loss for the company, in a way an expense or an outflow from performing other than core operations of the company. So that was all with regard to the elements of profit and loss statement. 4 elements: revenue, gains, expense, losses. And unlike like we had a relationship in the balance sheet, we also have their relationship in the income statement. Your income or your loss, either of things are going to be there. It's never going to be both of them, and that's a basic thing. You cannot have a plus and minus simultaneously. It will be either a plus figure or a minus figure. Will be equal to all the revenue and gains minus all your expense and losses. So all the positive or the incoming minus all the outgoing, that gives you the net result, either an income or a loss. Just let's quickly look at an example in the same lines as we looked at for the balance sheet, and that will help us understand what exactly is an income statement prepared. So here, if you see net sales $800,000 less the cost of goods sold. So here this net sales forms a part of your revenue, and this cost of goods sold forms a part of your expense, because these are performed towards operating, or you can say the revenue generating activities of the company. Again, selling expenses, these again form a part of your expense because they are performed for day-to-day core operations of the entity. Administrative expenses, they also form a part of your expense because without these administrative expenses, the core operations cannot be performed. Other revenue and gains, these are part of your gains. This can be by sale of a machinery, by additionally renting out the premises, and so on. Other expenses and losses, these are part of your losses because these are generated not because of the performance of the core operations of the company, but because of any additional other activity. It can be like sale of a machinery for a loss. Possible, right? I had a machinery, I sold it for a loss because it was not giving any value. So I just decided to convert some cash on it, but I did realize a loss on that. How did that happen? Suppose I had an old typewriter, okay, an antique typewriter worth $2,000, but nobody's willing to type, nobody's using that. I found a buyer on a Craigslist or a eBay for $500. I sold it for $500. I made a loss of $1,500 because the value of the typewriter was $2,000, but I had to sell it for $500. That means I made a loss of $1,500 over here. So that is how you book an expense, you realize and loss, and you realize other gains and revenues. That gives you your income before taxes, less the income taxes, and that gives you your net income over here. So I hope with this thing you got a quick glimpse into how the financial statements and balance sheet are prepared. How do you interpret the financial statement? How do you interpret the balance sheet and so on? In the next session, we're going to see an example on how project managers can plan, can defend themselves, can defend their projects by utilization of the income statement and the financial ratios. That will help you to understand and the importance of knowing the financial concepts pretty well. Okay, I'll see you in the next session. Till then, if you are from non-financial background, just make sure to go through the financial slides, at least the balance sheet and income statement again. Till then, have a great study time. So I hope till now we clearly have an understanding of what is a balance sheet, what is an income statement, and so on. And now we're going to see how does one uses the income statement analysis to defend or justify his project when the management has a different opinion. So this is more going to be a case study kind of a thing. So we're going to do a case study on using income statement to justify the project profitability. Obviously, first of all, as a project manager, you should be clear in your mind that is the project profitable or not. And for that, you need to have certain computations done, which should be readily available with you, so that when the management has the other opinion, you can defend your project. So let's look at this case study. So let us assume a project manager, Mr. X, is being evaluated for his ongoing project, which has been posting a reducing net profit percent every quarter. So now Mr. X project is showing a negative net profit, or you can say a loss every quarter on quarter. So the management concluded that since the project profitability is going down, it is better to discontinue the project. Now let's see how Mr. X is going to go and defend his project, or you can say justify that his project is a profitable one, whereas how did it turn out to be a negative one in the eyes of management. Okay, so we're going to go to an example, but now over here, if you see, I'm going to be doing a slight twist in the example. Till now, all the things were pre-written in the sheets and we used to go through the slides and all. Now I'm going to build up the entire scenario in front of you guys. Okay, so even you have a realistic example, realistic feel of how the things are building up on a step-by-step basis. Okay, so let's say the management of Mr. X wants to discontinue his project. So they show him the records that this is how your project summary is being shown. So first of all, we'll say that the project manager, Mr. X, received the following income statement summary, based on which it was decided that his project is supposed to be discontinued. Okay, so here we're going to have income items. This is for quarter 1, quarter 2, quarter 3. Okay, perfect. A couple of minutes more, guys. Just hold on. Okay, so he receives an amount of total sales value generated from his project, or you can also say it as a revenue that is expressed in terms of dollar values. Okay, then we have the net profit for his projects quarter on quarter basis. Then you have the net profit expressed in terms of percentage, which is a net profit divided by total revenue percentage. That's it. Okay, so how do you think things will build up? First, we have our numbers over here. 280,000. Just one second. I believe this whole formatting needs to be taken care of at once. 280,000 for quarter 1, 286,000, a slight increase in the revenue, and 300,000 in quarter 2. The net profit posted for quarter 1 was $42,000. For quarter 2, it's reducing $40,000, and for quarter 3 it remained the same. But if you see, comparatively to the increase in revenue, it's remaining the same. So ideally it is decreasing in that sense. Okay, in the relative sense, it's decreasing. Now we'll calculate the percentage of this thing. That is the net profit divided by the profit percentage. That's 15%. Oh, my bad. There's expressed in number values. We apply the same formula over here, quarter 2, quarter 3. So as you can see, it's decreasing profits. Okay, the net profit percentage, it's decreasing quarter on quarter. And based on this statement, based on this summary, the management is right in taking the call that you need to scrap the project because it's turning out to be a loss-making one. Better to stop it when you still have a chance than incur the entire loss and then regret, right? Now let's see how Mr. X was able to defend his project over here. If he did not have the financial bandwidth, the financial understanding, obviously he would have said, it's fine. I do realize the project is making a loss quarter on quarter. It's better to shut it down. But here, because Mr. X has a brief insight, or you can say a detailed insight into how the financial worlds work, how the financial analysis is relevant to project management, he asks management to provide him with the detailed financial statement so he can do a postmortem of his project for himself and then come back with the result. And then on asking for a detailed income statement summary, Mr. X receives the following. Okay, this is going to be the same. We'll use the same template over here. The total revenue are going to remain the same. Then we have the cost of revenue, that is all the direct costs. Then you get the gross margin on deducting the. You not worry about this thing. I'm just trying to show you how things shape up so you have a realistic view. I'll be explaining everything in detail once I finish my creation of the entire table. Okay, just hold on for a while. Operating income, then you have other expenses, and then finally you have the net income. Oops. Okay. We'll try to build a formula base over here, okay? Okay, say. So for earning $280,000, the cost of revenue was $200,000. And based on which you get a gross profit, that is total sales or revenue minus the cost of revenue, that gives you the gross margin. Then you have the operating expense of $25,000. You have operating income of $55,000. Okay, now operating income is basically gross margin minus the operating expenses, that gives you the operating income. You have other expenses allocated to this project, that's $14,000, that gives you the net income of $41,000. Okay, so I just realized I made a typo error over here. This one is supposed to be $41,000. This is supposed to be $39,000, and this is supposed to be $38,000. So now if you're wondering why is this amount in the net profit percentage not being changed, they do change over here, but the fraction is changing. That's why it's just expressed in a 0 decimal factor over here. If I increase a decimal point over here, so you see if it was $42,000, it comes to $51,000 and so on. But yeah, I'm just skipping it for the safe side to map up with what computations I have made, so we have a quick understanding of the entire sum. So now for quarter 2, the cost of revenue was increased marginally. So again, you have the formula over here, that is going to be total revenue minus the cost of revenue, that gives you the gross margin. You have the operating expenses at $23,000. They reduced in a way. Ideally, they reduced entirely. And then you have other expenses of $23,000. So here, it's going to be operating income minus other expenses, that gives you the net income of $39,000. The same way we'll put it here. The quarter 3 has a cost of revenue or $205,000, that gives you the gross margin of 95. Operating expenses of $26,000, that gives you the operating income of $69,000, and other expenses allocated were $631,000. That gives you the net income of $38,000. Now this net income maps over here with the net profit over here. Ideally both are the same amounts, to be honest. Okay. Now, based on this detailed analysis, Mr. X is now in a position to draw some conclusions, to pick up some ratios and then go back to management and explain them where things have gone wrong and get a chance to continue the project or then take a call with the management to discontinue the project. But till now, I hope you're clear on how you analyze the detailed statement over here. Once again, we'll go through it quickly. Your gross margin is nothing but total revenue, the sales minus the cost of revenue, minus the cost of generating that sales, okay, minus the direct cost involved to fulfill those sales. Then you have the operating expenses reduced from the gross margin. Operating expenses are basically those expenses which are required to keep the project ongoing, okay. For example, you need to buy some machinery for the project, specifically for this project, and you need to pay a rent every month, a license fee every month. That is a part of the operating expense to keep the machinery on and on, to maintain it on and on for this project. Then you have an operating income. Operating income is basically your gross margin minus your operating expenses. That gives the operating income. Then you deduct the other expenses from your operating income. This could be anything, a common HO, common head office expenses allocated throughout all the projects, and interest cost applicable, a blanket interest cost applicable to all the projects because the financing is taken for the common benefit of everyone, and so on. That gives you the net income, final net income of 41,000 for quarter 1, 39 for quarter 2, 38 for quarter 3. Now let's see how Mr. X was able to draw some meaningful insights in this and defend his budget and defend his project ideally. And that will study in the next session one-on-one what things are to be taken into account. For now, I hope you're clear with how we built up the entire thing, a summary of the income statement, and from that we went on and obtained an entire detailed income statement from the management to do a postmortem on why things should be stopped. I hope you're clear on how we went from a comprehensive income statement to a detailed income statement, and let's look at the various components. Now we're going to do a complete financial postmortem of the detailed income statement. That is this part over here. Okay. So first, let's begin with every formula or every margin or the income which is derived by deducting one component from the other. So first, that is going to be a gross margin analysis done. So first of all, what is gross margin? How is gross margin derived? As a formula stated over here, revenue minus cost of revenue. That is this minus this gives you the gross margin. So now we're going to compute the gross margin percentage first of all to determine, is the gross margin percentage decreasing on a quarter by quarter basis? Is it stagnant, same, or is it increasing? Ideally we are going to try to figure out, is the cost of revenue increasing? Is that the factor why the net income is reducing every quarter and quarter? So let's begin with that thing over here. First of all, let me write down the formula over here for you. Gross margin equals to revenue less cost of revenue. Okay. Now we're going to conduct a gross margin analysis. So this over here, which is going to be, we'll take the same format over here. Gross margin, and we did one more. Okay. So here we're going to replace this thing by gross margin percentage, which is going to be the gross margin divided by the revenue. That gives the percentage expressed in form of percentage over here. Gross margin divided by the revenue percentage. The same one over here. Oh, surprisingly, this is increasing. As you can see over here, gross margin for the quarter 1 was 29%. It increased to 30% in quarter 2 and 32% in quarter 3. So based on this analysis, one thing is for sure, gross margin is, or the cost of revenue increase is not the factor for the decrease in the net profit. So what does this mean? First of all, let's interpret this thing. So based on this analysis, we can say that the gross margin percentage has increased, which means that the direct cost of the project, the cost of manufacturing the goods for the project, is not the reason for the increase, for the decrease in the net profit. Now, since the gross margin analysis did not work out, we'll increase our computation to the next part. That is going to be the operating income analysis. Now, in the same lines which we did for the gross margin over here, we're going to be figuring out that whether the operating income, which is derived by reducing the operating expense from the gross margin, is that responsible for the decrease in the net profit? Yes or no? We're going to come to the conclusion pretty soon, like we did for the gross margin over here. I'll just copy the same template over here first of all. You guys just rely on the final version, okay? Don't need to be banging your heads around the mechanical works over here. Operating income is equal to your gross margin minus your operating expenses. Minus operating expenses. So here we're going to be having now total revenues. Perfect. We don't need this cost of revenues. We need the operating income. So we're going to be putting this over here. Operating income equal to We'll try to do this all formula driven so it's easy for you guys to do on your own also. Bang, here we have it. It's supposed to be 20%, 22%, and 23%. Okay, so again, the operating income part is also increasing. One second. So, based on this analysis, we can say that the operating income percentage is also increasing on a quarter by quarter basis. So, even operating expenses are not a reason for the decrease in the net profit of the project. Okay, so that's how these computations come in handy. Surely, the operating income part over here, operating expenses which are incurred specifically for the smooth operation of the project, even they are not responsible for the reduction in net profit. In fact, there is an efficiency achieved in both the areas, the cost of revenue as well as the operating expenses, because your gross margin and your operating income are rising quarter by quarter, are increasing quarter by quarter. They are not reducing, they are increasing quarter on quarter. So with this, we can conclude that even operating income is not a factor for reduction in the net profit. Now, last expense item which is pending is this other expense analysis. So we'll try to interpret the other expenses over here. The other expenses, they have increased drastically. Okay, you can say 14, it literally went to increase in a 50% over here, 23,000, in fact more than 50%, and from 23 it went to again on a higher level of 31,000. Now, the first of all, these other expenses are not relevant to the project, first of all. Okay, so the project manager X cannot be blamed for the increase in the other expenses. In fact, you can say that if project manager X project did not exist, the other expenses will be a burden on the other projects because of the operating income of 55,000, 62,000, and 69,000. The other expenses have been absorbed substantially by the project. And if we just compute the operating income analysis, we can say that project managers Mr. X project is doing a performing an absolutely brilliant manner because it's giving a positive an increase in the net profit, operating income profit and the gross margin every quarter on quarter. That means his operational efficiencies are gone up. He is doing a great job in the operating part of the project, operation of the project, because he's able to achieve economies of scale and other standardization of the product process and all those things, which are ultimately leading to an increase in the better utilization of the project resources and giving an positive operating income quarter on quarter. Even his consumption of the goods, direct materials used in the project, direct labor involved in the project, the operational efficiency of that has increased because the gross margin is also going higher, is also increasing quarter on quarter. That means project manager Mr. X is able to achieve operational efficiencies on a higher scale. But because of this other expenses, now what can be this other expenses? It can be a common allocation of the head office cost. It can be a common allocation of the interest involved. Supposing the company has gotten a big revenue, it has got multiple projects, and it needed to take up a huge loan, which was needed to finance its assets, employ more manpower, and whatnot. Now we'll try to understand how do we measure the growth of the project. So, is the project going on a steady pace? Is it declining trend? Is it the growth going on a negative aspect? Or is the growth going on a trajectory basis like a hockey stick? Or is it a steep growth? What kind of a growth is there? You need some metrics, some idealistic analysis or formulas to define to measure the growth of project. So the growth of the project can be measured most only by two ways. One is by way of a revenue analysis. That is, here you measure the growth in terms of dollar value of the sales. How fast are your sales increasing? How much are they increasing? That's the first question. And next, which is a more precise way of analyzing, is the net income or the profit analysis. This is done in terms of percentages, in terms of ratio. So whenever ratio is involved, percentage is involved, you compare one thing to the other and that gives you a much more better insight. Now, let's go to the Excel sheet and we'll solve the whole thing like I had done in the previous example. Previous case study, we're going to be recreating it from scratch entirely. We'll use the previous example itself, but then you'll have a quick understanding of how the whole build up is done and how you measure the growth in terms of revenue as well as in terms of net profit analysis. Let's begin with the example over here. Oh, I already did some part over here. First, we'll see at the revenue analysis. So we'll measure this project growth analysis by way of revenue analysis. Okay, so over here you have a revenue of $280,000 for quarter 1, quarter 2, quarter 3. Just bear with me for a second. We'll be done with our computations in no time quickly. Okay, so here we have a revenue, total revenue on in quarter 1 of $280,000, in quarter 2 of $286,000, and lastly in quarter 3 of $300,000. So how do you measure the growth over here? Or you can say the increase in revenue. What is the percentage of increase in revenue on a quarter by quarter basis? So you take the first quarter as your standard quarter over here, as your base quarter over here, and then you compare that with the growth in the other quarters over here. So for first quarter, you won't have any percentage because that's the standard or the base, the starting point of the comparison. Next quarter, you have a revenue of $286,000 compared to revenue of $280,000 in the beginning in the first quarter. So the formula which you're going to use is we're going to take the difference over here, that is 6,000, divided that by the original in terms of X percentage, and that gives you a 2% increase in the revenue. We apply the same formula over here. Compared from $286,000 to $300,000, that gives you a 5% increase in the revenue. So you can say that the project has grown to 2% in the second quarter, and from 2% it took a jump to 5% growth in third quarter based on the revenue part. That's how your revenues increased every quarter on quarter. By revenue, we mean the sales over here. Don't confuse this with the net income or the profitability of the project. That's an entire different ball game. We're going to be looking at in a couple of minutes from now, but this is important just to determine how are the sales growing for the project. Now, the net income analysis is a much more realistic analysis. Why? Because in the net income analysis, the primary reason is that it also takes into account the cost which you incur to derive this growth in the revenue. Okay, sometimes it happens that the cost of the acquisition is far more than the revenue which is derived from the new customer, and hence although your sales will show an increasing trend, your cost is increasing at a higher rate than your sales, resulting in an overall loss in the project on a other side, not the profitability. That's why it's said that the profitability analysis or the net income analysis is a much more preferred method to determine the growth of the project. Also, the management is mostly interested in determining what is the project profitability, not just the increase in the revenue. Okay, so now let's go ahead and see how do you make the analysis of the growth analysis in terms of net income or a percentage. Net income by percentages over here. Before we go ahead, I just want to give you a small heads up. In the net income analysis, there are two methods to determine how a growth is happening. Either you have a increasing revenue as we have in the growth analysis over here in terms of revenue, and then you compare that with the net income or the profit percentages where it's constant on a quarter on quarter basis. And the other part is where your profit percentage is a constant, is increasing, and your revenue is a constant factor. So both of them sound tricky as of now, but just bear with me for a couple of minutes and I'll try to get it resolved completely for you guys. Okay, so the company expected to have a 10% profitability on the project. Okay, and that profit percentage is going to be constant. So now your net income will be total revenue multiplied by the profit percentage, that is $28,000. And the same goes for quarter 2 and quarter 3. So that's how the net income goes to $28,000, increases to $28,600, increases to $30,000. That is one aspect of the growth analysis when you use a net income or percentage method, where you keep the profit percentage a constant factor. You have determined that you are going to be getting a profit of 10% throughout the project life, and that's why every quarter on quarter it's going to be constant. But because of the expertise which you gain in the operational efficiency, the cost of manufacturing efficiencies, and so on, your revenues also starts to increase, and that's how all these factors combining increases your net income by the same amount, by the proportionally the same amount, the increase in your revenue. Now, this is one aspect of the net income analysis where you have a fixed percentage of profit. Fixed percentage of profit. Now we're going to looking at the another aspect where your revenue is a fixed percentage. Revenue is a fixed dollar value. Fixed revenue. Okay. So before we go ahead to the fixed revenue part, let me give you a small heads up when it happens. Most of the contracts which a company enters, which organization enters, they are of at least a year or 2 years in terms of timeline, and they have a defined contract value at the beginning of the contract itself. So what happens in that case is that the company allocates a quarter on quarter a fixed amount of revenue which is going to come recurring to the company. Like say the government makes some of the private companies take up a government project and builds a road for them, for which the government is going to pay them a royalty of a particular tenure. Okay, royalty, license fee, such thing like that. Now that fees amount is fixed for the entity. The how the entity can earn profit is by achieving operational efficiencies and increasing its profit percentage on a quarter on quarter, or periodically increasing the profit percentage over year. So here the revenue remains the same because that's a fixed amount determined in the contract itself. However, the entity expects to increase the profit percentage on a quarter on quarter basis. So let's say in the first quarter increases it's 10%, in the next quarter they expect an increase of 1%, and in the third quarter they expect an increase of 13%. So here you have the net income increasing $28,000 in the first quarter, increases to $30,800 in the second quarter, increases to $36,400 in the third quarter. This increase was achieved not by increasing revenue, but by only achieving one thing, that is a great operational efficiencies reduction in the cost of manufacturing, cost of the direct cost of the project materials, and so on. And that is what is termed as an increasing profit percentage over here, where your revenue is constant, but your net income rises only because you're achieving operation efficiencies. So these are the two methods of analyzing the growth of a project. One is in terms of revenue figures of the contract itself, that is this method over here. Next is the method of net income analysis, where you have two methods: fixed percentage of profit, that is this amount always remains constant, and lastly we have growth analysis, net income percentage, which is based on the fixed revenue concept, where this amount always remains constant. Always remains constant. And the same thing happens over here for revenue part, always remains constant. So I hope with this you are able to get a good understanding of how you're going to be evaluating your project, how you're going to justify your project, how you're going to protect your project in terms of the profitability analysis, and next how you are going to measure the growth of your projects. Now sometimes if you have a question in mind that why is it important for me to keep a track of the growth of the project where everything is defined beforehand, it is important. Let's suppose Mr. X had this project going on, and he also had at the same time company had and project being carried out by Mr. Y, who was also doing a profitable at the same operating at the same level of profit as Mr. X project. Now if the entity has to decide, if the management has to decide which one project to continue and which one to drop off because they are having a resource constraint, a time constraint, anything, which happens very much in the realistic world also. The next step they're going to look up is the growth analysis. Which project has a better growth prospect and ultimately giving better net income to the company, better profit to the company, and the entity will carry on only those projects which has a good growth potential. So that's why it's also important for you to know not only the income analysis for the existing projects which are going on hand, but what is the growth prospect of the existing projects which are in hand, as well as the project which you're going to take up in the future. With this, we complete the growth analysis of a project also. Now we're going to study one of the most important aspect of a project management, that is cash profit versus book profit analysis. Before we proceed with the actual differentiation between the two, let us understand what is meant by book profit, what is meant by cash profit, and then we'll have a clear understanding of what is the importance of comparison and knowing both of them. So, what is a book profit? Book profit means the profit which is reported by the books of account based on the financial accounting. Okay. Now, the entries which are posted in the books of account, the transactions which are posted as a books of account, are based on an accrual basis of accounting. Remember this term. The books of accounts are built up on the principle of accrual basis of accounting, which follows a matching principle concept. So, what does this concept state? This principle of accrual basis of accounting states that the income which are earned during the period, okay, irrespective of the fact whether they are collected or not, the income which are earned during the period should be reported in that period, and expense which are incurred during the period should be reported in that period itself, to make sure they are matching. The transparency is there a true and fair representation is made for the period of accounting. So I know the accounting language might be a bit complicated. Let me try to simplify it by giving an example. Suppose the organization pays its employees on the 5th of the next month. The salary, the payroll due for the month of January is paid on the 5th of February. In this case, when the company makes up its accounts on records its expenses in the books of account on January, it will also include one line item, that is salary expenses for the month of Jan, irrespective of the fact that they are being paid in the month of February and not January. That is called accrual basis accounting. The expenses are recorded when they are incurred. Their date of incurrence is important, not the date of payment. Similarly, when you close a contract and you generate a sales invoice in the month of January, which is going to be collected after 2 months of credit period, say in the month of March, you still record the sales invoice in the month of January to make sure the period in which the sales has happened, the period in which the sales was closed, is recorded in the same period and not when the cash is ultimately collected from the customer. That is what is meant by book profit. When you incur an expense, you record it an expense. When you are liable, or sorry, when you are due to receive a income, you for a particular period, you make sure the income is booked in the same period, not the future period when it's actually received. Now, based on this income and expenses analysis, you get a profit or a loss amount. That is called a book profit or a book loss amount. Okay, because it's based on the booking of the accounting system. Now let's understand what is a cash profit. Cash profit is entirely reverse of the accrual basis of accounting. Here you follow a cash approach. That is, irrespective of the fact when you made a sale or when you made incurred an expense, you book a sale or an expense only when cash is actually going out or it's coming in. So continue with the previous example. Let's say you had booked a sale on the January, but the collection came in month of March. So when you're following a cash profit system, you will record the sales amount only in the month of March when you actually receive the cash. Similarly, for the expense of payroll, which was incurred in January but paid in February, you will record the cash expense for the payroll in the month of February when cash actually has gone out, not in the month of Jan when it was actually incurred. Now, I hope till now you got the point that both of the system will result in a different profits amount for the projects, okay, for any entity. Now, what is the importance of knowing both the things? We'll just look at an example and that will give you a clear insight as to what is the need for having and understanding of both the cash profit as well as the book profit. So let's see over here. One second, I'll just make one quick change over here because you will need this files for your record. Okay, so let us understand. We'll take this thing over here, the same part, line items over here. Book profits. Okay, just remove all the colors. We don't want any fancy thing going on for this one. Okay, here we have book profits. Here we have cash profits. Okay, so for the book profit, we made a sales of $800,000 over here, against which the expense incurred was $300,000. So now your gross margin is supposed to be total revenues less the cost of revenues. That gives you the gross margin. Now, based on after the gross margin, you have an operating expenses which were $220,000. Okay, so that gives you the operating income of $280,000, and then you have the other expenses for, let's say, $10,000 only. Okay, wait a second. I'll just put one more line item over here, which will be other income. Let's say this was $20,000. So now your net income is going to be operating income plus other income minus your operating expenses. That is $290,000. Okay, so this was based on the book profit. Okay, here you recorded all the expenses which you incurred in the period. Let's say for month of January 2018. Here you recorded all the expenses which are incurred for the period Jan 2018 itself. Okay, now we'll jump on to the cash profits. So in the month of Jan, the company collected a sales amount, cash account receivables from its debtors at sum of rupees $400,000 only. So understand this thing, even though the sales are $800,000, it is not recorded at the entire value. It just recorded the amount of collections actually realized from the customers. Here, and the company paid, let's say, an expense of $275,000 only. It has a credit of $25,000 still due in its account. So it's just going to record an expense of $275,000. That gives the gross margin of $125,000 compared to the $500,000 over here, because the company is not accounting for the sales or for the credit sales over here. Operating expenses, let us say it's supposed to be $200,000 over here. 20,000 is still outstanding, but you only account for what is actually paid till now. That's $200,000 over here. That gives you the operating income a loss of $75,000. That means it states that the company paid $75,000 extra from its own pocket. It accounted a loss till now. Other income of the $20,000, you realized, let's say, half of the amount till now, and other expenses you paid 7,500. Let's say, keep it safe, $6,000 a year. So now your net income will be operating income plus other income minus other expenses. That is $71,000 over here. So if you see the difference over here, you received an income of 10,000, you paid an expense of 6,000, the balance is 4,000. That is an extra income. So that goes to reducing your losses of $35,000, and that gives you a cash loss of $71,000 over here. So I hope this was clear to you. What's the difference between the cash profit and the book profit? Now we'll just see what is the importance of this both things over here. The key difference over here is that an entity or a project manager has to strive to make sure the gap between the cash profit and the book profit is the lowest, as low as possible. It's rarely going to be the same one, because you don't get the entire collection and you don't pay all the expenses in the same period. But the project manager needs to strive for reducing this gap as much as possible. Why? Because even though if your project is doing great, it has a great profit margin till now, but if the cash profit is less, that means the collections are not happening as quickly as it should be within the credit terms of the company's defined credit terms or the industry credit norms. Then you are losing out on the opportunity cost of the project. Then you are incurring your own expense, own cash flow. You're burning out, you're putting a hole in your own pocket to make sure the project sustains and survives, which is also not a good sign. So, by the analysis of this book profit versus cash profit, an entity, a project manager, is able to determine whether the credit period that has been given to the customers is a good one, is it a reasonable one, should they reduce the credit period, should they take other better precautionary measures to reduce the credit period, to deliver better services so that the cash is collected quickly, to deliver projects on much faster pace so that they can realize the cash of the project or the proceeds from the project on a priority basis. The next aspect to compare here is that try to figure out, are they paying up their expenses too quickly? Are they making the full use of the credit period provided to them by their vendors, by their suppliers, by the creditors? Or are they losing out on the opportunity of taking a full advantage of the credit periods? Now understand these things. In India, at least I know this thing, that many of the banks give you an option of creating an FD even for as low as 7 days with an amount as low as just 5,000 rupees, 5,000 INR. So if you have a spare cash of credit period of 20 days or 30 days period, that's the industry norm. And imagine if you have the cash lying with you and you can pay to your supplier, which is not going to give you any discount, any cash discount search. In that case, you can put this entire amount of extra cash, supposing they say $100,000, in a fixed deposit, and that will give you an interest for a period of 25 to 30 days for the credit period. And when that matures, the interest income goes to the other income, and you pay off your suppliers on time, maintaining a good relation, maintaining your credit reputations, and so on. At the same time, when you don't collect the cash from the customers on a priority basis, right, on the due dates itself, you are losing out the opportunity to earn the interest on those cash. It's ultimately adding another cost to the company. That is the opportunity cost, the opportunity lost to earn interest had that amount been invested by the company itself in a fixed deposit or any liquid fund and stuff like that. So that was important aspect to know. What is a book profit, what is a cash profit, what is the importance of analyzing both of them, and how to try to strive a balance, or you can say close the gap as much as possible between the book profit and the cash profit, resulting in an overall profitability of the project itself. With this, we complete another important aspect, that is the analysis of a cash profit versus book profit. In the next sessions, we're going to be starting with the various ratios involved in the project analysis. Then we'll go ahead and see the various project evaluation techniques, which project to be taken on hand, which project meets the company's expected return on investment, and so on. And lastly, we'll have a look at how to budget for a project, how do you prepare a budget and forecast for the entire projects based on which you select which project to take up, which project to be dropped off, and which project to be pursued at what point of time, and so on. Till then, I want you to quickly go through all the slides and examples and just understand what are the steps we took to recreate this entire things from scratch, the computations and all the stuff. Now, with the completion of section 1, we begin our section 2, which is mainly focused, or you can say, which is covering the cash flow and ROI. ROI basically means return on investment. That's going to be a next part of a section B. For now, we'll start with cash flow. So if you recall, cash flow statement is one of the important component of the financial statement. It is a part of the financial statement. So let's try to understand a bit what does cash flow means ideally. What is a cash flow statement? As the name suggests, cash flow is statement provides you with the entire scenario of your cash balances, the cash movements. When is the cash coming in? When is the cash going out? At what point of time you have surplus cash? What point of time you have a deficit cash? When do you need to arrange for the cash? When do you have excess cash to invest and earn income on that cash? And so on. I know it sounds a lot detailed, but it's not. Trust me. Once you understand the template and the components of the cash flow statement, it's going to be a really kid's job for you. So let's go ahead. I believe you must have been understood by now what is a cash flow statement. Okay, it's provides cash flow statement just provides you with the entire summary of your day-to-day, monthly, month-by-month cash balances. It can also be weekly. It gives you an entire summary of what point of time the cash is going to come in, from what source is it going to come in, for what purpose is it going to go out, for what reason, to whom the cash is going to be paid, and so on. Okay, so what is the need for a positive cash flow or a positive cash position? So first of all, before we understand the need for a positive cash flow or a cash position, understand the meaning of the term cash position or a positive cash flow. At the end of a period, when you're done with computing your cash flow statement, you might either have a positive side or a negative side. Positive comes in when your inflows are more than your outflows, and negative comes in when your outflows are more than your inflows. Now, why is it important for entity to have a positive cash flow statement or a positive cash position? It is because companies are precisely here speaking for the project managers, they always need to hold a surplus cash to make sure they are prepared for unexpected contingencies coming up, unexpected emergencies coming up, unexpected expenses coming up. In a way, you can say that simple enough. Okay, that's one of the key factors. So, and when they have a greater opportunities, like but if they had a surplus cash to invest in a better machinery, they can yield better results for the project. So to capture the unexpected opportunities also, you need to be cash ready, you need to have a positive cash flow, and to make sure that you are not facing a cash crunch, so that your entire team or entire project is not under pressure to be completed on an early stage to recover the cash from the customers, because most of the time projects are based on deliverables, and when you have to rush up with the deliverables, there is a great chance of a compromise on the quality. So more than the financial aspect, the positive cash flow gives the project manager a peace of mind that yes, project is heading on a right track. They have a surplus cash to encash every opportunity which comes in their way, which they want to utilize. They are prepared for unexpected contingencies. They have a backup for unexpected expenditures arising on the way, and they have a opportunity to invest the excess cash in a better resources, which will help them to deliver the project in a better way. Okay, or you can say to improvise on their project to make the project more efficient and deliver it more quickly, and so on. So this was a small gist on why is it important to have a positive cash flow statement or a positive cash position. Now this this was all with regard to the aspect of a project manager to manage or to maintain a good cash flow position, a positive cash flow position. Also, there's one more important point which is applicable if the project manager is managing multiple projects. Supposingly, if the project manager has multiple projects on hand going on, if one of the projects falls short of cash and it is in dire need of cash to encash a good opportunity to pay off an unnecessary expenditure or so on, if the project manager is aware of its cash positions at any point of time, and he has a surplus of positive cash flow in the remaining projects and the other projects, he can divert the resources from project A to project B, which is demanding cash flow for the time being, and then when project B generates a positive cash flow, repay it back to project A. This he can do only if he has a good control over every project. He knows the cash position, the projected cash flows in the future period in and out for every project, and then he can use this temporary financing arrangement between his projects itself. So this was all with regard to why does the project manager need to maintain a positive cash flow or a positive cash position. Now cash flow from generating activities are classified into three categories. Okay, cash flow generating activities are classified into three categories. Sorry. Cash flow generating activities are classified into three categories: operating activities, investing activities, and financing activities. So we'll go in depth for each of them. But remember one thing, as a project manager, you are mainly concerned with the operating activities because this is the area of activity on which you will be able to exercise the highest level of control. The investing activity and the financing activity, those decisions are mainly, or you can say decisions with regard to these activities are mostly taken at the corporate level. However, as we go ahead and see the examples, you'll be able to understand that to a certain extent, even as a project manager, you do exercise some control over the investing and financing activities. But the main area which is under your control as a project manager is the operating activities related to your project. So before we go into the depth of this and see an examples, I just want to give you a quick heads up as to what these three activities are classified as. The operating activities are those activities which are performed by the organization on a day-to-day basis. These are the core operations for any entity, and any activities which generate a cash by way of performing the day-to-day operations, those cash flow are reported in the operating activities. Let's say, for example, payment from receipt from a debtor to whom sales was made on credit, cash sales, your payment to creditors, your salary payments, your office rent, utilities payment. All these activities, if you realize, they are the core operations. They exist to support the core operations of the entity, and hence these all are classified as an operating activities. Investing activities, as the name itself suggests, when you have a surplus amount of cash lying with you, you don't just keep them in the bank lockers or in your company lockers. You need to invest them so that even they can generate an income for the company, an income for the organization. So whenever the entity has a surplus cash and it invests in generate an additional revenue from that investment, it is called as investing activities. Now it's not necessary that the surplus cash is generated only for the purpose of income, earning the interest income or the dividend income. No, many times the companies need to purchase a new asset, a new equipment, a new land, a new office building. All those things are done to support the day-to-day operations of the entity, but they do not fall under operating activities because they are not the core operations of the company, right? That's why these all the activities of are classified as an investing activities. One is whenever you have a surplus cash and you invest it in some bonds, securities, deposits, any kind of thing, and any purchase or sale of those securities are termed as investing activities, are reported as a cash flow from investing activities. Also, whenever you purchase any fixed asset, machinery, plant, equipment, also, or when you sell those equipment or those fixed assets, the cash flow generated from them is classified as an investing activities. And lastly, we have the financing activities. Financing activities are those activities where the entity enters into a financing agreement with institutions to raise capital for their company. It can be by way of a loan, by way of issue of new shares, and when they have a surplus cash, they can also buy back their own shares, repay out the loans, and stuff like that. So those are all classified as a financing activities. So I believe by understanding this different area of activities, you must have got an idea that operating activities are the area where you as a project manager have a greatest level of control. When you have some surplus cash, you invest it, but that's going to be a passive income for you. You cannot exercise much control in that area. That's up to the entity's policy also, whether it's allow the project managers to invest the cash or they ask them to return back the cash when they have in surplus and so on. So with this mindset, we'll just go ahead and see an example on the cash flow for, first of all, for an organization as a whole. Then we'll see a small cash flow statement which technically can be said relates to a project manager, how a project manager can prepare his own cash flow for his own project. Okay, we'll see that in the next session when we compare with both the examples simultaneously. Till then, I hope you had a good understanding of the cash flow statement. Make sure to repeat the slide again, at least go through the points again, because this is one of the crucial component for you as a project manager to analyze how do you manage your cash and analyze what point of time you need the cash, when is the excess cash lying around that you can invest in, and so other questions. Now let us understand an example on a cash flow at an organization level, then we'll look at an example on a cash flow at a project level. We'll continue with the same trend where we prepare the entire thing from scratch in Excel, so we even you can have an understanding how things go on, what is the flow of its movement from one point to A, point to B to point C, and so on. Okay, so first let's prepare cash flow at the organizational level. Okay, so let's say in the books of ABC Inc. We'll say statement of cash flow. So we need particulars, we need amount which will be in dollars, and so on. Okay, okay. Let me just make this whole thing at a proper level first of all. Okay, 12 seems to be good enough option now. The first thing is cash flow from operating activities. Okay, this will be a first activity. As you defined, cash flow statements is broken down into three components, or cash flow generating activities are classified into three activities: operating, investing, and financing. We'll begin with the operating section first. Okay, what can be the first we look at what can be the inflows from a cash flow from operating activities. Okay, so let us say collection from debtors, the most common one. Okay, I just remove the bold. You can say collection from your debtors. Might be, let's say, around $20,000. And also we'll put this statement of cash flow for the month of March 2018. March 2018. Okay, $20,000 received from the debtors. Then we can say we received a collection from, what else can be the collection? Okay, discount, any cash discount which you received, will they come into this cash flow statement? No, they don't, because you only record the actual cash coming in and actual cash going out. Debtors, discounts, and trade discounts, sales discount, all those will be taken care in your income statement, your profit and loss statement. Okay, so what else can be the thing here? Okay, let's say we have a cash sales. That's, let's say, $10,000 cash sales, right? We have a sale of an obsolete stock. That can be around $1,000. So that was good enough for collection from the debtors and cash inflow coming in from the operating activities. Now we'll look at some of the outflow of the cash. First, up and common, payment to creditors. Cash going out, so it is supposed to be a minus figure over here. Let's say $10,000. Okay, one more important aspect which we need to remember: whenever there is an inflow, you add it to the cash flow. Whenever there is an outflow, you deduct from the cash flow. Okay, keep this thing in mind always. Whenever there is an inflow, you add it. Whenever there is an outflow, that's deduction from the cash flow statement. So here we have payment to creditors. Then let's say we have a selling expenses, that is your salesman commissions, your transportations, and whatnot, minus $2,000. You paid your salaries to employees for March, that's another $5,000. You paid your utilities for March 2018, that's another $2,000. Oh, sorry, minus $2,000. Okay, so that was good enough, and this total gives up the net cash flow from operating activities for March 2018. Okay, and here you just use the summation formula for the entire amount, and you have a positive cash flow of 12,000 for the month of March from your operating activities only. This is all with regard to operating activities only, right? So in the same line, we'll just see, and remember one thing, that is at the organization level. We are talking about the organization level. The project wise cash flow will be much more condensed, much more shorter in size and transactions and volume, but it's better to know first of all the big picture, then cut out and customize a small picture according to the requirement. Okay, so here now we'll move to see how the cash flow from investing activities work, and for that we'll use the same template from the operating activities.
and we'll just modify it as per the requirements. Cash flow from investing activities. Okay, obviously the activities line item are going to change for sure. So let's say what can be chances of an inflow from an investing activities. uh, we had mentioned sale of fixed assets. So sale of an equipment is an investing activity. Cash inflow due to an investing activities. Let's say we sold the equipment for 50,000 bucks. We can say we purchased an equipment in place of the old one. Purchase of a new equipment oops equipment for say like $60,000. Then we sold investment in shares of XYZ company for let's say around $20,000. Here you have a positive cash flow, and purchase of new equipment is supposed to be a negative cash flow, so it's gonna be a minus figures over here. Okay, so I think yeah, that's pretty much good for the investing activity section. I believe you get the point which we're trying to emphasize, and we'll move on to the financing activity section for the company at the organizational level. Oh, sorry, purchase cash flow from your financing activities. Financing activities. Here, what can be a financing activities? Come on, let's try to think it together. We paid a dividend on outstanding shares, so that's cash outflow due to the in financing activities. Because you have the shares, you are liable for paying dividends, and that's why it's a financing activities outflow. We bought back a shares buyback of shares because we had an exist surplus cash. Buyback of shares, but let's say even that's an outflow because you have to pay the cash to get the shares, another $5,000. We can say we issued bonds to raise capital for a new machinery, for purchase, for expansion of activities, or any other reason, but just issued bonds for let's say $30,000. But issue of bonds is where company is getting the money in. Okay, they are utilizing the cash, so that's another $30,000, and that's a positive cash flow. Yeah, I think that's good enough to go now, and believe we can put a conclusion to our cash flow statement, ending statement. So with this, we need to be analyzing what is the ending cash balance for the month of March. So before that, we need to know what is the net cash flow. Okay, that's it. Net cash flow for March 2018. That is gonna be, let's say, label operating activities labeled as A, net cash flow from investing activities labeled as B, investing activities labeled as B, and lastly, net cash flow from activities labeled as C. Oh yeah, the C is gonna be hectic, or it will pull up the copyright mark symbol. So just keep it simple, C. So the net cash flow from for March 2018 is gonna be your A plus B plus C. That will put the formula over here. That is gonna be $12,000 plus $10,000 plus $15,000. That's gonna be $37,000. Okay, so this was your net cash flow for the month of March from the various activities, but there's still a catch. We're not completed a cash flow statement. Yes, hold on a while. Now to this, we add the opening cash balance on 1st of March 2018. Now this balance was brought forward from the February 2018 cash flow statement. Okay, understand this thing. When you're figuring out the cash flow, you need to reach the end balance of cash for the particular month, right? And to reach the end balance, you also need to account for the opening balance. How do you calculate what is the end asset you have in hand? You need to figure out the opening balance first, then add the net effect of all the transactions, which can be positive or a negative. In our case, we had a positive cash flow, and that gives you the ending balance of a cash flow. Let's say in the month of March, in the month of February, we had a negative cash balance of $5,000. Okay, so here we put minus $5,000, and so that gives you cash balance on 31st of March 2018 as $37,000 minus $5,000, that is of $32,000 is your net cash balance at the month of March, or you can say precisely closing cash balance on month in March 2018. Closing cash balance as on 31st of March 2018, that goes to $32,000. So yeah, that was all how an organization level cash flow statements are prepared. And now with this, I hope you have a good understanding of how the cash flow statement operates, how you need to measure your cash flow, understand how the organization level cash flows are prepared. And now we'll quickly look at one more example, which is going to be a very small cash flow statement, but that will be with regard to a project. I'm not going to be able to list out every single item which is going to be covered in the project. It depends on project to project. For example, IT based projects will have a different cash flow line items, especially with regard to the operation expense. The marketing project manager will have his own different cash flow line items, especially in the operating section statements, again depending on the activities carried on by them on a recurring basis or the activities which form a core part of their project. But I believe you'll be able to get a small hint how is the project level cash flow going to look like, but it's nothing going to be different compared to what we just looked over here. Okay, we'll take the same example over here, use the same thing and put it over here in a side-by-side basis, so that should help you also to get a quick comparative analysis precisely. Okay, cash flow at the project level. Sorry, caps lock was on. Project level. Okay, we don't need to write this books and all. We just label project XYZ and we label the project manager as our famous Mr. X. Okay, statement of cash flow for, we just need to modify the labels here, project XYZ for the month of March 2018. Now, what can be the cash flow for project X for Mr. X? It's obviously data collection can be there if it's a revenue driven project where they have the timelines and all set it up. We'll say we had a collection of somewhere around $5,000 for the month of March. Cost of sales, cash sales, nothing. We'll remove this thing. Obsolete stock is supposed to be the company's liability, I think so. We paid to creditors for, let's say, $2,000, which are only relevant to Mr. X project over here. Okay, selling expenses may not be there. We'll keep it for the timing, but we'll reduce the amount. It cannot be that substantially high, so we'll just put it as $100 over here. Salaries to employees. Here we need to put one more thing. A project can have a couple of employees specifically hired for a particular project, or they can have the common resources of the company which are available to all the project managers. We'll put into account only those salaries which are paid to employees who are specifically hired for project XYZ or are specifically involved in project XYZ. Okay, so that's gonna be something around like say $2,000 additionally for the month of March. Utilities, no, they're going to be common throughout the organization. So that gives us a net cash flow of $900 for project XYZ's operating activities. Now, cash flow from investing activities, all these things, sale of equipment, purchase of equipment, selling of shares and all, they all are the organizational activities. They cannot be reported in the companies or the project's cash flow statement. So let's try to understand what can be an investing activity for the project XYZ, or you can say for Mr. X. Supposing even he had last month this $900 from operating activities, and he invested that cash flow in a liquid fund for a period of 1 month to get an interest income on that. So investment in liquid fund, we'll put it investment in liquid fund. He's a smart guy. He won't invest the entire amount. He knows he need to have some amount in his hand to spare. So he just invested $500 of the liquid fund. So now net cash flow from the investing activities is gonna be $500 only, right? And lastly, we have financing activities. If it's not going to be most of the cases that project managers are liable to raise finance for their own projects. No, they get access to the common funds of the company because companies decide that this is the budget we have for this project and you need to play within this budget only. Here is a check for your project, check of budget which is there for your project and so on. But let's say over here Mr. X is at liberty to raise the loan if needed. Okay, and this is supposed to be collateral free working capital loan. So we just put your working capital loan for project XYZ. I think $1,000 should be sufficient based on what the working capital requirement is coming up. And so they raised a working capital loan of $1,000. Now net cash flow from operating activities. Oh, sorry, I'm not supposed to write this here. It's supposed to come over here. $1,000. Now net cash flow from the operating activities. Let's say that is the total. Obviously, that's the total of these three things. Sorry, my bad. I went to a different zone. Okay, so your net cash flow A plus B plus C is going to be $1,400. Negative 900 from the operating activities. Invested 500 out of that. That leaves you with a balance of 400. Additional $1,000 loan for the working capital of the project XYZ. That gives you a total of 1,400 net cash flow for the month of March. Also, additional opening, he had, let's say, suppose an additional funds of $200 in hand on 1st of March. Closing balance of Mr. For the project XYZ on 31st of March comes to $1,600. So technically speaking, there's no difference in these two on a fundamental levels, right? Principles are the same for both of them. The only difference lies in the line item. The one for the organization level is going to be an exclusively detailed one. The one for the project level is going to be relevant only for those items which are incurred for the projects. That's it. So this was all with regard to an example on a cash flow statement. I hope with this you have a thorough idea, a clear-cut idea of how the cash flow statements are prepared, both at the organization level and at your project level also. Fundamentally speaking, there's no difference in the application of the concept. The only difference lies in analyzing the items and allocating them among the operating, investing, or financing activities. But as a project manager, most of the time you need to be worried about your operating activities because that's where you have an exclusive control. The other areas you can just leave it to the higher management of the company or the finance team of the company. Your core focus should be only in this section, the operating activities and how to maintain a positive cash balance, a positive cash position in these section. That was all, guys, for the cash flow statement. Now we're going to look at another important, or you can say a small type of strategic for you project managers on how you can enhance your cash flow position of a project. Okay, what are the small steps, small improvements which you can undertake as a project manager to make sure you have a good cash flow position, or even better that you are improving your existing cash flow position. The first is increasing the credit period from the vendors. Now if you are having a bulk procurement, if you're purchasing the goods in a bulk quantity from your vendors, you can negotiate for a good deal of a credit period within them. Suppose if you have an existing credit period of 60 days, you can get it extended to somewhere around 90 days at least. Okay, but it depends on the quantities which you're going to purchase from them. Or if you have a good relation with them where you have been paying your credit on timely basis to them within the due dates, make sure to utilize the entire credit period from them. You might be wondering how is that enhancing, or you can say how is utilizing the credit period going to enhance my project value, my cash flow position. It does nowadays. At least there are funds where you can park the additional funds above, just say any funds above 5,000 can be parked in an FD for at least 7 days. Okay, the minimum requirement is 7 days and 5,000 rupees. So let's say you have to pay a vendor an amount of rupees 1 or 2 lakh, and you have been paying it before the credit period gets over, supposedly within 30 days. You're losing the opportunity to earn entire 1 month of interest, and your vendor who's receiving funds from you early is going to park the funds in his own account FDs and get an interest from that funds. So try to get more credit period from the vendors is the first principle. If not more, negotiate for a cash discounts, for a great discount, a good discount rates, and at least make sure to utilize the entire credit period from your vendors rather than paying it upfront to them just for the sake of maintaining a good relation. No, if you have a 60 days credit period, it's better to pay on the 59 day and utilize and keep those funds parked in an liquid investment, or you can say kind of fixed deposit for those 59 days and earn an interest income for your project, for your, which will improve your cash flow position. Next is decreasing the credit period of the debtors. Now here you need to do exactly the opposite of which you are doing for your creditors. Negotiate with the debtors, show them the benefits which your project is giving them, show them the benefit which the goods are going to give to them, and try to negotiate it and negotiate the credit period down to, supposedly if you have an existing credit period of 90 days, try to get it down to 60 days or even better 30 days. That's how you negotiate and get more. The earlier you receive the funds with you, the more we can park them in a liquid investments and earn and passive income from that also. Okay, the idea here is to get the money in your control as soon as possible so you can invest it for your own betterment. Okay, those are the strategies which you need to apply as a cash project manager. Other thing is eliminating the unnecessary expenditures. Obviously, if we take a deep look, if we scrutinize our records, every cash, every penny spent, we realize most of the time, not in just project manager, but also in a personal life, there are a lot of opportunities where we can save the money, where we can save the unnecessary expenditures. And not only that, saving of the unnecessary expenditures, but when we invest those unnecessary expenditures very well, smartly, we earn a good amount of income on that, a passive income in the personal life that leads us to a financial independence, financial intelligence. In the project management perspective, it leads you to a better cash flow, a positive cash flow, an enhanced version of your positive cash flow. Next is investing the idle cash to generate a passive income. As the guy said in the book, The Richest Man in Babylon, never let your money sit idle. It should always be working for you 24 by 7. Whatever income you get from your cash flow, you keep on investing that, and that compounding of interest gives you multiple fold returns. But that's applicable for a long-term scenario, 20, 15 years down the line as a project manager. But still, it's important that whatever cash savings you are making, any unnecessary expenditures eliminated, any received from the debtors earned at an earlier point of time, any payments made to creditor by and using the entire credit period, you need to generate a cash income on that. And how can that be done? By investing it in the surplus, by investing those surplus cash, right? Lastly, make sure to repay the loans and the interest on the due dates to avoid the penalties and additional interest payments on the late payments. This is applicable when you have taken a loan or for your project. Okay, when you have been given a loan for your project and management of that loan is entirely up to you. So in that case, make sure you're paying up the loan, especially on the proper due dates, making the entire interest payments on the due dates, and thereby maintaining not only a good credit position, but you're also avoiding a lot of bad reputation, a lot of additional interest payments and penalties, a lot of cash outflow which could have been gone out by way of additional interest payments and penalties and so on. So these are some of the few pointers which you can use as a project manager to enhance the cash flow position of your project, to generate a positive cash flow position on your project. I hope with this you are able to comfortably analyze a cash flow position, study the cash flow position, prepare one for your own, and apply the steps to enhance and come up with more tips on your depending on your projects to enhance your cash flow position for the project. With this, we complete a part B of cash flow. In the next session, we're going to start with the ROI, that is return on investment. Now we're going to come to the other part of section, that is ROI, which is return on investment. So first of all, what is a return on investment? As the terminology itself suggests, you're going to invest a particular amount, you're going to invest some time and resources in a project. What is the return you expect to get from the project? And that return you're going to quantify it in mathematical terms, okay? So it has to be something which is quantifiable. The return which you get has to be something quantifiable. Now, many times projects are undertaken with the intention of non-financial returns also, like brand value enhancement, goodwill creation, and making people aware of your company's product and all those things, which ultimately lead to obviously increase sales, increase revenue, increase profitability. But the intention of a particular project may be to enhance the non-monetary, non-financial factors for a company. But we're going to restrict ourselves only to the financial factors and understand how do companies evaluate the ROI, the return on investment, and take decisions accordingly. So, to summarize, what is an ROI? It is just the return which you expect to get on your investment, which is quantified in a mathematical terms for a financial understanding. Okay. So this was not a standard definition. First of all, by the way, this is something which I have been trying to give you in a layman's language so that you can be aware, especially those with a non-financial backgrounds, you can be aware of meaning of an ROI, return on investment. Okay, so let's understand how do companies use the return on investment to evaluate which project needs to be undertaken. And this can be done better, can be understood better only by the way of an example. So we'll go back to our way. Let's say the company is doing an analysis of which project it should take up, which project should choose. It should choose. Okay. Now over here, let's say the company. Okay, let me first make it at 12. The company has a budget of $1 million. So that is the resource constraint. The maximum the company can spend on the project is $1 million. Now it can choose a combination of two projects or drop one or choose all three if the project requires only that maximum limit of investment. We'll see how it works out in now. Let's say the company is considering three projects: project A, project B, and project C. This will be project C, project B, and project A. Okay, so by taking this project, the company expects an increase in revenue. This will be in absolute dollar values. By undertaking project A, let's say the company expects to have an increase of $500,000. Okay, 5 million. Sorry, 500,000. By undertaking project B, the company expects to have an increase of 5.5 million. And by undertaking project C, it goes for a $700,000 increase. Five zeros, right? Now this is the expected increase in the revenue. Okay, for that the company obviously needs to incur some cost, additional cost, or you can say additional investment to take the project, to undertake a project. For if the company wants to go for project A, it needs to shell out an investment of $400,000. For company B, let's keep it at somewhere around $420,000. For project C, let's say it's gonna be somewhere around $500,000, so it's gonna be $500,000. That's the additional cost or the investment which the company needs to make. Now notice over here, combining these three projects, the investment is 1.3 lakh. The company does not have a bandwidth to go for that level of investment. You can say the company can go for project C and project A, because here the project C seems to be promising in terms of absolute dollar values. Oh wait, let's just complete this whole table first of all. Net profit from the project in terms of dollar values is going to be simple. Expected increase in the revenue minus the additional cost. So sales minus the cost of the sales, that's going to be your increase in the revenue. Now looking over here, you might be tempted to take up the project C because that has a profitability of $200,000 compared to project B and project A, which are seriously lagging behind project C. In fact, project A has just half the profit of project C. But let's not jump to conclusion first and understand the ROI percent on this thing. Now, how is the return on investment going to be computed? Return on the investment is going to be your net profit divided by your investment amount or the additional cost. Over here, we'll label the net profit as B and additional cost or investment as A, and it's gonna be a mathematical computation now. That is 100,000 divided by $400,000. That's gonna be 25%, I believe so. Yeah, and the same formula applies for this things over here also. So here it's gonna be 31%, and for project C the return on investment is 40%. Now let's try to tweak the numbers a bit to see how the computation changes in terms of dollar value and percentage value. Over here, it's simple enough. Project C is a first preference, project B is a second preference because it gives both a good return on investment and in terms of absolute dollar values also. Now, let's say to undertake project C, the company will have to incur a cost of $550,000. Okay, so if you see, there's still project C has a profitability greater than project B in terms of dollar value, but the return on investment drops down from 40% to 27% just by an increase of a cost of $50,000, right? That is why the concept of ROI is very important to understand, guys. If you just go by the dollar values, absolute dollar values, you end up choosing a wrong project, which gives you a less profit percentage, less margin, less return on your investment compared to the other opportunities in hand. uh let's say over here we do some maths for this thing also, project A, and we decrease the cost just by $20,000. Just by decreasing the cost by $20,000, even though project A has the least profit in terms of dollar value, still it becomes the number one preference because the return on investment jumps to 32% compared to the B 31% and project C, which is now worst at 27%. So I hope with this you understand the company's perspective of how they're going to select the projects based on the return on investment. They're not concerned with just the profitability figures. That's the next point for them. The first point is what is the project going to be generating in terms of the return on investment. And mark this thing, all the companies have an internal predefined set of a return on their investment. Let's say if your project generates 5% return on investment and the government bonds are generating giving a risk-free return of 7%. In that case, companies won't even consider your project. They'll directly put the funds which they can allocate to your project in the government bond because those are risk-free. It returns risk-free investment which are guaranteed to generate a 7% return compared to your project which is only generating a 5% in terms of financial policies. So that was all with regard to why is the what is the importance of ROI, return on investment. Now we'll mark over your preferred projects in terms of their orders. Project A becomes number 1, project B becomes number 2, and project C becomes number 3. I'm sharing this template with you guys, this whole Excel sheet with you guys, and you can play around with the numbers and go and do some of more of your research to get a good understanding on the return of investment concept. Next comes the point is that why is it important for project managers to know the concept of ROI. So till now, whatever project this return on investment competition we've done, we had done it with the point of a company's point of view. How does companies use the projects, use the ROI to evaluate which project to choose? What is the point of understanding the return on investment for a project manager? Now, because as a project manager, you understand how the companies compute the various opportunities, how the companies compute the various projects return on investment, and then choose the project. Before submitting your figures to the company, you yourself can do a certain analysis and certain cost benefit comparison in the same style and figure out what unnecessary cost you can eliminate. Figure out what small increase in the cost, what small reduction in the cost can generate an increase in the revenue, can do a cost saving. As you had seen, when we just reduced the cost by 20,000 for project A, suddenly it became the most preferential project from being number 3 to being on number 1. So that's why it's important for you as a project manager to know what's the importance of those small cost saving also going to have on your project for being chosen in the long term also for proving as a profitable project. So that was all guys with regard to the return on investment. I hope you get the good point about understanding what is the return on investment and how to do the various computation. Make sure you do have a thorough understanding of this. This is going to be a useful project not only in terms of your professional life but also in terms of personal life. How it can be useful in your personal life is that when you have certain investment opportunities, when you have an idle fund lying around with you and you intend to invest it, you can use the same return on investment concept. For example, a friend of yours who is opening a startup is interested in taking a loan from you, whereas on the other hand, you have a risk-free return from the government for 7%. Now that's how you determine which investment is a better one. Is your friend startup going to be generating that return sufficient in the future? Or is it better to put the funds in the government backed risk free securities that are going to give you a safe and secure return on your investment as well as a principal? Okay, so I hope with this we have a good understanding of cash flow as well as return on investment. In the next session, we're going to see one more important concept, which is going to be capex versus opex, that is capital expenditure versus operating expenditure. Now we're going to cover one important aspect which you as a project manager should always be aware of, that is capital expenditure versus operating expenditure. Before we go in depth of how these two are important for you as a project manager, how you plan for your various expenses based on understanding of the capital expenditure and the operating expenditure, let's look at what is precisely meant by capital expenditure, what is precisely meant by operating expenditure. First, let's understand the term capital expenditure. The capital expenditure is that expenditure which results in purchase of a new fixed asset, procurement of a new fixed asset. Now that can be anything. It can be a new factory, land, building, machinery, anything which involves a huge investment on the part of the company of resources. It can also be any expenditure which is carried out by way of repair, which does either of the three things to that asset which is being repaired. It either makes it bigger, better, or longer. Now by these three analogy, we mean that is it making the asset bigger in size, thereby increasing its production facility, enhancing its features and such stuff? Then yes, it is a capital expenditure. Is it making it better? Suppose by incurring this expenditure, let's say of about $100,000, your factory is now going to be able to produce 1,000 units extra per hour based on the previous output. So that is making the asset better in efficiency. So that is a capital expenditure. Is it making the asset longer? That is it extending the useful life of the asset by incurring that expenditure? If yes, then it is a capital expenditure. If the asset does not result in if the expense, which is kind of a repair, does not result in the asset becoming a bigger, better, or a longer version of its existing version, then it's not a capital expenditure. It is just an operating expenditure. Also, if the expense results in procurement or purchase of a new asset, yes, it is a capital expenditure. So that is a criteria for understanding an expense, whether an expense is a capital expenditure or not. Okay. The other expenditure is the operating expenditure. Now, the expenditure which is incurred to ensure the day-to-day operations are carried out smoothly are known as operating expenditure. To put it in other words, any expenditure which is not a capital expenditure can be termed as an operating expenditure. Now, that can be your purchase of the goods from the creditors on a day-to-day basis, paying of the factory rent, utilities, repairs and maintenance of the existing machinery to ensure smooth functionality, but it does not make the asset any bigger, any better, any longer. It just keeps on the existing machinery, existing asset functions smoothly. That's it. So that is an operating expenditure. So with this, I hope you have an understanding of what is meant by capital expenditure and what is meant by operating expenditure. Capital expenditure involves a huge outflow of cash at certain point of times, right? Understand this thing importantly. We look at another important concept based on this understanding: what is buying versus leasing. Now, whenever you buy a new asset, that is a capital expenditure. Whenever you lease an asset, you lease a machinery, equipment, and certain on which you just need to pay a monthly rent or monthly lease fees, that is an operating expenditure. So buying versus leasing is basically your capex versus opex. If you're wondering what's the importance of this thing in a project manager, as a project manager, hold on to your seats. We're going to jump into depth of it right now. Now let's say you need to purchase a big machinery to successfully complete your existing project in hand. For procuring that big machinery, obviously it's going to involve a huge outflow of cash. Might be the machinery cost around $1 million, another additional 10-20,000 for transportation, installation, and stuff like that. And there is another company who is financing the same machineries for a year-to-year basis based on a lease fee of say $20,000, $30,000 a month. Now, which is a better option for you as a project manager to ask your company to allocate to you? Is it buying a new machinery for you or is it leasing the new machinery for you? We'll understand this thing with the help of an example over here, which will help us understanding it in a better way. Now let's say we're going to do an analysis of capex versus opex. Okay, that is buying versus leasing. Okay, yeah. So here we're going to list out the line items. Here we say the company incurs an expense, a capex expense, and here we say the company incurs an opex expense. That is, they buy the machinery over here. What is the scenario if we buy it? And if we lease it, what is the scenario over here? Right? So, cost of the asset, it's $1 million, right? We'll continue with the same example which we had just used for the theory part. That will enable us for easy understanding. $1 million for the machinery. Oh, sorry, that meant to 10 million. That's it, $1 million. Cost of the asset for an OPEX is going to be zero, $0, right? Because you're not buying the machinery, you're just going to lease it out. Now, cost of transporting the asset is supposedly another $10,000. It's a heavy machinery, gonna get it from the factory to the site. Let's say in case of lease also, the lessor is not that much lenient with the money, so he asks you to bear the expense if you want the asset delivered to your premises. and you need to do that because it's a heavy machinery which is required for the project. Over here, you also incur in $10,000 of expense for getting the machine to premises. Annual lease at the rate of, let's say, $20,000 a month, dollars per month. So it's going to be $20,000 multiplied by 12. That's going to be $240,000. And let's say a security deposit refundable, which is refundable security deposit. It's supposed to be, let's say, around another $100,000. Okay. Over here, the sale value. Okay, wait. We'll put the sale value of the machinery over here of the asset at the end of 3 years. Might be we charge a depreciation of somewhere around $150,000 a year. So that's going to be $450,000 for 3 years on a straight line basis. We're taking a 15% depreciation. So that leaves the asset with a residual value of, uh, let's say that's going to be equal to $1,000,000 minus, it's going to be depreciation of $450,000. So that leaves the machine with a value of, at the end of useful life, of $550,000, which is going to be realized. So here we're going to understand this thing, that this is the outflow of the amounts. Okay, you have to incur these amounts to get the machine delivered to your premises. So looking at the scenario over here, if we take it for a first year of total annual cash outflow for first year, for first year we're going to have cost of the asset to be incurred if we buy the asset and cost of transporting the asset. We don't consider the sale value as of now because that's going to be realized at the end of the third year, and we're just considering the factors for the end of the first year. Okay, that's why we have ignored this figure for the time being. Now over here we do the same thing. We have to transport the asset to our premises. We're going to pay an annual lease of $240,000, and we have to pay a refundable security deposit of $100,000. Even though this is refundable to us at the end of the third year or fifth year, whenever you're going to use complete using the asset, it's still an outflow of cash for the first year, so we're recording it as an outflow. So if you see the difference over here, that's huge, right? $1,000,000 and 10,000 versus $350,000 just to lease the asset. If you are working as a project manager and you have this dilemma whether to buy the machine itself or to use the lease facility if it's available, this is the computation you need to refer to understand what amount of pressure will it put on your budget as a company, to understand which is the convenient way to use your resources the most efficiently without putting much more resource constraints on your own budget, and utilizing the machinery to the most efficient way, right? This is a simple computation on the reason of using a machinery by way of leasing rather than buying. Now let's see let's see what is the impact at the end of the third year. We supposingly we see what is the total outflow for 3 years. Okay, so here we're going to have the same outflow of cost of the asset plus cost of transporting the asset, and we're going to receive the value at the end of third year for $550,000, saying under the assumption that we're going to receive the entire value of the machinery. Okay, there's no reduction going to be there. Still we end up incurring an outflow of $460,000 versus over here, if we consider the cost of the asset for this one over here plus $720,000, that is $240,000 into 3. Just make compute this as 3. Okay, so here we're going to compute $10,000 plus $720,000, and we're going to ignore the security deposit for the time being because we paid at the first year, we receive it back at the end of the third year, so that effect nullifies. So the total outflow which we incur is $730,000. So now you understand that your computations are changing up. Now if you look at the long-term scenario, as a project manager you need to take up the machinery on a capital basis, like you need to buy the machine. That's going to be realizing you much more, that's going to reduce your outflow over a period of 3 years rather than the leasing of the machinery, right? So that is how you interpret the capex versus opex figures. Okay, buying versus leasing facility for a new asset. And with this we complete the most important analysis of buying versus leases, capital expenditure versus operating expenditure. There's no standard definition that you need to use to buy an asset or to lease an asset, anything. It's entirely upon you to take a rational call based on the understanding till what point of time you're going to use that machinery, till what point of time you're going to sell that machinery, and what is the resale value and stuff like that. Okay, that was all with regard to buying versus leases. Now we begin with section C on performance management. In this section, we're not going to go through any of the computations, examples, and such stuff like that, because performance management of a project is entirely in the hands of a project manager ideally. But based on this understanding of the various financial statements, the return on investment computations, capex versus opex, cash flow, you are sufficiently equipped to use those tools to enhance your project, to measure the performance of your project, and also take the corrective steps to increase its performance. I'm going to share a few tips with you on how you can and you should do recommended to do those steps to keep a track of your project's performance over a period of time, also taking necessary actions in as and how the project progresses. But that list is not exhaustive. It's just a few steps on how you can manage or you can enhance the performance of your project. So let us begin with this concept of performance management. Now, it's recommended to conduct the following activities on a recurring basis for effective performance management of the project. Okay, it is recommended you conduct these activities at least if for your project on a month by month, at least recurring on a month by month, preferable to do a weekly, but that will be too chaotic. So the ideal timeline will be a month on month performance based evaluation, right? Analyze the detailed P&L statement on a monthly basis. Now that you're aware of how to study the P&L statement on a detailed basis, request your finance department every month on month basis to send the P&L statement for related to your project, where you can understand what are the revenue, how is the revenue trend going on, is it increasing, is it decreasing, is it stagnant, is the cost of expenses or the cost of revenue becoming high, that is the cost of undertaking the activities to generate the revenue, is it increasing, is it decreasing, is it stagnant, and stuff like that, based on which you'll also be able to pinpoint if the additional or you can say the expenses which are not relevant to your project, are they increasing in volume or are they reducing or are they same across from the beginning of the project. And if the other expenses which are not relevant to your project, if they are increasing over the time, that's a red flag. You can point out to your managers, to your leaders, and say that this might impact your conclusion about my existing project, because the common expenses being allocated are increasing on my project day on day basis, right? So that is why it's important for you to analyze the detailed P&L statement and take corrective actions with regard to whatever red flags comes in. Can be increase in cost, drop in revenues, increase in other expenses being allocated, and stuff like that. Keep a track of the ROI for your projects. Now, if you are a manager who has multiple projects going on, it's very important for you to keep a track of your return on investment on every project. That's simple enough. What costs are being incurred, expected to be incurred? What is the profit they expected to be increased, expected to be receivable from the incurrence of those expenses, and computing the ROI, return on investment, for every individual projects. Now, we had studied this entire concept of computation of ROI in the Excel sheet, if I hope you remember that. And we had understood how a small change in the cost can drastically change the decision of the whether to drop the project, continue the project, whether it can change the entire preferential order for the project. That's why it's important for you to have a clear understanding of your various projects ROI. So supposedly in the future, if the management tells you, hey, you got 5 projects in hand, you can only afford to finance 3 of your projects, you choose which 2 to drop and which 3 to continue. You should have a clear understanding of your functionalities, at which projects are performing up to the optimal level, not just in terms of dollar value. That will be highly misleading, and the ROI computation comes really handy at those point of time. Next is comparatively study the P&L and ROI of your projects to keep a track of how your project is performing. Not only just the dollar value or the net profit computation is essential, that's just a piece of the puzzle. You also need to supplement it with the ROI computation, because absolute dollar profits can be misleading sometimes, but ROI accompanied with the absolute dollar values gives you 100% correct result for most of the time. Okay, if you have an increase in profit but your return on investment is decreasing, that means the cost which you are incurring to increase the profit is much more high than the increase in the profit itself, which is offsetting, which is why the return on investment is going down for that particular project. If the dollar value of the project, if the net profit of the project are increasing along with the increase in return on investment, that's a super project to carry on. And those are the analysis which you can only derive when you have a thorough understanding of the P&L and an ROI, and you're tracking both of them simultaneously, starting both of them simultaneously for every of your existing projects. Understand the requirement of the capital asset and plan for its leasing accordingly. Now, based on the previous lecture itself, previous session, where we understood the entire capex versus opex scenario, buying versus leasing. If your project requires a substantial amount to be invested in a fixed asset, and you need to determine what is till what period of time you want that asset to complete your project, and based on that, you make up the analysis. Is it better to buy the asset with the resources, or is it better to lease the asset? And accordingly, time is the biggest factor over there. As you had seen, if you recall previously, when we had computed the 1 year calculations, in that point of time, we thought it's better to lease the asset. When we extended the computation to 3 years, our decision went in the favor of buying the asset. So that's all tricky parts which are taken care by the you need to take care as a project manager to enhance the efficiency of your project, to make smart effective decisions. And lastly, keep a track of the expenses and eliminate the unnecessary expenses. This is important not only for the projects, for your personal life also, but we'll stick to the project management aspect because this is not a financial literacy course. So keeping a track of every expense which are incurred for your project and removing the unnecessary expenses which don't really need, which whose presence are more taking the project down rather than increasing, rather than providing any additional values. And again, I'll re-emphasize the fact that even small changes in the cost can cause a drastic change in your return on investment. If you have any doubt, see the entire slide on our ROI computation, how we worked on the Excel with the different numbers, with the very different permutation combination. And just by changing a $20,000 of a cost in a project of $500,000, the project preferential order changed from number 3 to number 1. The percentage return on investment changed from 25 to 32, I believe so. That's right. These are the these are some of the strategic key points which you need to follow irrespective of the fact whether you're doing a financial project, non-financial project, any project. And it's important to understand these aspects of the project management, these aspects of the related to the financial components of project management. It makes you, these are the tools which will give you to manage your project to the greatest efficiency, as well as defend it when the times are high, when the times are going against you, when you are in a negative situation in front of a manager, right? So I hope you had a thorough understanding of the performance management tools, and now you're good to go in the financial world out on your own to show your project being managed very well. Well, I hope you got the point. That's it. Okay. I'll see you in the next session where we start with the project evaluation techniques. Now we begin with a section D, that is project evaluation. So first of all, what is a project evaluation? Let's understand that. Till now, we have seen performance management, cash flow, return on investment, concepts of financial statements, and stuff like that. But when we this all is tied up to the project, okay, which you are taking in hand. So the most important concept: how do you evaluate your project? How do you evaluate what's going on in the project? What point of time do you evaluate, and stuff like that. All that questions will be answered in this section that is based on entirely on project evaluation. Okay, so coming back to the point, what is a project evaluation? To put in a layman's term, project evaluation is a rigorous examination of your project, of the project, on the various metrics which are financial as well as non-financial, to evaluate whether it is feasible to accept the project, and if the project evaluation is done for an existing or an ongoing project, to evaluate whether it's feasible to continue the project or divert the resources to some other projects. Okay, evaluation can be done in terms of factors like technical performance of the project, schedule to complete the project, additional cost to be incurred to complete the project, better opportunity available to, rather than deploy the funds in the existing project to new projects, or just invest it in some good securities and generate a better return compared to the existing project. In the impact the project can have on the brand value of the company on its completion, or is it better to drop off because it is not performing up to that level where the company had expected it? What's the opportunity cost to complete the project, opportunity cost to take up the project, and stuff like that. So I hope you get the idea that project evaluation can be done in tons of financial as well as non-financial metrics. Okay, but we are going to restrict ourselves to the financial aspect of the project evaluation. Okay, because we are mainly concerned on how to use the financial management aspects to the for a better project management. Second question comes is that what is the need for project evaluation? We understood the fact that yes, project evaluation means a rigorous examination of the project in terms of financial, non-financial metrics, and so on. But next important point is, what is the need for the project evaluation? Here we have two perspectives. One is from the organization perspective, what's the need for the project evaluation? One is from the project manager perspective, what's the need of the project evaluation? From the organization perspective, organizations are always facing a resource constraint and they cannot accept every project which they come across. Even though if the project gives a good return, a positive return compared to their expected factors, they still always have to make a decision, choose between one or the other. And that's where the project evaluation comes in. So return on investment, which we had just studied some couple of minute sessions back, is just one aspect of project evaluation. That is an important factor, but that's just one aspect. There are also different methods which organization deploys based on the situation and based on their requirements from the project to evaluate whether they should continue the project, or if it's a new project, to evaluate whether they should accept the project and carry on. From the project manager perspective, now the project managers, they are accountable for the success of the entire project. So before accepting a project, it is project manager responsibility to make sure he knows all the important aspects of the project on which he is going to be evaluated, and he is ready to, or he can say he is ready with his analysis beforehand to explain to the management why he thinks the project might not be a good fit, what deviations need to be made compared to the current analysis part, and so on, just to make sure he is in a safe position and it's not coming under, he and his team do not come under undue pressures later stage of times. Okay, so those are the two aspects why a project evaluation is important. Now, third question comes in mind is that when is the project evaluation done? So project evaluation is a continuous ongoing activity. It's done prior to the commencement of the project. To accept the project, what there are various feasibility done, whether to accept the project or not to accept the project. Here the main question to be answered is whether we should start the project or drop the project before it's, or reject the project. That's the correct term. Next comes is for an ongoing stage. Now, when the project is ongoing, obviously it goes for some projects do extend beyond months, some go beyond years. So it is necessary to evaluate to keep a track of the progress on an ongoing basis to determine at what point of time they should drop the project, they should put a stop to the project and say, okay, whatever cost has been incurred till now is a sunk cost. We do not need to incur more project cost, more cost for this project. We have better opportunities online and let's focus on that aspect. The lastly is post completion. Once a project is completed, there still remains a part to evaluate. Did the project give the results as expected? Did the project meet its expected standards or not? Did the project no fulfill its test, which on the basis of which the company took the project? Did it enhance the brand value to that extent which was expected? Did it generate the profits to that numbers which the profit numbers were hit by the project, and so on? These questions are answered at the post completion, after the project is completed. Was the project manager efficient in his completion of the project? What could have been done better? Where did he had a slack? What was the reason for the increase in the cost? What were the reasons for the efficiency of the project, and so on? Now, note over here, the contention of the management might not be just to take out flaws from the project manager. It can also be to find out what are the best practices applied by the project manager and apply them across all of the projects for the company. That can be a good resource or good value addition to the company for its other projects also. So these are the aspects with regard to project management, project evaluation. What's the need? What is project evaluation need for it? When is it done? And so on. I hope with this you have a thorough understanding of the theoretical part of project evaluation. In the next session, we're going to start with the actual uh, techniques of evaluation of the project. But before that, let's quickly go ahead and look at what are the different methods of project evaluation which you're going to study in this session. It's going to be net present value, where you complete the future value and present value of the money of the entire inflow and outflow of the cost in the project. Don't just bother for the timing with the names of the project techniques. It's just for giving you a heads up. We're going to cover each and every technique in a detailed lessons going forward in a detailed session, along with an example for every of the concept, and examples will be done in an Excel sheet in front of you guys. So when you have an understanding of how the entire process is going from point A to B, from B to C, and you can practice on your own also. Next will be your internal rate of return, that is IRR. Third is the payback period of the project. This is the simplest one to calculate, trust me. Fourth is the discounted cash flow analysis. Fifth is the opportunity cost analysis. And lastly, we have earned value analysis. Now, because you have an entire list of the various projects going on, you might be concerned as a project manager, which method am I supposed to use? So the answer is there's no one size fit all. Yes, there's no one size fit all. Now, every project evaluation technique, it serves a different purpose, and therefore it is important to select the method according to the needs by which you are starting the project, or you can say according to the needs of your organization. Okay, every project serves a different method, every project serves a different requirement for a project manager, for the organization, and the project manager and the management of the company selects the method which provides them with the objective fulfillment which they are looking for. Let's say priority of the company is to recover the cost invested on a priority basis rather than looking at the long-term profitability. In that case, you use the payback period rather than the income analysis part, you can say, or the IRR method. That's why it's important to know what is the company's requirement. Is it the fastest recovery of the cash? Is it generating a great return on the long-term basis, and so on? Need not worry. We'll go about with each and every method in a detailed session in the next sessions. Till then, I hope you had a good understanding of all the concepts till now. If you have any doubts, at least go back and refer to all the slides and thoroughly study the examples. Understanding the numerical financial concept is much more important than the theoretical part, right? Once you have a good understanding of the numerical part, you will be definitely empowered with all the tools for making sure you manage your project to the most efficient way. Till then, I'll see you in the next session. Have a great time. Now we'll look at the different methods of project evaluation. This is just an introduction, or you can say a glimpse into what techniques we're going to study with the different project evaluations. And then we're going to go and study each and every method in depth along with a good example for it. So there are 6 different methods of project evaluation which you're going to study. The first is the net present value method. Over here, you try to determine what is the net present value expected to come out of if the project is undertaken. Okay. The next is internal rate of return, IRR. This is more of a trial and error mathematical method where you happen to determine the break-even point in terms of percentage of return. Whereas you try to determine that percentage of return where you have a break-even point, that is all your investment and your inflows equal up to zero, no profit or no loss situation. Next is a payback period method. In this method, we're trying to define how quickly can the project recover the entire cost invested in that. Next is a discounted cash flow analysis. This method is said to be an extension of the payback period method, but over here you try to discount the cash flow based on the future value of the cash flow and then determine what is the earliest point of time when you can have the actual recovery in terms of the present value of cash. Now, need not be concerned if you're not aware of the present value figures and future value computations. In the next session, first we're going to study the present value concept and then we're going to go in depth with all of these methods. The fifth method is the opportunity cost analysis. Now, this is not exactly a project evaluation method, but it's a good concept for you to be aware of how do you define the incremental cost, the opportunity lost when you take up the other project, and what is the incremental gain by taking up the opportunity or the existing project which you are carrying right now. And the last is earned value analysis. Now, the sixth method, earned value analysis, is not a method which you take into hand for deciding which project to take on. This method is applied once the project has started, once you have decided which project to pursue and you have started working on that project. Okay. Now, if you're going to start with the sixth method, obviously, I believe you will have a question in mind which project evaluation method is to be selected. Now, understand this thing that every project evaluation technique serves a different purpose, and therefore it is important to select the project evaluation method, or you can say the method for the evaluation according to the needs of the organization, according to the intention for taking up that particular project. Let's say if the company wants to recover the money on a earliest basis, that is a priority for the project to be selected, right? That's a criteria. In that case, you select the payback period method. However, if profit is the priority, profit percentage earned is the priority, then you go for the internal rate of return method. Okay. If positive cash flow at the end of the project completion is important, then you go for the net present value method. So you can understand that every project evaluation method has a different intention, a different purpose to be served, and you need to identify what is the intention of taking up the project, and then and then you have a proper judgment as to the method which you're selecting is a correct method or not. Okay. With this thing in mind, we'll go to the next session and start studying each and every method in detail. Now, before we begin with each and every individual method of project evaluation techniques, it's it's important for us to understand the concept of present value. What does the present value mean? Present value is the sum, or you can say the current value of sum of money or stream of cash flows at a specified rate of return which are supposed to be received in the future. Okay, so it means that uh, it is, to simply put in a layman's terms, it can be said that receiving $10,000 now is worth more than receiving the $10,000 5 years from now. Now, why does this happen? If you recollect the fact, we had an concept of inflation, right? Every year the inflation rates are going high and high and high. So it's obvious that the purchasing power of $10,000 today as on date will not be the same as of 5 years from now. If you can get a brand new 4K TV for $10,000 today, 5 years from now, it's highly possible that the cost of that same TV will be around 15,000. You can say 12 to 15,000 at least. It will be increased, but it won't go beyond 10,000. That's why it's important to know this thing. How do you compute what is the present value of my money which I'm going to receive in the future? Because if you understand the very fact, all the projects in that you're going to invest the money right up front, right? But they're going to take a good amount of time, might be 3 years, 5 years, 10 years down the line to give out a constant return. But that return which you expect to receive 10 years from now, which can be $10,000 a year, it's not going to be the same, it's not going to have the same purchasing power as a $10,000 today, right? So it's important to bring down the future 10,000 value to its present value, bring down the value. Always remember this thing, that when you're going to be trying to determine the present value of your future receipts, it's always going to be lower than what you're going to receive in the future. So let's say if you're going to receive $10,000 in the future from 5 years from now, its value as on today will definitely be less than 10,000, because it's going to appreciate to that amount to receive, to go to a level of $10,000. Okay, so that's why it's important to know the concept of present value to get a much more understanding, or you can say much, to make much more informed decision in any of your project selections. Let us see the formula for present value, or you can say how the computation of present value works. The formula is C1 divided by 1 plus R raised to the power of n. Now your PV is your present value. C1 is a future value of the cash to be received. Like say, you know that 5 years from now, the project is going to give you $10,000. So that's the future value of the cash to be received. The future value is 10,000. We're going to try to discount that and bring it down to current value. The R is a discount rate. Now this is basically the interest rate at which, or you can say the income rate, discounted rate, which you got expect to receive over the number of years. So every company has their own hurdle rates, which is the discount rate over here. We're going to talk about this in detail as and how we go about. But understand this thing, if a company expects that its resources generate a 7% risk-free return, so that is a discount rate over here. What is the amount of interest, or you can say the interest risk-free investment return the company expects to generate? It can also be a higher one. It's not necessary that always the company should have a risk-free one. If the company states that always all the investments done by them till date have been generating a return of 15 to 20%, so even that can be discount rate. Nothing is bounded over here. It's all supposed to be defined. So as a project manager, it's really important for you to determine what is a company's discount rate at first. Then only you can make an informed decision for arriving at the present value concept. Okay. Next is the N. That is 1 plus R raised to the power of N. That is a number of periods. Now this number of periods can be a yearly, a 6 monthly, a quarterly thing, anything. Okay. With this thing in mind, let us see a quick example. Ideally, let us prepare a quick example to understand the concept of present value. So we have Excel ready over here. Now, let's say we need to compute the present value of $100,000 expected to be received after 3 years, discounted at 10%. Okay, so I'll just note it down over here. Compute the present value of $100,000 expected to be received after 3 years, discounted at 10%. Fine. Now, before you go ahead in depth of this, let's try to interpret the formula which we had used over here. That is the cash future value of the cash receipts divided by the 1 plus rate of return or discount rate raised to the power of n. So over here, if we had to replace C1 will be $100,000. That is the future present value of the future cash flow to be received. The discount rate will be 10%, and the period will be annual periods. That is going to be 3 years. So replacing this in the formula, we have $100,000 divided by 1 plus 0.1 raised to the power of 3. Okay, right. Now, if we were supposed to do 1 plus 1, we'll just try to understand it mathematically. We also have an entire table, ready table available with us, but I'll show you how to read the table. But to read the table, it's important for you to know how the formula, multiplications, and factors are working up here. So, coming back to our example, we can say it's 1 plus 1.1 multiplied by 1.1 multiplied by 1.1. That's 1.1 raised to the power of 3, right? Now, if I was supposed to actually see the amount, it's going to be 1.331. So, putting the figures over here, it's going to be $100,000 divided by 1.331 equal to 100,000 divided by 1.331. The present value is supposed to be $75,131.48. So, to put it in a layman terms, $75,131 today will be valued at $100,000 3 years from now, discounted at 10% rate. So that is how you compute the present value of the future cash flows or the future amount of money to be received. Now, I just put the equal to sign so you understand how the steps are derived. Now we did this thing with the entirely our own computation, right? We used the formula, actually multiplied 1.1 into 1.1 into 1.1. Suppose you had a period of, say, something around 15 years. At that point of time, it will be really chaotic to multiply and determine these values, right? So that's why we already have a present value table along with us. Now this table is a standardized one. Over here you have two categories, present value and future value. We're going to focus our efforts, or you can say we're going to focus on this part of the table, present value. Not to leave you guys in suspense, I'll just give a short insight what is present value and what is future value. Present value we already covered. We're trying to determine the future value of the amount which is supposed to be received in future as on today. Like in this example over here, the $100,000 that we're going to receive 3 years from now, today its present value is $75,131. In the same way, the present future value works in a reverse order. So you know the fact that you have $75,131 in hand today. What will be its future value based on a 10% discount rate, 10% earning rate in the next 3 years? It goes the reverse way. And you also can say that the future value of $75,131 today will be $100,000 3 years from now, discounted at a 10% rate. That is an earning of 10% income on this $75,131. So it's a reverse order. On one case, you know the future value and you try to bring it down to its present value. In other case, you know the present value of the money and you're trying to determine what will be its value, appreciated value in the future, because money is always appreciating unless the economy is facing a deflation. Like you can say the value of money is going down. Okay, so getting back to a table, how do you study the table over here? So remember this thing, we had a discount rate of 10%, that is a hurdle rate of interest is 10%. So we're going to look at over here 10%. Now 10% for 3 years. So you have this over here, number of year period 0.9091, 0.8246 and 0.7513. We need the amount, you can say we need the value at the end of third year. So that is the number over here, 7513. So what this means is that $1 today discounted at 10%, after 3 years its value is going to be 0.7513. Now if we replace this 0.7513 in our equation over here, multiply this value by $100,000, you have $75,130 over here. The difference is due to the rounding of the amount, but it's approximately the same amount, right? 75,131 and 75,130. That is a difference of $1.48 only. So this is how you study the present value tables. Okay, I just mentioned over here present value using present value table. I'll give a short note. Referring 10% column, that is this amount over here, referring the 10% column, discount column for the third year, that's gonna be the present value is 0.7513. Therefore the present value of $100,000 is $75,130. I hope you got the gist, or you got a brief summary of how do you compute the present value, what's it used, why is it required in your project evaluation techniques, and now we're going to study each and every method in depth. But again, I request you guys to go through this one more time to understand thoroughly the concept of present value. Without it, most of the future, or you can say most of the evaluation techniques which you're going to study are not going to be helpful much to you then. With this thing in mind, we complete the concept of present value and we move on now actually to studying the 6 different methods of project evaluation. Now we begin with our project evaluation techniques, and we begin with the first method, that is net present value. So let us understand what is the concept of net present value first of all, before we jump into the depth of all the jingles and understanding evaluation of the results and so on. So the net present value is the present value of the project's expected future cash flow minus the project's initial cash outflow. So you can say that the net present value is the final result of the project's future expected cash flow minus its initial cash outflow. Now projects, or you can say the present value of the expected future cash flow. This is calculated by using the discount rate, that is the company's required rate of return. So if you remember from the concept of present value, how we had used the discount rate to determine the present value of the money which is supposed to be received in future. That's exactly the same concept which is going to apply over here. That's why it's important for you to understand what is the concept of present value of money. Okay, coming back to the net present value, the present value of the expected future cash flow, the one which we're going to interpret, which are going to come in the future, is discounted using the company's required rate of return. So every company has their own benchmark, right? Before evaluating any project, obviously there's always a risk-free investment option available for any entity, any person. But because businesses are uncertain and take a risk, they expect the projects to reward them with a higher rate of return, so either higher income. So every company has defined their own required rate of return, which is based on multiple factors which they take into account and arrive at a final computed figure. Over here, we need to understand that this required rate of return is going to serve as a discount rate for you. That is, the company is going to evaluate the future value or present value of money using their own required rate of return as a discount rate when you compute the net present value. Now, this required rate of return is either the return the organization could expect to receive in the market from an investment of a comparable risk. Let's say your project has a 50-50 chances of failure and a success, and also there is an alternative in the market which has a similar 50-50 chance of pass or failure, of success or unsuccessful. If that project is giving the rate or required rate of return, or you can say that project is generating an income of 15%, then obviously you can use that same benchmark to determine the discount rate for your project. Or else, that can be the minimum rate of return that the project must earn in order to justify investment of the resources. Many times it happens that the companies themselves have developed an internal required rate of return, and they have this thing that if you want your project to be qualified, if you want the company to fund your project, you need to prove them that your project is generating at least required rate of return expected by the company. So as a project manager, you really don't need to go into the depth of this entire stuff. You can have this numbers, required rate of returns, everything from the financial teams, but it's good to know how these numbers are arrived at, so you can tweak your projects accordingly to reach that level. You can justify your projects accordingly to reach to that level and get the funding from the company. Now, the required rate of return is also called as a discount rate, hurdle rate, opportunity cost of capital, and such other names. Generally, company's cost of capital is used as a discount rate. Now, the company's cost of capital is entirely a big topic in itself, okay? But to give you a glimpse of that, what happens is that companies raise their funding by various sources. They can be loans, bonds, debt, share capital, preference capital, and such a thing. And every capital raised, every financing arrangement has their own required, or we can say has their own payout things. For example, bonds have a fixed interest payment year on year and upon maturity. Debt has similarly a fixed interest rate. So these are the required cost of capital the company needs to pay. Equity shareholders of the company, depending on the risk appetite or this risk level of the company, have either a higher expected return or a lower expected return. Preference shareholders have a preference share dividend expected returns, and sometimes if it's going to be converted to equity and all, there's a different game. But when all this interest factors are taken into account, the company arrives at one single cost of capital. That is a weighted average cost of capital, which is proportional. The weights are depending on the amount of funding raised from various sources, and that final figure is known as the cost of capital for the company. Now, again, this is entirely a topic of records. You really don't need to understand this in depth. You will be given your cost of capital or the discount rate and just need to use those amount into your computation to arrive at the final net present value. But as I said, a bit more knowledge is not harmful, and it goes a long way to help you to understand and stand out as a project manager. Okay, so coming back to the question in hand, now I believe you understood what is the concept of net present value theoretically. We're going to solve this sum practically also, but theoretically, I hope your concepts are clear. Now, how do you evaluate the net present value when you have the results in front of you? How do you evaluate that? So, when a project has a positive net present value, that is all the present value of the future cash inflows minus the cash outflow, still generates a positive number. That means the project will be profitable because it will earn more than it will cost the company. So it will increase the wealth of the shareholders ultimately, and the company should accept the project. If the project has a negative present value, that is, their present value of the cash inflow is less than the total of the cash outflows, it is an unprofitable project for the company, because this will cost the company more than it will earn for the company. Hence, it's better to reject it. And lastly, if the project has a zero net present value, that is, here the project is neither profitable nor in a loss state. If you're going to invest, supposedly say $100,000 in the project, the present value of all the cash inflows which it's going to generate is exactly $100,000 only. And this is not the acceptance of this project or the rejection of this project is neither going to impact the shareholders' wealth in any case. It will neither increase the shareholders' wealth nor the profits of the company, neither it will decrease the profit of the company or the shareholders' wealth ultimate. So in a way, the company is indifferent financially, saying from the financial standpoint, if the company accepts the project with a zero present value. So this was all with regard to the concept of present value. Now we're going to look at an example which we're going to create and solve together. So that will give us a better understanding of the net present value. So let's go to our Excel sheet and start preparing the example. Okay, so let us say ABC company needs to decide whether to accept a project based on NPV. The company's discount rate is 6%. The relative cash flow details are as under. You have your cash outflow, or you can also say it as an investment for the project in year one itself for let's say $501,000. Oops. You have the cash inflow over 8 years as follow. We'll try to take a different approach. We'll not just say that the project is going to earn a constant cash flow. We'll say the cash flow amounts are going to change across some years. So for the year 1 to 4, let's say the cash inflow will be $77,000 for year 1 to 4. For year 5 to 7, we'll put it as $85,000. And lastly, in the year 8, the last year, you have a high increase in the cash flow, and we'll bring it to 1,01,800 something. Yeah, just random figures right now. Okay, now we're going to compute the project's net present value. So first of all, it's important to know what is the company's discount rate. The discount rate is 6%, which is the company's required rate of return. So we're going to need a couple of columns over here. Let's say the period. Over here we have the net cash flow. We're going to put the 6% present value factor from the present value table. I'll just mention over here derived from present value table. If you remember, we had seen the present value table the previous session where we are understanding the concept of present value. That whole table, I'm going to attach a table to you guys for your reference. You can use that table to understand, or you can say for easy computations. And finally, you get the discounted cash flow amount. Okay, discount cash flow at 6%. At 6%. Whew. So here you have 1, here 1, 2, 3, 4, 5, 6, 7, 8. Here 2, here 3, here 4, here 5, here 6, here 7, and finally here 8. Net cash flows. In the initial year, the company is going to have a net cash flow of $501,000. That's a negative figure over here. We'll just set it to the numbers over here. Okay, this needs to be in the number format. In the next year, from year 1 to year 4, the company is going to have the first cash flow starts from year 2. Year 1, obviously there's a cash outflow and it does not start earning from year 1. From next year onwards, it's going to have a net cash inflow of $77,000 up till year 4, $85,000 from year 5 to year 7, and lastly it's $101,800. Now we'll pick up these values from the present value table. So you have the present value table over here. Okay, here we have the future value. We're going to look for the present value computations. And here we have the present value interest factors for $1 discounted at X per K percent for N periods, so and so. Okay, 6% over here we have it. For the first year, no. Are we going to look at that? Oh, 1 second, guys. I just sure need to rectify something. Okay, this is what I was thinking. It's wrong. Initial investment is going to be coming over here, and this is going to be $77,000. And this remains the same from year 1 to year 4 because this inflow is going to arrive to us at the end of the year 1, and obviously $1 at Jan 1st will not have the same purchasing power as on December 31st. So here we're going to go with the same previous assumption that the inflow starts from year 1. So that will help us to reconcile this with the present value table over here, or else it might be just confusing that why did we start from year 2 and not from year 1. Okay, so 6% present value factor for the initial investment, it's going to be entirely the same. $1 is the value is $1 on the same day itself, but $1 at 6% at the end of year 1, it's 0.9434. 0.9434. I think I need to increase the zeros decimal, right? For the next year, it's going to be 8,900. So it's 0.8900. Okay, that's four decimals over here. For the third year, it's going to be 0.8396. 0.8396. For the fourth year, it's going to be 0.7921. 0.7921. For the fifth year, it's going to be 0.7473. 0.7473. For the sixth year, the value of $1 is going to be 0.7050. 0.7050. Seventh year, it's going to be 6651. 0.6651. 0.6274 for the last year. 0.6274 for the last year. Perfect. Now it's simple. We're just going to multiply the net cash flow with the present value factor, and that goes for the same. The same formula applies for everyone. And you have the dollar values over here, right? So let's round this off to 0 over here. Okay, perfect. Now if we put this in accounting format, we'll have the currency figure over here, right? So now the net present value is your sum of the total outflow minus total inflows present value minus the cash outflow. If you remember from the definition, net present value is the present value of the projected future cash inflow. This is the amount of the projected future cash inflow, that is 5,10,661 against an investment of 5,01,501,000. So here you have a net present value, a positive net present value of $9,661. Therefore, the project should be accepted. I just mentioned note here, since the net present value is greater than zero, the project is profitable, hence should be accepted. So this is how you interpret the entire net present value of the project over here. Now, let us try to figure out what would have happened if you had taken the discount rate at 8%, just so, to get one more tweak in the whole scenario. We'll use the same formulas over here. The only difference is going to be in terms of we'll write here, assume that the discount rate is, we'll just double it up, 12%. So we have this over here at 12%, discounted cash flow at 12%. That's all. These numbers are going to change, rest all things remain the same. So if you see this thing over here, we have the 12% discount rate over here, and the initial investment is always going to be remain the one, because you're going to invest the amount today itself. If it's going to be invested in the future, then obviously those amounts need to be brought to the present value, but we'll avoid that high-end competition as of now. We'll just stick to the basics right now. Let's change the present value factors over here to 12% from 6%. So for the first year, it's going to be 0.8929. 0.8929. For the next year, it's going to be 0.7972. 0.7972. Notice this thing, because it's a formula based thing, then the moment you enter the present value, revised present value over here, all the competition take care of itself. For the third year, it's going to be 0.7118. 0.7118. For the fourth year, it's going to be 0.6355. 0.6355. Fifth year, it's going to be 5674. 74. Sixth year, it's going to be 5066. 0.5066. Seventh, it's going to be 4523. 0.4523. Lastly, eighth year, it's going to be 0.4039. 4039. Oh, the results change drastically. Now, if the company accepts this project, it will end up in the negative net present value of $96,268. That means against an investment of $501,000, the company is going to have a loss of $96,268. So over here, the conclusion is that since NPV is less than zero, the project is not supposed to be taken ahead, to be taken up. Okay. I did not plan for this discount of 12%. I just thought we'll just see how the results come up when you use a different discount rates. So that was all, guys, with regard to the net present value. And I hope this was sufficient and clear enough for you guys to interpret and make your own net present value computations. I'll see you in the next session. We're going to start with the another method of project evaluation. Now we come to the next method of project evaluation, that is internal rate of return. So internal rate of return, what is this internal rate of return method? So in the internal rate of return method, or you can say the internal rate of return is that interest rate at which the net present value of all the cash flows, both positive and negative from a project or investment, equals to zero. I understand the definition was on a quite higher level. Let's try to simplify it down. So in the net present value, you try to arrive at a number, okay, a dollar value, and then you evaluate, is the dollar value greater than zero or less than zero? Okay, that dollar value was arrived at using the discount rate, presenting it to the current value, and such stuff like that. In the internal rate of return, you take a different approach, although your intentions are the same to determine whether the project is acceptable or not. But over here, you try to figure out that discount rate or that rate of return where which makes your net present value equal to zero. That means you neither in a positive state, neither in a negative state. And then based on that rate of return, you determine whether you should accept the project or not by comparing it with the existing company's required rate of return. So to simplify it down, okay, before that, this method has to be done by a mathematical trial and error basis. There's no such definition where you can just use one single rate and assume that to a discount rate and carry on computations. No. So what happens in this method is that you know what is your present cash outflow, you know what is the future cash inflows. Now, all the future cash inflows, you try to discount it by that factor through which the net present value, that is the sum of your initial outflow minus your future in present value of your future inflows becomes 0, and that becomes your that discount rate at which these amounts become 0, that amount becomes your internal rate of return. Okay, so internal rate of return, I know it sounds a bit complicated right now, but once we have done the example, trust me, it's going to be crystal clear. The internal rate of return is used to evaluate the attractiveness of a project or an investment, because here you try to determine that interest rate, or you can say that discount rate, that profit rate, which is going to break even, at which point the company breaks even the earliest, and then you compare that with the company's required rate of return. If that is greater than the company's required rate of return, it's great, go ahead. If the IRR is greater than required rate of return, the project is desirable. The reverse goes when the IRR is less than the required rate of return, project should be rejected. The IRR must be internal rate of return must be found by using mathematical trial and error to derive the appropriate rate. Understand the word, the appropriate rate. There's no fixed rate over here. You cannot arrive at one single rate. It's always going to be in closest range. Okay, it's very rare that the net present value will turn out to be 0, because sometimes you need to have a middle rate of return. Like, it cannot always be 16 or 70%. Sometimes it can be 16.67%, 16.25%, stuff like that, because of which you try to come closest to the $0 value. So let's look at an example for this thing, and then I'm pretty sure this is going to be crystal clear to you guys. So coming at an example for this, where's my example sheet? We'll name this as IR computation, internal rate of return. Okay, so let's find the internal rate of return for an investment having an initial cash outflow of let's say $212,000. Okay, then we have the cash out inflows during first, second, third, fourth year. First to fourth year as mentioned below, right? For the first year, it's supposed to be 65,000 approximately, $65,000. For the second year, it would be somewhere around let's say $96,000. 96,000. For the third year, we'll put it somewhere around $73,000. Fourth year, it's gonna be $55,500. Now, I already derived the net present value computation for these on various interest rates, and I've used the same formula, same template over here. Okay, so let us say, I mean, I do know the answers. I'm just trying to explain to you what the psychology was in approaching to the solution. First, we'll assume, so the first internal rate of return which you're going to try to determine is always going to be a random figure, an abstract number value. Okay, based on that you determine, okay, is it closer to 0, should I, or is it actually negative, should I increase my discount rate or should I reduce my discount rate? How does that work? We'll see in a couple of minutes. Assume that the R, or you can say the discount rate, is 10%. Okay, I'll just show you how the 10% discount rate works over here. We'll use the same template for timing. Just hold on a minute, guys. We're just done with the formatting ASAP, and we'll quickly jump to the solution. Okay, so the initial outflow is 212,000, right? So it's going to be 212,000, and now we're going to use the discount rate at 10%. Discount get cash flow at 10%. We just need this amount here, from the present value tables. Where is my present value here? Okay, for 10% for the first year, it's 0.9091. So this is going to be 0.9091. For the second year, it's 0.8264. So it's going to be 0.8264. Third year, it's going to be 7513, 0.7513. For the last year, it's fourth year, it's going to be 0.6830, 0.6830, right? So here you have the net present value coming up to present value. As you can see, this is far beyond zero. Okay, that means that the 10% hurdle rate which we have taken is very less. We need to increase our discount rate factor to reduce the discounted cash flow. The logic behind is that the higher your discount rate, the higher your expected rate of return, your present value of that future cash flow starts reducing. Okay, so $1 discounted, or you can say $1 discounted at 10% today will be something for first year will be 90 cents precisely. But the same thing, when $1 discounted at 15%, it becomes 0.896. So that's the logic. As in how, if you want to reduce your present value and bring it down to zero, you need to increase the discount rate. With the same logic, now at various discount rates, at a discount rate of 13%, we just try to evaluate the whole thing rather than just putting up abstract values, right? So now we'll take it at a discount rate of 13%. We'll use the same template in entirety over here and just change this amounts to 13% over here. I mean, if you observe this one thing, if you have the Excel templates with the formulas, it becomes quite easy to change the figures and quickly, guess the answers. And you, in fact, have the internal rate of returns templates of Excel available in Google. You can just Google it out and get the templates to solve. But mostly it's like finance stuff. I'll just try to give you a hands up on this thing. So it's better to use, but make sure with the operations of it. How does this work? I'll just get back. Okay. At 13% for the first year, the value is 8850. So it's 0.8850. For the next year, it's 0.7831. 0.7831. I hope you're following where I'm clicking the mouse and highlighting this thing, so you also get a gist of how the numbers are arriving at. Third year, it's 0.6931. For the fourth year, it's 0.6133. 0.6133. Okay. If you can see over here, we are still far away from zero, although we reduced it drastically, but we still need to increase the discount rate further so that the amount goes to zero. The net present value comes to zero. Now let's increase it marginally. Let's say by just 1% over here. And now we'll put this amount as discount rate at 14%. Discounted cash flow at 14%. You just need to replace it with the dollar values over here. 0.8772 for the first year, 0.8772. 0.7695 for the second year, 0.7695 for the second year, 0.6750 for the third year, 0.6750 for the third year, and 0.5921 for the fourth year, 0.5921 for the third year. Okay, it's 1027. So this amount is going to be lying somewhere between 14 and 15%. Okay, so now we just try to validate it with one more calculation over here, that is at 15% over here. And if the amount turns out to be negative, then we are sure that the amount lies between 14 to 15%, and the one which is nearest to zero will be the final discount factor for us. For $1, the value at 15% goes to 0.8696. 0.8696. For second year, it goes to 0.7561. 0.7561. The third year, it goes to 0.6575. 0.6575. And lastly, for the fourth year, 0.5718. 0.5718. Oh, this amount goes to a way beyond than zero amount, right? It's minus $3,158 over here. So we can safely conclude that the internal rate of return for this project is supposed to be at 14%. Ideally, somewhere between 14 to 15%. But if we take 15%, the difference is huge. It goes to 3,000 negative. So the closest value to zero as of now, which we have, is $1,000, $1,027 precisely. So it can be said that based on the above computations, the internal rate of return for the company based on the above computations, it can be stated that the internal rate of return for this investment is approximately, always use the word approximately for IRR unless you have a precise zero net present value, 14%. Okay. I hope you got a clear clarity on this thing now, how the IRR works. The only difference you know over here is in the net present value. You determine whether the amount is more than zero or less than zero. It's positive or negative. Here you try to get as close as possible to a zero value, and that's your break-even point where you are not neither at a profit nor at a loss, and that's the IRR the company intends to have in their budgets. Okay, so that was all with regard to the second method, guys. Internal rate of return. I hope you had a clear understanding of these two first methods. Now we're going to go and start with the third project evaluation technique. Okay, now we're going to start with the third method, that is the payback period. So this is quite simple. It's just plus, minus, addition, subtraction, and then you're done. More more precisely, it's just going to be addition of the cash flows, and then you get your payback period. So before we jump into the depth of this thing, let us understand what is the meaning of this payback period. Payback period means the period of time that the project requires to recover the money invested in that project. Okay, it's simple as that. It is the time period needed for the to recover the investment made in that project. Okay, that is, you take up all your cash inflows which are going to come in the future, and then you compare it with the investment value, and at which point of time you have your entire cost recovered. That is your payback period. It's simple as that. No discounting factors, no present value, no such stuff like that. Okay, the payback period of a project is expressed in years and computed using the following formula. Payback period formula is investment required for a project divided by the net annual cash flows. Okay, investment required for a project, that is the cash outflow, divided by the net annual cash inflow. Now, as I said, unlike the net present value method and IRR method, payback method does not consider the present value of the cash flows, precisely present value of future cash flows. Under this method, your investment is going to be project is going to be accepted or rejected purely on the basis of when the money is going to be recovered, when the investment is going to be recovered. The acceptance or rejection criteria is basically boils down to one this thing. Payback period is less than the company's expected payback period. Sure, go ahead, accept the project. Now let's see an example on this thing, and also after that we'll have two different scenarios. I won't disclose it right now. Once we complete the payback example, after that we'll go ahead for this two different scenarios. So here we have an example on payback period. Okay, so let us say ABC company is planning to purchase a new machinery. The related details of the cash flow is as under. Okay, the company's desired payback period is 4 years. Okay, so initial cost of machine, that's gonna be let's quote it to say somewhere around $40,000. 40,000. Annual cash flow details. Sales will be increased, or you can say sales will be 80,000 supposedly, and cost of materials say around 10,000 of outflow. Cost of materials, salaries, another $20,000. Maintenance of the machinery, another $5,000. Yeah, pretty much that's it. So we can say annual net annual net cash inflow will be equal to $45,000 annually. Okay, but wait a minute, compared to this, the initial cost of the machine is very less, right? Let's say the sales is going to be only about 50,000. No, $50,000. Yeah, that makes sense to us now. $50,000. So the annual net cash inflow is going to be $15,000. Notice one thing over here, we have not taken depreciation of the machinery account. Why? Because that's a non-cash expense. Actually, cash is not going to be spent for booking a depreciation. So here, all the non-cash expenses and incomes are avoided over here. So if you remember the payback period formula, here formula, that is your investment required for the project, that's divided by the net annual cash inflow. Perfect. Let's get this done. Oops. So now it makes sense, right? Payback period is equal to investment required for the project divided by the net annual cash inflow. That's the payback period formula. So over here, first we need to compute the net annual cash inflow. That is step one, which is covered over here in the question itself. Ideally, we framed it over here in the question itself, or else you need to compute it. That's pretty straightforward, as you have seen already. So here we have the net annual cash inflow $15,000. Investment required for the project as $40,000. So here we have $40,000 divided by $15,000 equals to how much? 2.67. Ideally 2.7 years. So that's less than the 4 years. So to conclude, the payback period is 2.7 years, which is less than company's desired payback period. Therefore, the equipment should be purchased. Okay, so that was all about payback period. As easy as it could get, guys. There can be nothing simpler than this one project evaluation technique. But there are certain limitations in this method also. It's that many times it happens that projects or the investments gives a high return after its initial gestation period is over. Like in this case, it might be possible if the machinery will have generated an annual cash inflow of just say around $5,000, or you can say if it was the other way around, where we just see over here. This is not for the final sum, just giving it as an example to explain the disadvantage of this method. Let's say the machine would have costed annual sales of just $30,000. Oh my god, why am I making so much mistakes today? We'll make it to $38,000 precisely. So now if you look at this period of payback period, it's going to be 40,000 divided by $3,000. It's going to be 13.33 months only, guys. Okay, 13.33 months. That's way beyond the company's desired payback of 4 years. In this case, definitely the project will have been rejected. But let's say the company failed to realize that this machinery, once the labor would strained in this thing, and over the coming years, the cash inflow would have increased. The sales value from the fifth year might have picked up and doubled literally. In that case, the machinery, this method fails to track all the cash inflows arising after the payback period, and that's the main disadvantage of this thing. Another disadvantage is that it does not account for the present value of the money. I'm sorry, just fumbling a bit. This method does not take into account the present value of the future cash inflows. Like $15,000 coming after the end of the first year is not going to be the same is not going to have the same value as it had at the beginning of the year. $15,000 at the end of the third year definitely won't be the same as in value it sits today. So these are the major two disadvantages of this method. The present value disadvantage is taken care by the discounted cash flow analysis, which is our next method, of course, to study. But yes, this disadvantage of ignoring the cash inflow occurring after the payback period is over, after the payback period, is definitely a biggest flaw and cannot be rectified for this method. So remember, if I had told there are two more things coming up for this particular thing, particular payback period method, which I'm going to show you after the example. Now that is, over here, we had the understanding that the annual cash inflow are going to remain the same. What happens when we have to choose from several alternatives? And next is that payback method under the cash flow method, under uneven cash flows basis. So as the situation arises, you need to make a choice among the different payback, apply the different methods of payback as per the situations. We're going to quickly look at this two methods or two situations where precisely cash flow from several or choosing from the several alternatives and payback method under uneven cash flow. I'll just try to portray this, or you can explain this thing with the help of two quick examples for this thing. So let us say choosing from various alternatives. This is also as simple as it could get. Suppose ABC company wants to buy a machinery and has two equipment choices. Let's say machine X saves $2,500 in labor and costs $15,000 to purchase. Similarly, we can say machine Y saves $3,000 in labors and cost $19,000 over here. Okay, so to compute the payback period over here for machine A, or you can say payback period is equal to the net annual cash inflow over here will be equal to the savings done by the machine. Okay, any avoidance of cash outflow in this case is as good as a cash inflow only when you're computing this payback period thing. Okay, so over here payback period will be equal to your investment for the project, investment divided by net annual cash inflow. Over here we're going to compute for machine X and this will be for machine Y. Okay, sounds good, right? So here it's gonna be $15,000 divided by 2,500, which is equal to 6, right? 15,000 divided by 2,500, 6 years. And similarly here it's gonna be 19,000 divided by 3,000. So it's gonna be equal to 19,000 divided by a little over 6 years. So obviously machine Y will be rejected and machine X will be procured. Okay, decision accept, reject, as simple as it can get, right? So this is how you determine which one to choose, which one to drop off. Just compute the payback period for every individual projects or purchase or whatever investment decision you need to make, and evaluate the shortest payback period. The condition over here is that if the company would have put it one more condition that the company's desired payback period is 4 years, then in that case both the machineries would have been proposal which have been rejected and neither of them will have been purchased. Now the other is payback method under uneven cash flows. So here we're going to put a line saying that this is over, and now we're going to pay payback period under uneven cash flow. So till now, whatever methods we have done, we have assumed that all the projects are giving an equal cash flow throughout all the years. But that does not happen generally, right? As in how the labor gets a good hand, as in how the labor gets trained on the new machinery, as in how the expertise is developed, economies of scale and various factors are achieved, the cash inflow goes on increasing or the cost goes on decreasing. Out both of them take place, which happens to generate a uneven cash flow, higher in the initial years, lower in the later years, lower in the initial years, higher in the later years. Anything is possible, right? So let us look at an example where there's an uneven cash flow. Let's say an investment of $300,000 is to be made, and the cash inflow on annual basis are as mentioned, right? So for years and the annual cash inflow. You have year 1, 2, 3, 4, 5, 6, 7, 8. It's fine. I think till 8 years should be enough. For the year 1, we assume it to be on the lower sides, let's say $30,000. Year 2 will be like, no, not too much of increase, $32,000. Year 3, let's say it's gonna be remain the same. Year 4, we're gonna have an expedited one, $38,000. How much is the total so far? It's 132. Now we can pump it up to somewhere around $50,000, 55,000. Let's say there was a shortage of materials and we had a negative cash flow. reduced cash flow. How much does this give? $289,000. And here we have something around extremely on the higher end, $90,000. So now we got to compute the payback period over here. In this case, compute the payback period for the investment. If you see, because there's an uneven cash flow on an annual basis, we cannot use the payback period formula as we have been using till now, which is which is the total investment for the project divided by the net annual cash inflow. What we can do is we're going to use the compound or cumulative cash inflow approach here. So we're going to compute the, oh wait, why am I writing it? It's already here. We're going to compute the cumulative cash inflow. Compute the cumulative cash inflow. I think it's getting too long, guys. Just hold on a while. We're just nearing the end. Cumulative cash inflow, which is going to be previous cash inflow plus the current cash inflow, and we're going to drop it down across, right? So it's 30,000 for the first year, second year 30,000 from the previous year plus 32,000 from the next year, that's 62,000. For the third year, 62,000 from the previous year, 32,000 from the current year, 94,000, and so on. Now we're going to see what was the initial investment, or you can say the outflow was $300,000 over here, okay? And here the $300,000 is covered over here when you have $289,000 over here. So it's obvious that the payback period is more than 6-7 years over here. And to be precise, what is the payback period? You can say you need $11,000 more in the 8th year out of its receipt of $90,000. So that's gonna be $11,000 divided by $90,000. That's gonna be 12 months. Okay. So your payback period is gonna be 7 years plus 12 is equal to 7.12 years. Your payback period is 7.12 years, and obviously you're going to reject the project because it's far beyond the company's desired rate of return of desired payback period of 4 years. This is all with regard to payback period, guys. I hope you had a good understanding of the payback period. As simple as it can get, as easy as it can be, once you have understood the principles of its application, right? I'll see you in the next session where we're going to study the discounted cash flow analysis. Now we're going to study the next method, which is an extension to the payback period method, that is discounted payback period. So far, you must have realized that discounted payback period has one of the biggest limitations, that is, it does not account for the present value of the future cash inflows, which is highly an inappropriate technique to judge a project, right? That limitation is compensated, or you can say that limitation is eliminated entirely by using the discounted payback period method, or you can say the discounted cash flow analysis. In the discounted payback period method, you eliminate, or you can say you eliminate the payback period flaw by discounting the future cash flows appropriate values to the appropriate values. Now that discount rate will be the company's, if it's not mentioned, if it's not provided to you, you safely assume that it's the same rate of return required by the company for any project. That will be your discounted rate of return, or you can say the discount rate to arrive at the present value of the future cash flows. In discounted payback period method, we have to calculate the present value of each of the cash inflows, taking the start of the first period as 0 point. Okay, the first cash inflow point is a 0 point. That is when you invest or when you make the cash outflow. That is as happens. 0 point means that the value will be 1. It's exactly the same as we do in the net present value, right? If you recollect the fact how we had done the cash inflow present value computation, it's going to be exactly the same. Challenge over here is that you have to use a cumulative cash flow approach like we had done in the previous payback period method for the last example, where we had an uneven cash inflows coming in at various point of time. Now, the discounted cash flow for each period is computed by a formula, that is discounted cash flow is equal to actual cash flow divided by 1 plus interest rate raised to the power of n, and that is the exact formula for the present value of cash inflows. If you recall the formula which we had done in understanding the present value factors, in understanding the present value computation, that was also present value of future cash, or you can say future value of the cash inflows divided by 1 plus interest raised to the power of n, 1 plus rate of return raised to the power of n. That's exactly the same formula which we're going to use for the discounted cash flow over here. Now, once we have the discounted cash flow formula, the entire procedure is same as it was when we were doing a payback period which had uneven cash flows coming in. So that can better be explained with the help of an example. Let's start with the example itself now. Now we have your discounted payback. So let us say an initial investment of let's say $232,400 okay is expected to generate $600,000 per year for 6 years. Calculate the discounted payback if the expected rate is, let's say, 10%. Okay, so first we're going to prepare a table which is going to compute the discounted cash flow of each period by multiplying the actual cash flow to the present value factor. So here we have is let's say the year, the cash flow scenario over here, present value factor at 10%. You have your discounted cash flow. So here we're going to understand year 0, 1, 2, 3, 4, 5, 6. For year 0, we're going to incur the initial cash outflow of $2,324,000. Okay, and you're going to have an every year annual cash inflow of $600,000 till the 6th year. Now we're going to look at the present value factor table for 10%. For the first year, it's 0.9091. So it's 0.9091. Next year, it's going to be 8264. So it's 0.8264. The third year, it's 0.7513. 0.7513. Fourth year, it's 0.6830. 0.6830. Fifth, 0.6209. 0.6209. And lastly, sixth year, it's going to be 0.5645. 0.5645. Over here, it's going to be 1. Now, as we had done in the present value computation, I want to multiply this entirely. Use the same formula, dollar value. Okay. Now we're going to put the one more additional step, which is going to help you figure out where does your payback period lie. It's going to be cumulative discounted cash flow. Okay. So here we're going to have the same minus figure, $2,324,000. And as you realize, this goes on decreasing because you initially made a negative investment, like your cash had gone out, and then you're starting to receive money against that, which is discounted to the present value. So obviously your cumulative cash flow will keep on reducing from negative and ultimately turn out to be positive. In which year it turns out to be positive is in the 6th year. But it does not need the entire $338,700 of cash inflow in 6th year. It just needs this $49,580. So what we're going to do is use the same equation as we had done previously. That is, we're going to figure out how much is the difference over here. Out of $338,700, we just need $49,580. Right? So we're going to compute the fraction amount over here. That is, the discounted payback period will be equal to 5 years plus $49,580 divided by 338,700. That's gonna be a fraction of 0.15. So it's gonna be 5 years, 5.15 years. Okay, so this is how you get your discounted payback period. It's very easy once you understand the discounted cash flow concept and you start applying it. That's why hence we had told you the present value computation is going to play a really crucial role in all your future computation, most of the techniques of project value evaluation. As for now, I hope you have a good understanding of your discounted cash flow analysis. Okay, that's it for the time being, guys. Now we come to the fifth method of project evaluation technique, that is opportunity cost analysis. So this ideally does not involve much of an intense competition like we had in the present value, discounted cash flow, and stuff like that. This is just mainly a understanding, or you can say application of a common sense. What is the opportunity cost to accept a project or reject another project? Okay, so opportunity cost, ideally saying in layman terms, it is the cost of earning income which you forego for choosing the other option. It is the cost of benefits you have lost because you choose the other option, because you went with the other option. In this case of project evaluation techniques, or you can say before going into the depth of project evaluation, let's understand how do you judge that in the layman's, you can say in today's term. Let's say you have a weekend assignment, a part-time assignment which you can do on your weekend and earn a handsome amount of $1,000, but you choose to go out with relax with your friends. Okay, so here the opportunity cost for you to go out with your friends is $1,000 because you forgot one income and choose the other option. The cost of losing out on that income, that profit, is the opportunity cost for you at a personal level. When you expend some of your, when you and your friends share drinks and have a good time, and the amount you spend on those activities, that's another, that's incremental amount for you, but already you made a loss of an opportunity cost of $1,000. So that's simply as an opportunity cost. So let's look at an example from the project management perspective, and then I hope it will give a better understanding of how do you evaluate the opportunity cost. As I said, this is not going to be a really fancy kind of example where you have a whole lot of techniques, present value, discounting period, payback period, and stuff like that. It's going to be a simple layman question. So let's say we'll look at this example from a, not from project manager perspective ideally, but from a layman's investment term ideally. Okay, suppose you have $200,000 to invest, and you can choose among the following options. Okay, one is invested in government risk-free return scheme, which gives a return of say 5%. Okay, the other is your friend has approached you to invest in his startup, invest in your friend startup, which can give you a return of 12% after 3 years. And you do the same way, you invest in free for 3 years. Okay, for 3 years, and 12% per annum for 3 years. So now here you have to choose which investment option is the better for you, which is not one. The higher the risk, the higher the return. In the case of government risk return, the investment, or you can say the government risk return, does not carry any risk, hence they have the least return at say a nominal rate of 5%. But your friend's startup is an attractive one, but also it possesses a high risk. You may or may not even recover the principal amount, or you may recover the principal partially in case the startup fails. Anything is possible. That's why it provides you with a higher return, that's of 12% a year. So now let us see what is the income which you're going to derive with this thing. So here you have your years, and $200,000 invested at 5% per annum for 3 years. That's going to give you an income of, let's say, for the timing, we'll just avoid the whole concept of present value because we're going to try to keep it as simple as possible. So year on year, your friend and your this bank is going to give you some return. We just look at their current values only. For the year one, 3 on $200,000, 5% gives you $10,000 of return. So for your government, you get this is for government risk, government bonds. Okay. And now we're going to see your friend startup option. This is going to give you a 12% return. So it's going to be $24,000 for 3 years. That's going to be $72,000. So here you might say that if you invest in your friend's startup, you're going to earn an income of $72,000. But that's not the case, guys. You're just going to earn an incremental profit of $42,000. Incremental income. And why so? Because to earn a $72,000 income, you had to forego an opportunity cost of a $30,000 income. That's how you only earn an incremental income of $42,000 in the long run after 3 years if you invest in your friend's startup. So this is the concept of opportunity cost, guys. When you forego one opportunity, you also need to evaluate the cost of income you forgot by rejecting that option. And when you determine the income you gain by the other investment, you need to understand only what was the incremental income, incremental gain you made on that investment, because you already had to forego a secure, a risk-free opportunity to earn an income. Okay, although not really important from a calculation concept point of view, but really important to know as a project manager which project has how much incremental cost and which project has what opportunity lost, which project loses an opportunity cost to what extent. That will give you a more detailed analysis, a more clear idea of how to choose which projects and so on, guys. I hope this was easy to understand. With this, we complete our opportunity cost concept. Now we come to the last method on project evaluation, that is earned value analysis. Now this method, the intention of this method or using this method is really different from the other methods, other 5 methods. If you notice in all the other 5 methods, our main intention or main focus was diverted on how to select a project. But this method helps you to determine what is the progress of an ongoing project. Should you continue it further? What is the additional investment required? Is it on time or not? And all those questions are addressed by this thing, by the earned value analysis. That's why the intention, or you can say the focus of this method is mainly on evaluating the ongoing projects, not between choosing a project, but evaluating the project which are already being executed. So what is the earned value analysis? The earned value analysis is by definition an industry standard method of measuring a project's progress at any given point in time, forecasting its completion date and its final cost. At the same time, analyzing the variances in the schedule and budget of the project proceeds as the project proceeds. This method compares the planned amount of work with what has actually been completed, and then it's determined if the cost, the schedule, and the work accomplished are progressing as in accordance with the original plan, with the original budget standards. As the work is completed, it is considered as earned. What is the need for earned value analysis? Now, most of the projects are over budgeted and are behind the schedules as most of the time. Also, many times the project finish uh, over and above their initial budgets. And sometimes it happens that even after spending a lot of time and money, projects never get completed. They come to a halt because of some of the other reasons. So it's important that this earned value analysis gives the management an insight, and it helps them in various ways. How does it help them? It helps the management and it helps the project managers mainly to measure the amount of work performed on any project at a given point of time, by which they can forecast the precise completion date and also the precise cost to complete the project. It helps the management to analyze between the various schedules, between the schedule and projected budget cost. Also, it enables, most importantly, it enables the management to take a proactive decision rather than a reactive decision when it's too late and the damage is done. So this all boils down to two main questions which are addressed by the earned value analysis. The first is that will the project cost on completion be greater than, equal to, or less than the original estimate? That is the difference between the planned cost and the actual cost. And next is that will the project be completed on time? That's it. This is the main two intention of the earned value analysis. So going ahead, Now, to understand this earned value analysis, we're going to need to understand some variances which are computed under the earned value analysis. Now, to understand the variances which we're going to compute under the earned value analysis, it's important for us to know a few important definitions beforehand. Planned value or the budgeted cost of the work schedule. This is the total amount of work scheduled to be completed as per the milestones which were defined originally. Okay, so you need to interpret what is the actual plan, what was budgeted, or you can say planned value, which was the actual cost which was budgeted to be completed when the work reaches a certain stage as per the milestones which were defined originally. Actual cost or the actual cost of work performed. This is a total of the cost incurred in accomplishing the work till date. And lastly, we have earned value. This is the value of the work actually completed. Two variances are computed under the earned value analysis. First is the cost variance and next is the schedule variance. We're going to look at this with the help of an example that will give us a much better clarity in understanding this whole variance concept. So let's go to the example and we're going to form it over here. Earned value. Okay. Okay. So let us say a project manager has a budget of $1 million and the project is expected is to be completed in 12 months. Now after a month, 10% of the project is completed and cost incurred is $120,000. Okay, but as per plan, the project should have been completed till up to 20%. So over here we are saying that as per the original plan, the project should have been completed up to 20%, but the actual status states that it's completed only till 10%. Now you're going to need a few important computations over here to determine the variances. So first, budgeted figures and actual figures. Okay. Okay. So we have the total cost of the project. It's budgeted at $1 million. Percentage of completion as per the budget. It should have been 20%. Actually, it's only 10%. Now then we have the actual cost incurred after 1 month. It's $120,000. Okay. Actual cost after 1 month. Let's mention it more clearly. Right. Now we're going to compute the important figures which we had discussed. That is the planned value, the actual value, and the earned value. Compute the planned value, actual value, and the earned value. How are you going to compute the planned value? That is the total amount of work scheduled to be completed as per the milestones originally defined. Total amount of work expected to be completed as per the original plan. By here, total amount of work means that work or the cost expected to be incurred. Right? So that's what is the plan value. Oh, so it's gonna be how much? It's supposed to be $1 million to into 20%, right? So it's supposed to be a $200,000 of work to be cost to be incurred and the work to be completed till 20%. Okay, now we're going to compute the actual value. That's going to be total cost incurred till date to accomplish the current work status, right? The current status of the work. You can see the current status, and that's simple. It's given straightforward. That's $120,000. Okay. And lastly, we have the earned value computation. Now, how do you compute the earned value? That is the value of the work actually completed till date. Value of work completed till date in terms of original cost. That's the most important factor here, in terms of the original budget. So what does this means is that original budget, as per the original budget, the cost should have been how much? For 10%, it's supposed to be $1,000,000 into 10%. Okay, that's supposed to be $100,000. So if you compare the factor here, its earned value means how much is a percentage completed till date. Actual percentage is 10%, and how much was the budgeted cost for the actual completion? That's $100,000. Okay, so that is what the concept of earned value is. Now we're going to compute the variances over here of the variances. And we had two variances, if you remember, cost variance and schedule variance. First is the cost variance. Now cost variance is equal to your earned value minus your actual cost. Here you're trying to define what is the deviation from the cost which are supposed to be incurred for 10% versus the cost incurred actually for 10%. So that's going to be equal to 100,000 minus $120,000. That's equal to a negative $20,000, right? So this is how you come to know what is the status of the project in terms of cost. In terms of cost, they have already exceeded 20,000, overspent 20,000 compared to the planned amount. Now we're going to go for the scheduled variance. That is equal to your earned value minus your planned value. So now you're going to go for earned value minus planned value. That is equal to $100,000. What does this means is that in terms of the schedule, you are supposed to incur an expense of $200,000 till date by completing 20% of the contract. But till now, you only completed 10% of the contract, whose standard cost is $100,000. So in terms of the schedule variance, you're lagging behind literally half of the value which are supposed to be accomplished. The costs which are supposed to be incurred till now is only half of what has been done till now. So these are the two important variances for the earned value analysis. Now we're going to go ahead and look at the theoretical part, because there's some more which needs to be understood, and that is efficiency indicators for the earned value analysis. Till now we just seen what is the difference, but okay, we are lagging in terms of cost. We are 20,000, we have spent extra 20,000. In terms of the schedule variance, we are $100,000 behind the expenses as compared to the original plan. How do you define it? How do you derive a useful meaning out of that thing? And that is done by this efficiency indicators, which is cost performance index and the schedule performance index. Let's look at an example, and also along the example we're going to understand what is meant by this variance index, efficiency variances. This cost variance and the schedule variance, they can be converted to the efficiency indicators to reflect the cost and schedule performance of the project. So firstly, it's going to be, we're going to start with a fresh over here, efficiency indicators. First, we're going to study the CPI, that is cost performance index. Okay, cost performance index is equal to earned value divided by the actual cost over here. So what does the cost performance index indicates? It indicates that what is the efficiency with which the costs are being incurred to complete the project. Okay, the CPI is known as generally to enable the entity to forecast the cost to complete the project, and the schedule performance index SPI is equal to your earned value divided by your planned value. And the schedule performance index enables the entity to indicate by what time is the company behind its schedule? By when will it complete the project? What is the expected time to complete the project? We're going to understand this thing in more depth with the help of continuing the example from the previous session from here itself. Over here, a cost performance index is equal to earned value, that is $100,000, divided by the actual cost, that is $120,000. Okay, that is equal to 83333. Okay, that's equal to 0.83. Okay, similarly we can interpret a compute for the schedule value, that's going to be somewhere like 100,000 divided by 200,000, so that is equal to 0.5. Okay, now how do you derive the meaning from these two indices, these two efficiency indicators? Over here, the cost performance index, this means that for every $1 spent by the company, every $1 spent, the project is producing output worth only 83 cents. Okay, so here for every dollar the company is spending, the project is only producing an output of 83% compared to the every dollar spent. So to complete the project, which was for let's say $100,000, $1,000,000, right? You're gonna need an additional amount to fulfill this project. Okay, so that's gonna be how, that's computed easily. It's gonna be 1 million divided by 0.83. That's gonna be, you're gonna need an amount of 1.2,004,819 to reach the milestone, to reach the project cost of, to cover the project cost of $100,000, $1,000,000. And how do you cross check the answer? It's simple enough. You just take this amount and multiply it by 83 cents. Okay, here you have a $1,000,000. Okay, so that means you're gonna overshoot the project cost by $204,819. That's what the cost performance index means, and that's what we had told in the initial step, that this cost performance index CPI enables the entity to forecast how much cost will it incur to complete the project till its ends. Okay, similarly we can see interpret the SPI, that is the schedule performance index. Now the schedule performance index is at 0.5 over here. This means that for every hour spent on the project, it is generating an productive output of only 0.5 hours, that is worth 30 minutes. Okay, so this means that for every hour of work the company is paying up, they are only able to recover and time, in terms of time, only 30 minutes of work for every 1 hour of work. Okay, for every $1 they're going to be able to recover only 50% of the value of that 1 hour, $1. That is how you estimate the schedule performance index, how much behind are you delivering. Okay, to precise, please say, you can say that the project is running 50% behind its scheduled targets. Okay, that's how the schedule performance index is measured, and it can also be verified by the very fact that entity had to reach a 20% milestone at the end of the first month, but it had only reached a 10% milestone, only completed 10%. That's a clear indicator that the project was only 50% completed till the first month, and that's also validated by this SPI, schedule performance index. So that was all, guys, with regard to the earned value analysis. Make sure you understand this concept very thoroughly, because as a manager, as an ongoing project, you are liable to answer all these questions. Why is the project behind schedule? Why is the cost being incurred extra? Where is it that your estimates have gone wrong? How do you improvise on that? Will it take care itself in the future that initial phase pay cost incurred was more compared to the later phase of the project? Will the delay in the time schedules be coped up, or will it need to be dropped down? Will you need additional resources? There are many questions which can come up, but if you have a thorough knowledge of this earned value analysis, that is how to evaluate a project on an ongoing basis, an existing project, you can be sure that you're going to have a sufficient timeline to save yourself, your project, and your reputation also, guys. That was all with regard to the earned value analysis. Now we begin with section E, which is going to be forecasting. So
let us understand what is the meaning of forecasting first of all. In layman terms, or you can say in general terms, forecasting is simply the process, or you can say forecasting is simply to predict the future, or you can precisely say to reasonably estimate the future. In business terminology, in the accounting and financial world, forecasting is said to be that process through which the company tries to predict the future by making a historical analysis, by making a rigorous, or you can say by making an analysis of the historic trends of the company. So they try to evaluate the past performances, how it has been improving year on year, how it has progressed year on year, and based on that, they try to reasonably estimate, reasonably forecast the future. So in most of the cases, in most of the organizations, the forecasting of the company's goals and objectives is done by top management. The decisions flow from top to down. But as a project manager, it's also important for you to understand what is the process of forecasting done. How does it impact? How is the computations involved? How are the decisions made based on the various forecasts? Okay, so let's understand the need for forecasting in a project management. The very important first point is that project duration. It enables the entity, the project manager, to estimate the project duration, how long will the project exist, how long will it take to get completed, and so on. Now, project duration is crucial for any project manager to know because mainly, first of all, our resources are deployed for every period of time the project is continued. Salaries are paid, wages are paid, and so on. Next, it's a project cost. Once you have the forecast, you can estimate the project cost which is going to be involved throughout that period of time to complete this project, given the number of resources you need to purchase, maybe in terms of material, in terms of services, in terms of salaries, and so on. And the most important point is that it serves as a what if analysis. So the forecasting, understanding the forecast method helps you to figure out your own what if analysis. What if analysis means that what will be the impact of taking one particular set of action. Let's say what will be the impact on the net profit if I increase the marketing spending by 25%? What will be the impact on my revenues if I increase a sales budget, salesman salary, salesman staff budget by 20%? What will be the impact if I increase my overhead spendings by 10%, and so on? So this is why it's important for you as a project manager to be aware of forecast. So let's quickly look at an example on how the forecasting works that will give you a better insight on how the various functionings are falling into place. So let us from the example over here as we have been doing till now. So Mr. A as a project manager has received the following data for the previous year. So here we can say the revenue for the previous year were supposedly, let's say, 1 million. The cost which were incurred to get this revenue, they will be salaries of his staff somewhere around 200,000. Then materials, let's suppose it's a production kind of a thing, so it will be materials of 100,000. Overheads of his own department was another $50,000. Sorry. Then equipments, repairs. I'm taking the term repair over here because I don't want to involve any fixed asset acquisition as of now, because if that involves a whole lot of different depreciation and processes comes into place. I'm trying to keep it simple as possible so you can get a gist of what we're trying to convey over here. Equipment repairs might be around, let's say, 25,000 for the safer side, and other support. This includes everything, right? Another 25. So after all this thing, the net profit for his project was, let's see, revenue minus the cost involved, $780,000. Okay, so this is, oh well, that's, oh yeah, salary is supposed to be $200,000. That's what I was wondering. Why is it so less? Okay, so this is the budget of the previous year. Now let us say for the current year, it is forecasted that the revenue will increase by 15%. Salaries, because appraisals are expected by employees,
will be increasing by 25%, material by let's say 30% for the safer side, and other support will reduce. Let's see what the effect of reducing one of the expenses will reduce by 10% marginally due to the efficiency gain. Okay, gain over the period, over the past years. Prepare the forecasted income statement for Mr. A. So I'll just mention your actual, okay, will be this income statement for the previous year. Right? After the income statement, we will mention your forecasted income statement. So over here, we'll just copy this previous year. We're going to have increase in revenue by 15%. So that's going to be 115%. Salary increases by 25%. So that's going to be salary into 5%. Materials will be increasing by 30%. So that's going to be 130%. Overhead remains the same. So that's going to be 50,000. Equipment remain the same. So that's 25,000. Other support is going to decrease by 80%. Sorry, by 10%. So that's going to be 90% of the original one. Okay, so this is how the forecasted income statement of Mr. A is going to look for the current period. Okay, that's going to be increase in revenue by 15%. That's going to be 1,015,000. Salaries increasing by 25%. That's an increase of $50,000. That's going to be 250,000. Material increasing by $30,000. Other overhead remains same. Equipment repairs remain the same. Other supports get reduced by 10%. So that's going to be 22,500 is the new overhead other support cost. Finally, it gives you an increase in the net profit. So if we were to compute this forecasted increase in the net profit, that would be the difference, that is 72,500 divided by $600,000, percentage of that, a 12% approximate increase in your net income, net profit compared to the previous forecast. So this is how you prepare the forecasted income statement, or you can say this is how the management prepares the forecasted statements. Obviously, it's not going to be this much simple, but the principles remain the same. They take up the past data and apply a fixed, you can say apply a percentage increase or decrease depending upon their analysis of the market, depending upon their analysis of the company's internal processes, improvements, and so on. Some cost will increase, some cost will decrease. In the inflation, not inflation precisely, in the years of growing economy, you can say the company expects an increase in sales based on the business models and expects a decrease in sales in some years, again based on the revised market conditions. So now if you're wondering when will the company reduce its sales figures based on the market condition, there are certain instances. Let's say, for example, before 10 years down the line, when Amazon was not there, there were only retail stores running across every corner of the world. At that point of time, every retail store will expect an increase in their yearly sales, year on year sales, a revenue increase year on year. But with the entry of the online markets, now the retail stores are reducing their year on year sales. Okay, the forecasted sales are reducing, the forecasted revenues are reducing. Why is that? This is because the change in the market scenario has become so much big that now online sales, online economy is booming, whereas the offline or the retail economy is going down day by day. So those are the scenarios which you need to account for when preparing the forecast. Obviously, as a project manager, it's very rare that you might end up doing the forecast analysis for your own project. Mostly figures flow down from top to bottom. But if you have the picture in mind, you can very well put up your case saying that if the management, let's say if you're running a retail chain, okay, if you're running a retail store, and if the entity has put it you a forecast on you saying that last year your sales was $1 million, this year you got to increase it by 20%. Now, based on your understanding, you can go ahead and say the management that because of the change in the economy, a 20% increase in the retail sales is highly not possible. However, if we move out, if we increase some of our spendings in the online marketing area, in the digital creation area, and then
create an entire logistic supply or create an entire backend chain to make sure we are able to cater to the online market also and the offline market, then we might increase our sales by 30% with an additional increase on cost of 5%, or you can say in some cost by 10%. Based on those increase or decrease, you can prepare your own forecasted income statement and put up your case to the management. That also makes the entity know that you are an active project manager who takes an interest, who comes up with his own suggestions, who comes up with his own thought process of how the entity can prosper. So that was all, guys, with regard to forecasted income forecasting. In the next section, we're going to start with our budget and variance analysis, which is an extension that ideally the next step after the forecast are done. Now we begin with the next concept, that is budgeting. So once you complete the forecast, you have a reasonable estimate. And if you remember the last statement which we prepared in the forecast, that was a kind of a budget for the coming period, okay? So, but let's not go in such a vague term and let's understand clearly what is budgeting. So, precisely saying, budgeting comprises the estimation of the cost, setting up of an agreed budget, and lastly, managing the actual and the forecasted cost against the budget. This whole thing comprises a process of budgeting. The budget that identifies the planned expenditure for the project or the portfolio program. You can see the budget is going to lay out the expenditures in detail, what expenditures the entity expects to make to fulfill a particular project to reach its goal of achieving that project. What are the costs which are going to be, various costs which are going to be incurred in reaching out to that project. It's a baseline, or you can say it is that standard against which the actual expenditures are going to be mapped, and a further analysis will be conducted. Why was the actual cost lesser or higher compared to the budgeted cost? And that terminology is the variance analysis, but that will take up in the next session. For now, understand this thing. The budget is a baseline, is that standard which you're setting up against which your performance, your actual performance is going to be benchmarked, is going to be compared to. So what's the importance of budget? So whatever is the importance of budget from the company's perspective, it's also important for you as a project manager. There's no deviation over here like we had in forecast, where the entities forecasting objectives were different and it was a different objective for you to understand. No. Here, the entity's objective of preparing a budget and sticking to it are the same one as you as a project manager should have in mind. First one, obviously, cost estimation. That's a basic function of budget. It lays down the entire cost in detail one by one and gives you an entire summary of what is the estimate of the total cost which is going to be incurred for completing this particular project. Prioritizing the use of limited resources. Now, resources, they are always going to be constrained. They are always going to be a bottleneck for every organization, irrespective of how much of money the company has. There are certain exceptions to that rule, but in most of the cases, resources allotted to a particular project manager to a particular project are going to be limited. And you have to determine what's the best use to, or you can say, where is the optimum use of resources going to happen now. That's why it's important for you to prioritize the use of these limited resources. Which areas are going to be giving you more fruitful rewards, which are going to be more productive, more efficient, which are going to be less productive, less efficient, ignoring, or you can say putting those areas in the C category rather than diverting them in the A category. Next is the future planning. Now, future planning, don't get confused with this term yet. Okay, I know future planning was a part of forecasting. How is it ending up in budget will be a question in your mind. So once you have a project going on, an existing project, it's important for you to always keep a track of what's the expected cost going to come up, what's the expected budget going forward to complete the project. Okay, many times it happens that sometimes if a project is of 6 months and you had estimated a total cost of $100,000, by the time you reach only 1 month, you have already spent it $50,000. There can be tons of reason for that, but yes, for the remaining 5 months, you do need a good amount. And here, this future planning helps you. How does it help you? It makes sure that you have a readily available amount, that what is the future needs going to come up, at which point of time, how much funds are going to be required, and you can anticipate those in advance, prepare for those in advance, and make sure you have the arrangement for those funds prepared in advance. That's why the future planning concept is important, or you can say is a part of budgeting concept. You can say based on these things, you can understand that the company's objectives in the for preparing a budget are same as you have as a project manager. I'm not taking an example right now over here because I want to cover the example along with the variance analysis where we have a one single stretch, a full length example where we prepare a budget from scratch, compare it to the actual and depth dive a bit deep into the variance analysis. That is, dig deep what were the reasons for the various changes, we can say the deviation from the budgeted cost. With this, we complete the theoretical part of budgeting, guys. Now we come to the last part of this topic of this session, that is variance analysis. So I hope you are still having some insights into variance analysis based on the budgeting sessions, because we had discussed a bit about the variance analysis. But now we'll dive in deep and understand it precise thoroughly. What is variance analysis? Variance analysis is basically the study of the deviations between the actual results and the budgeted results. Or you can say the budgets and the actual result. How the performance of the entity has been in compared to the budgets it had set it for itself, in compared to the benchmark it had set it for itself. Okay, by comparing these two things, you understand where the flaw lies. Is it in the budget setting process? Is the entity setting too high ambitious project, or is it undermining itself too drastically and setting a highly optimistic budget and overachieving the results? Or is it that the entity is setting a highly ambitious targets and missing out the results because the actual reality is highly different? But because of the variance analysis, one thing is for sure, either of the process will be having a few flaws. That's why there is a deviation between the actual results and the budgeted results. Now, what is the importance of variance analysis? First of all, it supplements the efficient budgeting activity. So understand this thing: if you prepare the world-class budget, but you do not have, if you have not compared it to anything, if you have not compared it to your actual results, if you have not figured out why are the reasons, why is the deviation between the actual results and the budget, what's the use of the world-class efficient budget? Nothing, right? So the variance analysis, it supplements your budgeting activity. Because of the variance analysis, the entity is able to prepare itself, to get itself more better in the budgeting process. If the variance analysis was not there, how will they ever know where does the flaw lies? Nowhere, right? Hence, it supplements the efficient budgeting activity. It acts as a control mechanism. Now, analysis of the large deviations of key items, you can say analysis of the major key items of the company, can give the entity a useful insight as to why is there such a big deviation, and the entity can take proper control in those area, exercise efficient control in those resource deployments, and achieve a better control mechanisms. Enables to assign the responsibility for deviation. Now, in an organization, there's just not just you as a project manager who's working, right? There'll be multiple departments, there'll be multiple people running across the organization, all working towards a common objective. But what variance analysis is just that it helps the entity to pinpoint who is the real culprit in the overall negative performance, or who is the real beneficiary of the overall positive performance of the entity. Sometimes it happens that because of the efficiency of one, two other inefficient people are being covered up, right? Or also vice versa, because of the inefficiency of one person, many of the efficient persons are not being able to get the credit, because the overall entity results reflects either a single profit or a loss. But what variance analysis does is that it opens up the various layers. It goes deep beneath every layer and figures out who is the one who is doing a better job, who is the one who is doing a negative job, or you can say a shabby job, and point out to those process or persons and take effective actions with those things to make sure the negatives are turned into positive, and the positive, if possible, are improved more. With this concept in mind, let us look at an example where we're going to study the entire budgeting process and variance analysis together. So let us create the example from scratch over here. Okay, so first let us set up a budget for you. Setting up a budget. Okay, over here we can say ABC company is in the process of setting up its budget for the current year. Important details are the following: it needs 2 units of raw material for 1 finished good. Okay, it needs, let's say, 3 labor hours for producing 1 unit of Okay, the same one, finished good, and it incurs overhead at the rate of $10 per hour of direct labor. Okay, simple and sweet. We'll just keep it simple for the time being. It has opening inventory of let's say 5,000 units. It expects to sell a sale of 15,000 units. Let's go 20,000, right? Units, and intends to maintain a closing inventory of 10,000 units. So based on this thing first, based on this information, first of all, we need to figure out what is the number of units the entity intends to produce. Based on that, the entire production budget, material budget, and labor budget will be formed. Okay, so before we go into the deep depth of this example, I wanted to know one thing. Most of the project management projects, are going to be also service type where the material costs, labor costs, all those won't be involved. But the reason why I'm taking up as this kind of examples is because it gives you an exclusive view into all the various cost and analysis which is possible in terms of budgeting variance analysis. You can just use the piece that is relevant to you. Most of the cases it's going to be salary cost, it's going to be marketing cost, and so on. But having this inventory thing in place prepares you for a much higher level, for a complex level of problems compared to where you are presently right now, especially if you're in terms of service projects, right? So let's continue the project over here. So the production number of units to be produced will be equal to how much? The simple formula over here is you already have an opening inventory, you are expecting to sell a particular inventory, and you intend to maintain a closing inventory also. So you need to sell, okay, units to be sold. It's going to be 20,000 units. Add the closing inventory, that's going to be another 10,000 units. So this gives you uh, units needed less the opening inventory, because you already have some units in place. So that gives you your units to be produced, 25,000 units. Now you know what is the amount of inventory, what is the amount of goods you need to produce. Now you can create your entire budget over here. So what we're going to do is standard budget for 25,000 units. Material per unit, rate per unit, quantity needed, rate per unit, and the amount. That is going to be quantity into rate, right? So for materials, we need 2 units of finished goods. Let's say the rate is at $5 per unit, $5. So it's going to be 2 into $5. That's going to be $10. Labor, we need 3 labor hours. Here we can say the rate is somewhere around $4 per labor hour. So that's going to be again 3 multiplied by 4. That's going to be $12 per labor hour per unit cost, right? Overhead, we need, it needs at the rate of per hour of direct labor hour. Overhead also needs 3 labor hours per unit, right? If you see the sentence over here, incurred overhead at the rate of $10 per hour of direct labor hour. So that means for equal number of labor hours incurred, overhead is also incurred at the same pace. However, the rate is going to be $10, and here it comes to $30. So this is the standard budget for 25 for 1 unit, right? For 1 unit. Now we're going to prepare a flexible budget. A flexible budget is the one which adjusts itself to the actual data. You can say in this case, because we need to produce 25,000 units, we're going to compare this budget to 25,000 units first of all here. So the flexible budget for 25,000 units. The columns are going to be the same over here. The only difference being that we're going to multiply everything by 25,000 over here. Okay. So the total cost incurred for per unit is $52, and total cost incurred for 25,000 units is going to be $1.3 million. Okay. So that's how you prepare a budget, guys. This was your budget setting activity. Now we're going to see how we compute the variance out of this budget over here. So before that, we need some actual data also. Let us say the entity's actual results for the period are as under. It produced 25,000 units. We're going to be staying same in that. Now we're going to say units produce 1,000 units. Okay. Let's say the materials consumed were 51,000 units instead of 50,000, and the material rate was 4.5 at which they procured. We're going to increase the decimal 4.5, right? For labor, it's incurred, it paid for 74,500 at the rate of again 4.5. Overhead also it becomes the same because that's how it's efficient. The overheads were incurred and it paid overhead at the rate of $10 itself. So overall you can see over here the entity incurred more compared to the original budgeted cost. So obviously this will tell that it's a negative variance. Okay, as we said, the overall result is negative, but based on that you cannot judge that who was the real culprit. Was it the material department? Was it the purchasing manager of the material department, or the production line manager who was responsible for the consumption of materials? Was it the labor manager, or is it the negotiation was not done at a better rate with them? Who was the real culprits and all? That can be figured out only when we actually dive deep into each and every single variances. Just a second, guys. I just want to make sure this is reflecting true scenario. Okay. First, we'll go ahead and compute the material variances. Now, remember this thing in the cost accounting and management accounting, there's a whole section devoted to the material or to the variance analysis, but that's at a very high level. I'm not going to be taking you to that level. I just wanted to give give an introduction to the variance analysis so you're at least aware how you're going to compute it on your own. We're not going to go through any formula. We're just going to try to solve it logically over here. So first we'll see material variances. So quantity consumed, or you can say just simply put it as a quantity variance. What's the standard quantity for 25,000 units? It's supposed to be 25,000 units. That's supposed to be 50,000, right? Less the actual quantity. That's going to be 51,000 units. You multiply this by the budgeted price. Okay. Now you might be wondering why we are taking the budgeted price instead of the actual price over here. The logic being that the difference in the price variances will be taken care by the price variance which is going to come next. whenever you're going to compute any variances except for price variance, you always consider the actual price only, budgeted price only, not the actual price. However, in case of price variance, you compute using the actual price. It's going to come up in a while. Have some patience for it. That's it. So your variance is going to be how much? Be 1000 negative. That is 5000 unfavorable variance. It's going to be unfavorable. Now we're going to compute the price variance for it now. For the materials, okay? I'm using the same template over here. Kind of makes easy. Now standard price for, okay, standard price for 1 unit, that was supposed to be $5. Actual price, it's gonna be 4.5 multiplied by the budgeted quantity. We're going to take the budgeted quantity because that's because the quantity variance, or you can say the reason why the variance exists because of quantity is already taken care by the quantity variance over here. The budgeted quantity is supposed to be 50,000 units. Okay, so the variance, obviously you can see the fact over here that the purchasing manager did a good job because the product which the company had budgeted for $5, he negotiated it down and bought it for $4.5 over here. So that's a 50 cents of saving for every unit purchased, and that results in a saving of 25,000 units over here. So that's how you compute the price variance over here. Oh sorry, we made one mistake over here, which is we're going to use the actual quantity, not the budgeted quantity. Sorry, yeah, that's it. So the reason we use the actual quantity is that because the variance which was existing because of the quantity difference was taken care over here in quantity variance. Now we only need to figure out the price variance over here. Compare the standard price with the actual price and multiply by the actual quantity. That gives you your variance for the price. Now this is going to be a favorable variance because it's a positive figure over here. How do you determine a variance is a positive or a negative? It's simple enough. If the cost is less than standard, or you can say the budgeted cost, it's a favorable. If the cost is more than the budgeted cost, it's a unfavorable variance. There's a double check over here that in the basis of which you validate your variance computation is correct for this material variance. You see, the total material variance over here is going to be expected cost, standard cost minus the actual cost. The cost incurred is more. The actual total cost incurred is less compared to the budgeted cost, hence it's a positive variance of 20,500. But if you see the fact over here, your price variance is 25,500, whereas your quantity variance is a 5,000 negative figure over here. Hence it is a total of 20,500 of a positive variance plus this plus the unfavorable one. That gives you your material variance of 20,500, which is exactly over here the difference between the standard price, standard material cost and the budget material cost. So as we had discussed in the theoretical part, the good job done by one guy gets overcome or reduced because of the negative work done by the other guy. Over here, the production manager, the flow manager who is responsible for the consumption of materials did a bad job, incurred a negative variance, or you can say expended $5,000 more compared to the price variance, compared to the other manager who did a good job and saved the entity a total of $25,500. So 5,000 spent extra, 25,500 saved extra over here. Netting it off, it comes to a total saving of $20,500 only. So this is how you understand the fact that variance analysis helps you to layer out who is the real culprit, who is the beneficiary to the company, who is doing an efficient job, who is doing a shabby job. So I hope with this thing you have been able to understand the variance analysis. Before leaving up, I just want to give you one more task over here. The same way how we computed the material variance over here, I want you to compute the labor variance and overhead variance and get back to me on what are your answers. Once I get answers from you guys, I will share whether the answers given by you are correct or not. In a way, it's an assignment for you. Do make an effort to complete the assignment, guys. It will be really helpful for you to understand this whole concept of material and this whole concept of budgeting and variance analysis. I'll give you a small hint. The competitions are same as we had done over here for material variances. Okay. I'll see you in the next session, guys. Oh, precisely saying, I'll see you when you submit your answers to me, guys. Till then, have a great study time.
Hi all. Let's start with the expert project management course. First of all, before moving into the details, what is an expert project management and about the whole course which we are going to have. It's a big course where we can have case study. We will see the numerous case studies to become an expert project manager, and also we will see what are the traits of expert project manager. So before all that, first of all, I want to make the session interactive, and I'm sure that you will have an experience as a project manager because that's how you have enrolled for this course of expert project manager. So I'm sure all of you have worked in the capacity of a project manager, handling maybe small or big team. It doesn't matter. You have managed a project. So when it comes to project management, the expert project management deals with, it's not for we are dealing as a project manager, we are not dealing only with materials or just resources and software, etc. We are dealing with people. So people are different, and people are definitely have huge emotional difference, technical difference. So we are managing as a group. We have to build a team, and we have to focus on a project goal. And when it comes to expert project management, it's regarding our course. We'll see the main areas like balancing time scope, all those things, which is the basic duty of a project management. But apart from that, what is there in for you for as a learner in this course is we will see numerous case studies, and for example for McKinsey and all those people as an Accenture, like how they have as in a company, how what are the what do the project managers do and how they treat their client, and also what is there what is distinct in this course is we'll see the details. We will see from a from just a project management and how you become an expert project management, because when you call a person expert, that means he has to have so many details. You are making good judgments so that your projects are not failing, and also you are managing your team well. So project manage, it is a overall development. It is just not one area that you are focusing. So when we call so just think about it. When you handle a project, is it just balancing time, scope, quality, cost, and how simple it sounds? Is it so simple? So that's what I want to deal with this whole course, where you will see the details of the planning and what should you do. Because definitely I'm sure that as a general project manager, we are all aware because we'll track of things and all. But how to have that discipline so that we become expert? I'm very sure that when we say an expert, that means the expert should have knowledge, immense knowledge, to make good informed decision. He should make, when he or she as a project manager should make his or her team happy. So that's how it is a balance. It's just not the balance scorecard. It is about overall the higher level, that you are aligned with your organizational goals, and also you have a balance with your team where you are aware of their personal goals also. So when we come to about the project management, so what is a project management? When we see what is a project management, let's start with the basic. We'll just brush up our basics. So when we talk about the project management, we have all been there. The project seems to be going along fine, although if we are completely honest that it is failing a bit, and also mentally just we don't keep a extra, because it's not humanly possible that we can keep track of each and every single item, but mentally keeping track of all those little items that you need to make sure get done. Then the client calls with a set of changes. It's a dynamic world. So project management becomes very heavy because of these changes. Because if it is just a straight set of requirement, project management is very easy. You're excited as you think they are getting it, and so you get stuck in straight away. A week later, you're dreading that how it's going. You call because you know you have no idea anymore. You're lost amid or in this whole delivery. You need project management. So basically, why we need this whole field project management? We can just get the client requirement, and I'm talking especially about the software part of it. Like if you are making a software a product, so just we can take a client call, we can make it we can just work on the design, we can deliver it. It doesn't happen because of the changes, whether it is in the software or also when it comes to the manufacturing. We have, when it comes to the different domains, we have different issues when it comes to each domain. So that's why you need a project management. So when it comes to the project management, it definitely, all of us are aware, we have to balance time, scope, quality, and cost. So when it comes to an official definition of project management as per PMI, it defines the term as the application of knowledge, skills, tools, and techniques to project activities to meet project requirements. That means you're applying these tools, skills, and to achieve your project goals. That's what a project manager does. A more tangible description is that project management is everything you need to make a project happen on time and within budget, within the and also deliver within the scope and the needed scope and quality. So when it comes to time and budget, and also the scope and the quality, the time and budget, I'm sure all of you are aware what is the time and budget, right? The time and budget, like let's use this arrow. So time, when we can't talk about the time, that means the client says that you deliver within this time, you have to deliver. Is it that simple? In practical scenario, you trust me, I have handled projects wherein whenever the date is given by the client, at that time I never had that right resources to with the same skill sets to deliver the project. So that's why the project management becomes complex, right? And then the scope. Is it the scope always remain? The requirements always remains the same? No. And quality is altogether a different issues, because nowadays all of the organization are facing quality, because when we have to balance the time and scope, most of the projects nowadays are driven by the clients because of the high competition. And when the sales or the BD team bids the project, though, so the timeline is very tight. They required project very early. So at that kind of tiff, the quality becomes an issue, because at that time to get that kind of resources and deliver, it becomes really difficult. And cost is of course the budget within, so that you are delivering a profitable project to your organization gets profit out of it. So when we talk about the scope, it refers to the list of deliverables or features that have been agreed. These are the features. For example, you are delivering a ERP program. Then the client can agree that I need these transaction, I need these transaction screen, I need these kind of features in the interface, so which is helpful for the user. So when we talk about the quality again, and there are now the organizations are more, they are moving towards a lot of certification like ISO and CMMI, so that there are external audits, so that when the product or the services given to the client, or whether we talk about the FMCG, because ISO applies for all the field, so they are going towards these certification, these documentation, so that we as an organization are following certain standards and also delivering high quality product or service to the client. So when we talk about the four different parameters, the balance is must. There are an interrelationship we should know as a project manager, and the balance is a must. But when it comes to the actual implementation part of it, I know the balance becomes very difficult, because either I can give you a case study from my example. Like I have handled a project, ERP project, where it has been a complete, it has to, we have to just scrap up the old framework which was in the obsolete technology as an IT project manager, and I have to build a new framework and deliver the whole complete application. So the problem with that was that the deadline was given by the client. So in this situation, the time was fixed, and delivering that kind of quality, cost, and all those parameters becomes very difficult, because in that particular time you have to just find out a right team, and then work upon it, and also you have to see that you're not overshooting the budget of the project. So these constraints that I am sure all of us would have faced in some or the other projects, we'll see how to handle these with expert project management. Then comes the understanding the project life cycle. The generic project life cycle is fairly simple. When we say the we are following the SDLC, it is planning, then there is part of it's just I'm just keeping it simple. It's not yeah, PMI has different phases, but here as a general project life cycle which is followed in every company or any small companies, if we follow CMI or not, if we follow ISO or not, it has a three phases. One is you plan, then you definitely execute it, and the controlling is kind of, if it is moved to a support or execution, the controlling comes into place. So basically it starts with an initiating, then planning, then executing, then controlling, and then it goes to the closing phase. Most people spend most of the time working in the executing and controlling phases, actually doing the task, building the product, and making sure everything is on track. Because if you execution is very very important, that we will see later, where that's how in execution, as a project manager, in the execution you have to when it comes to the expert project management, if you see all the successful project managers who have delivered good amount of successful project, definitely they will have one or two failure projects, but when we see about a successful project managers in any organization, then they definitely know how well to execute a project, because there only your major times goes in, and in those phases you are no more an expert project manager knows that he or she has to display the leadership abilities. It is no more just you just call somebody and just assign the work and it gets executed. It never happens, because trust me, we are dealing with people. We are not just dealing with the stationary resources. So when it comes to the, we need to understand the project life cycle. Why? Because where we are going to be, because many organization have many project managers in one project, so they may not involve you in execution, they may ask you to control track the project. So you need to understand in the project life cycle, what is the project life cycle of your project, and where your contribution is, and where you want to where you are going to spend most of your time. And then comes identifying stakeholders and getting things done. It is really a very, very important part. I won't say that it is a basic of project management. I will say that these two parameters are the building blocks of the project management, because you are managing a project, and definitely if you are managing a project, right? So you think about, I'm just giving you an example. Whatever organization you are in a bigger organization, you are in a smaller organization, you are handling a small project or big project, you just think about it. I'll just ask you a question and think about, just do a mind map that, like, when we come to definitely when it comes to project management, at some point of time maybe you have lot listed in the Excel, but at some point of time you would have been identifying stakeholders, because here's what the main job of a project manager is. Like, you need to see, there are you might, if it is a big project, it becomes a very complicated situation, because you will have many stakeholders. Then you have to prioritize, you have to section, like, this is how the communication will flow. Like, I will talk to these top peoples, where I will, you have certain set of conversation, and also you will gauge their expectations, and maybe your team members, your team leads will talk to certain set of clients. So these kind of identifying stakeholders, and also I'm saying it is very important, because as a project manager nowadays, all the organization, whether small or big, they want you to get more business to the company through the project you are handling. So it can happen that you are dealing with one client, and in the same organization they have the potential, if you are delivering very good quality product, that they will give you more project. So that's why the identifying stakeholders and managing the stakeholders are definitely the basic and building blocks of the project management. And definitely then comes getting things done. I'm sure, like, if you don't want to lead a project, or if you don't like to, if you don't know how to get things done, then I don't think we can become a good manager, because this is a basic requirement that you need to understand others, you need to grow up them, treat you should be like a mentor to them. And then when the people, because at the end, people will see what is there for them if they deliver a project, whether they will get promoted or all these things. There are little motivation factors also which comes into the picture. So when it comes to the getting things done, or the then that is also a basic primary skill of a project manager. I want to give you an example in identifying stakeholders and basically knowing your stakeholders. I once worked on a project that was meant to deliver a new software program to a team that collected data from different supermarket and turned into reports. So I think you can imagine the amount of interactions are involved in such projects. The designer was intent on making the program as user friendly as possible, which was definitely a big aim. But sad, a good aim. Definitely, all the clients want it to be very. Even the client wants the interfaces to be the user friendly. So we should also aim as a good product. We should talking about the software. We should make our screens very user friendly. But sadly, his definition of usable was significantly different from that of the actual users. So many a times, I'm very sure that this is a practical issue faced by all of us as a project manager in some point of time, where we will have a interface in the client's organization, and sometimes there is a disconnect between them and their users, end users. Usually what happens, the person will be in IT projects, the persons are always from the IT department of the client organization. So it can happen that they themselves have a disconnect with the users, or they are new to the organization, they don't know the business of their company. So it becomes a disconnect for, because for you can't talk to the end users directly, because that's how the protocol in most of the organizations are followed. You usually have an interface, they talk to their end users, and then you get the requirement from this interface, or your client face of the, so that's how it happens. So the designer had focused on making the software so simple that anyone could use it, even a no voice, when in fact only a very limited number of data entry clerks were going to use it. They were rather upset, discover they weren't to be consulted, and quite disgruntled when they were presented with a system that it appeared would make their work take 4 times longer than before. So basically it turned out to be opposite. The reality was that for them, speed was the most important factor. Ignoring these stakeholders led to disastrous consequences for the project. The entire design was scrapped and 6 months' work had to be redone. So that you can imagine the amount of the rework, the amount of the cost which has been impacted. So this story, what it tells, that basically sometimes the end users, because at the end of for a IT project, the end users give you the approval because they are going to the use the system, and that's how the IT or the technology makes their life easy. But sometimes what happens, the end user is never in the picture while developing the whole software. Then it turns out to be very, very disastrous, because they may have certain primary requirements, for example, the speed. So, but while designing, the client interface would have told you something else. We need to design it simple. So it turns out to be disastrous, because the design is not on the speed, the design on the looks of the interface, or make it on the usability part of it. So it happens, it shows a very clear requirement mismatch. and a communication problem. So that's why identifying the stakeholders and knowing your stakeholders, that's why many company they usually they send some people for the on-site to the client's place, sit with the end users, they just collaborate for the that's how the agile project management has come into the picture, like wherein the it's more about the collaborative approach, which mostly gives you success because you're aware of the user expectation. And one more thing is failing in the planning phase can be equally disastrous for your project. I'm sure these are the basic project management thing. One is failing because you are as a project management manager should be aware of what is to be done, what is priority, what is not the priority. If you don't plan at all, how will you know what you should be doing next? Similarly, planning once the beginning of the project and expecting just be able to follow that is really dangerous because things are not always the same. So that brings up to the our next, we'll see that into the in the next to next session, where we'll see what to plan, why to plan, and how to plan. So, definitely, when it comes to the planning, the best planning approach tends to be one that lets you plan the project's immediate future in detail. Don't you think so? I'll give you a single example that when it comes to the planning, don't you think so? Like we also do it in the personal life. We don't plan it for months, for so we take it's always better, and that too in large project, to take one step forward because it is easy to do it instead of just planning a whole huge thing and then failing. Very very important that you take one step forward, be practical, and that too if you're trying new approaches, it's very important that you try it in a very smaller level. And this is known as a rolling wave approach to planning. The deliverables for the next 3 to 4 weeks are broken down into sections so that it's possible to keep track of the project's progress on day-to-day basis. Anything further off than a month is left unplanned as a high level deliverable so that you can keep an eye on what lies ahead without become overly focused on the minute details. Not paying proper attention to the closure of your project can be just as problematic as poor initiating or planning. If you think your project is finished, when you finish the building the product, then you are definitely it has to be proper closure, proper initiation, and then proper planning. All these comes as a on the basic project management. But what is an expert project management, that we will see later. Like it is about detailed planning, focus on details, and motivating the team, because it's more the execution is major part. So for the execution you definitely need how to motivate your team and also make them as a, and definitely use all those principles of team building, and you enhance your teamwork, and you have to build that feeling in your team that it has to be a teamwork. Because any project, whether it is in manufacturing, it is any project, it can't be just one single person can just complete it. Even it comes to sales and marketing, it's a team effort. Your team is going to put those efforts to get the project closure with the success rate high. So that's how this goes in. Now we will see what are the perceptions, negative perceptions about management. Some perceptions are like it is boring. The first misperception is that project management is an incredible boring distraction from real work. I am sure the technical people, the core technical people, they can. I have always met those people where they say that it's boring because it is better to just do alone the technical design than just managing people. Whatever your current vocation, you are probably engaged in it because you enjoy it and are good at it. Taking time away from what you normally do to focus on a project management just doesn't feel right. I'm sure all of you can connect because we have some or the other team members, or in some point of time, at some point of time, we ourselves would have thought, what is this? You have to, in the initial stages, you have to just deal with this Excel data. That's it. So at the very worst, we should agree that the project management is sometimes many people, I have seen, they think that project management is just Excel. Yeah, it's just data. It does nothing creative. There is nothing creative. There is nothing new, innovative. But I'm sure like it is much more than that. And all of us, when we become an expert, when we spend some time in managing projects, that different projects, I'm sure all of us will agree that it is an art. It's not easy to balance the four parameters so easily and make a project success. It takes huge amount of time to become an expert project management. But trust me, like there are certain skills. If you master those skills, then it doesn't make. I have seen people who have three in IT industry, people who have 3 to 4 years of experience, they have also become an expert project management manager. So it's not about just time, or it take 14 to 15 years to become a project management. Personally, I believe that anyone can pick up project management skills and apply them in a useful manner. You know why? Because I can justify you with an example. Don't you think all of us in some part of the other, if you're in the personal life also, we are managing some of the other projects. It does need not to be a normal corporate project from IT or manufacturing. That in some most of the cases, like if we are managing our finances, it's also a kind of mini project. If we are managing our kids school and other activities, daily routines, it's also it also have a goal, and it is also a kind of management. So in some or the other, we are using as a person, we are using our management skill. Then why then this project management is scary? Have you ever thought about it? I just want to note, it's just to make it more interactive and interesting. I want you to make a note of initial when you were handling the projects initially, what were your negative perceptions about this field management? And I'm sure that I'll ask you this question again after you have gone through these recordings and these trainings, like because it's you will realize that it is not that difficult and it's not that boring once you know the practical sides of it. And also, I think, I don't know, it is a very practical perception people, I don't know, not practical basically. A person people have is that it is just a project managers just deal with Microsoft Office like Excel, PowerPoint, presentation. So I think it is, I'm sure we as a project manager know that it requires much more effort than that. Then definitely there are another negative perception that it is too hard, because it's about the responsibility. It is about the dynamics of the project, because one day the client will come to one change, the other day the clients will come with other changes. So it is not very easy. I agree that it is not very easy, but it is not too hard also. Like any other profession, project management have certain principles and nitty-gritties, and if we master that, we'll become an expert project manager. We have seen the basic project management. What are the negative perceptions of the project management? And I'm sure as project managers, you're aware, because in worldwide, every company is different, and every people have their own perception about the management field. And I'm going to tell you that even as an experienced project manager, I just wonder, initially in the beginning, usually I used to also have, because I'm in the I'm in the software field, and when I was like a team leader, and I used to have a lot of perceptions which were not true in practical sense. And now the world is going digital, and so there are a lot of changes in this field. There is a lot of changes which will come in future. So but there are few basic things which is which leads to a expert project management. So when we talk about the basic foundations, again, I'm stressing on this because the planning, the estimation, and all these things you can definitely get from other courses. But when it comes to the people management, and when it, because at the end, whether whatever domain you're handling, whether it is a manufacturing domain or whether it is a real estate or any domain, at the end you are managing people. And I'm sure people are totally different. And when you want to work as a team and you are the leader of the team and you have a specific goal, any project you take, then the expert project management means you are getting the team along with you with your project goals. That's the basis of the expert project management. And definitely there are, I'm sure you might have templates in your organization. You can learn about the nitty-gritties of the project management through various tools. But there is something with the experience comes is the detail, because you need to understand what are the details which is very specific to each project. So one is detailed and careful planning, another one is leadership skills. I'm definitely saying about this. One is detailed planning and another one is leadership skills. I think all of us will agree. When we handle people and just acting, and I'm just giving you an example. If you're going to handle the project, and I can just give you an example in software field for years, like some projects run for 4 years, 5 years, then just having a task oriented approach, you just call people. Just think about it. You just call people and just give a daily routine task. Is it going to help? I don't think it is going to help, because the dynamics of the project is such that, and in reality, people leave your project and leave the organization. So there are a lot of things which comes in, and there are typical behavioral styles of the people, and then you need a leadership skills. Then only you can promote to the next higher level in your organization. You can gain a experience in the project management field, because at the end, just maintaining excel, just maintaining the data is not a project management job. If you're maintaining, then yeah, in some projects you will be successful, but you need expert judgment for decision making. You need an experience, definitely a leadership skills to handle different type of projects and project teams. Basically, in some teams, the behavior of the people of the team will be totally different. So all these things we'll see in detail. And definitely the another one point is master in execution, because execution is the major chunk of a project management. Yes, you do a good planning, but if you fail in your execution, then definitely the project is going to fail. So major part is when we talk about the planning, leadership skills, and master in execution, we'll see all these with a case study. And first we'll see about the planning, then we'll see about the team building, how to build an high performing team, effective team. Because yes, we can do work, even simple day to day task also we can do. But when we come talk about experience, we talk that we are expert in those tasks. It only comes when we definitely have details about it, we plan it very well, and we execute it very well. There are certain principles in the project management, that is when we talk about the underlying principles of the project management. So I think, I'm sure when we talk about principles, so it's apart from the planning and leadership skills and execution, we have to say that the real work as a project management. And if you're going to see the advance, if you the company relies on you to handle a big project, then definitely what comes is you should have a priority. The real work matter. It can be easy to see project management as a function that's all overhead and no return. This is especially true when you first start to make use of the approaches and practices. But you can be rest assured that your project management work will become much easier with practice. That's what we say that an expert, right? Any task, it is not only for the project management, any task, when you become an expert, when it is about that, you practice it and you practice the principles. Even if project management really was a boring, tedious, and difficult as some people assume it to be, it would still be worth doing. The reason I believe this point to be fundamentally true, because at the end we need project managers. We can't just have the team. It's not possible, because at the end the people are involved, and as I told, different people have a different styles, and just people can't come together and finish a project. It is never going to happen in that way. Then second is main point is people problems can't be solved with software. I think all of you will agree with me. With all the modern technology now, all the techniques and everything. But at the end, people are complicated. People issues are different. Different people. I have an experience that the same team which I have led, from which I have worked as a project manager in one software team, and the same set of people does not perform at the same level in another project. So this kind of behavior is very complex. When you start work on a new project, look at the situation and identify the people and the process problems separately. This is the where I think when we come to the expert project management, I want to again and again emphasize that yes, basic project management we all do, like we make an Excel, we define a to-do list, we have issues identify. But when it comes to success in the project management, when we talk about the expert project management, the success of the project rate becomes high. That is why, because we are aware of the people's behavior, and we motivate them and enhance the team building, teamwork processes. So first of all, when you are being given a big project or a small team or a big team, first of all you need to identify the people issues. I really believe it. And it has to be separate. For example, I had a team where initially I've been given freshers. Again, I'm talking about the software product to be built within a given time from the client. And the freshers, they were not very confident, so there were a lot of issues. So first of all, we need to identify. Sometimes it could be a technical issues, like they are not confident about the technology and all those things. Sometimes it could be really conflicts. So these are the things which we definitely deal in detail, and I'm sure that you are going to enjoy this whole thing, because you will learn a lot of things which which can be practically applied. It is not about the technicality. I'm sure that as a project manager, as a basic level of we all do a scheduling, we all do a prioritization. But there are I even believe in day to day life, there are certain details. If we miss out that, our whole it can become not so organized. So same applies to the project also. If you're not organized, if you're not disciplined, and if you overlook certain issues, your project will definitely will be a failure. Let's see what is the next one. All about the plan. Before moving into the planning part, I would like to understand that definitely as a project manager we are all aware that what is to be done, what is not to be done. But there is one simple point: if it doesn't add value to your project, then you should not do it, you should not plan it. That's what the basic step of the planning is. As you become more of a project manager, you will find you have a long list. And I have definitely faced this in major cases of the software project management. As a software project manager, always there will be some requirement from various departments of the client. And also there are some issues, like because when we deal about the technical things, there could be some software configuration issues, there could be some tool upgradation issues. So all these things, I'm not saying that they are low priority, but as a project manager, as an expert project manager, the first and the primary thing when we are about to plan these things has to be have to be prioritized. Prioritizing is the basic step for achieving a good success rate for your project. That is the first thing. So when you say that, because you need to, when you include it in plan, unimportant things, you need to track it. So there is a lot of overhead which comes with that. Because when we say, so when track exactly how much time team members spend coding each new feature, detail exactly which budget element. So there are a lot of budget element is included, or it needs to be put in the costing of the project. So all these things matters. There are n number of example. I'm sure you will also have an example. For example, I can say that in practical sense, there are a huge project I used to handle, the redesigning of a framework of the old framework to a new framework, in those cases there are n number of things which comes as like, for example, whether we should first document all. Yes, documentation is important, but when the client has given you deadline and your team doesn't know the technology, so what you will prioritize first? So these angles, these things definitely need to be analyzed as a project manager. And I want to, just as an exercise, first think about your project, and have you ever prioritized which are adding value to your project and which items are not adding value to your project, and see your plan, and you can definitely be more efficient than ever. And one more thing is, the best tool is the one that works and gets used. I have always seen that when because various project, when we talk about the software or any other, because now the automation is everywhere, that IT department is running everywhere. So first of all, we come the organization spends a lot of money in investing on those tools, so that the life of the users become easy and the work is more efficient, so you have more return on investment. But my question is, when uh, I have seen, trust me, I have seen various clients or various clients of mine who have just, as an in the IT department, they just buy the tool, but when it comes to the usage, it's just, it becomes obsolete. They don't use it to the utility is very low. So again, as a project manager of your department, you have to see whether it is really going to be used or not. Just talking and just, yes, we will buy this, and then it's not getting used. So basically, like the lean principles of that states that we have to reduce waste, like that we have to eliminate all these kind of cost which can occur to the company because we are not going to use it. So there are many organization which they spend lot of amount in the name of productivity increase and buy some tool which are never going to be used. Again, there is one another point when we talk about planning, and definitely these planning and a lot of things which, because just planning, I have seen many project managers, they plan very well, and definitely they plan to the detail, and but when it comes to the communication to the team, they don't communicate. So they really definitely, I know, you can imagine the results, because see, most of the time it is not intentional, because we don't as a project manager, there are n number of tasks in our task to be handled, but communication is the key, because many project managers fail in that. So as a expert, if you want to become an expert project manager, the best way is to communicate that, so that, or in an effective way, so that it gets you heard. Because I've seen many project managers, they don't have a effective communication, so the team won't understand it, and then it becomes really in day to day routine, it is very difficult. Choosing the right form, method, and content for your communication is hugely important to your project success. Communication is an area in which it's particularly important to understand organizational culture. Which statement is really just management speak for the saying, or it is all having a, what kind of jargon you will use when you will have meetings, and what kind of email structure you have, because everything is dependent upon your organization culture also. I have seen, I will tell you one instance which has happened to me in a project. I have taken a vacation for 5 to 10 days due to some personal reason in my project. My project leader, then she has to handle that whole project. But what happened that she was really planning very well, and she was technically very good. But the major failure happened, and the client has escalated, is that the communication was not happening. The client was not knowing that we were really doing work. So this one part is very important, because when it comes to project manager, the whole entire team, there are a lot of dependencies created day by day. So it is very important that you need to analyze, and you need to groom your next level also on the, because it can happen, right? Like you can move, you can be transferred to different project, different department. So then what you will do? So these are the minute level of details that matters for the project success. Then again, the last, which is definitely a very important point, that you have to choose your tools and processes right. That is the primary. Like for planning some because if you are having if you are going to handle a large team of 50 to 100 team members, then the planning just in excel won't help. And I'm sure again it is also dependent on the organization structure. For example, in some companies they have inbuilt a software tool which tracks also, like you plan in a Microsoft project, and the people put their time on the WBS, on actually how much hours they have worked in each task. Then you can generate reports, and accordingly it also can generate the budgeted, the cost of the project. So all these things you can do it in a tool. So when you it comes to the tool, sometimes I have taken tools. For example, the client, it depends on the client also, like if they were not understanding our requirement in a just word doc format. Again, I'm talking about the software project. So in that sense, what happens, just you give the they won't come back that we don't understand. So the it was delaying the whole process of requirement sign off. So we just approached the client and understood the problem. So then we took the Visio tool where we can make certain diagrams in an activity. Certain clients are comfortable with the diagrams. So all these things definitely is the work of the manager, where he or she sees whether there is any lag in the process, and or any tools which are getting underutilized, and accordingly you can just implement those in your project. Again, if we talk about the processes, so when it comes to the process, the main point when it comes for the team, it's important that there are certain critical processes for certain types of project. For example, if the client is paying you, I'm again talking about the software product, that if your client is paying you per hour or on those basis, so then time and material basis, the contract is like that, then definitely it is important to have timesheets of your resources who are billable. So all these things, so certain projects I have seen that the project managers miss all these things, and it becomes very not so organized, and then it becomes very chaotic on day to day life. These are some of the examples. I'm sure you will have your own story, you will have your own practical applications. So just check, just analyze that in your project, what are the process lags you have, and what will be the prioritization you will do for getting this project into an effective manner. Now I will ask you a question, and you have to answer it diligently and analyze. Have you ever failed in project planning? Just think about it. I'm sure practically, as a humanly, it is not possible that we are always, and that too when we start as a project manager, it's not possible that we are always successful. It's not possible because we could have overlooked certain areas, we could have underestimated our project or overestimated our project. And also planning comes with an expert judgment, because when I can talk about the software projects wherein there are certain new technologies involved, and sometimes as expected we can't in execution we can also go wrong, because the resources might not be available, or we would have thought about design something and it has changed. So all these comes in the picture. And also planning is, I'm again talking about the software scenario. Planning hugely depends on the client requirement also. If your client requirements keep on changing, then definitely it is then your plan becomes weak. Because I have seen many times in my project management, when I have taken project management work for large projects. So in such cases, certain times the client himself or herself is not clear about certain requirements. They are not clear about certain requirements, and they keep on changing the requirements. So all these things have definitely high impact on our planning, because our planning is not then study. So I just want to think about it. Have you any time done over or underestimation? I'm sure it happens. So I just want you to list down those things and see what you have done, because again I'm just emphasizing on the point that when we say that we are expert project managers, we have to learn from our failures, because at the end failures are inevitable. And like all the successful people say that we have to learn from the failures, then how that's how we become an expert or successful, right? So if you have failed in the project planning, please analyze whether you have overestimated or underestimated, or it might happen in practical situation. I'll tell you that you would have overlooked certain issues, because sometimes I have literally, or I have also practically experienced it, that in some project, for example, we can take a simple web designing project. So when we talk about web designing, then there are a lot of interface which comes in. And now the world is moving into the digital world, right? Like everybody is online, and definitely the companies are more focusing on their website more than ever before, because to reach out to millions of people across the world, across the globe. So when we talk about such a website designing project, so what is now the current trend is that we need to put SEO or the digital marketing keywords so that more people get their pages in the Google search. So all these things have come up. So when we talk about it, so definitely when we talk about the content, I'm sure there are project managers who have dealt digital marketing projects, so online projects. So when we talk about the website designing, one is the interface, and nowadays the content becomes very important, because the website is the face of the company digitally online. So it has to be represented very well, so that even you get more clients on the basis of your website content, your B log, what products you're offering, and what services you can give. And at the end, it is about, because they are new to your company's name. If you're a startup, then these things definitely have an impact. So what I'm saying is, in those kind of, when we are building website for a startup, if you say, the brand becomes very important, because many companies don't know the company name. So in those places you need to know how to present the content. So project planning can fail in those areas if we have not properly planned the content well, or the user is expecting, your client is expecting something else, because startups usually because they have just started, so they don't have a clear vision, depends on the client to client basis. Again, it is according to your own personal basis, what experience you have project to project. But certain times we can fail in the planning if the client does not know what exactly the website content should be, or he's not clear about he or she is not clear about the digital, how it should, we should go online. So in those cases, we need not to worry, we can collaboratively work with the client. And yeah, we can work on an agile model where we can try prototypes and then just release it out and see the responses, and then you can make changes. So don't worry. Yes, I'm talking about, this is a simple scenario. In website design also, if the interface, regarding the interface, some people like it very flashy, or the design perspective, some people will like it very subtle, very professional. It also depends on the domain the client is in, right? If it is an entertainment industry, it is a different design people will prefer. And if it is another professional side, so it all depends on the client, which domain they are in. So when we talk about failure in project planning, it mainly occurs due to frequent changes, requirement changes. And if there is no clarity in the requirement itself, then how can you plan? If because the planning fits can occur only if proper planning can occur only if the scope is very well defined. You are very clear what you want to deliver. So, and that is one thing. And second thing is, the project planning can also in technical part, I'm talking about whether we see about NASA or any other case study, then there is a lot of technicalities involved. So in some stages the complexities were underestimated. In such cases also the planning can go wrong. So don't worry, we have solution for everything, and as an expert we'll learn things and we'll see how we can make it clear, and how we can be organized so such things can be avoided, or we can have some judgment so that future projects we handle it well. I'm sure you would have got good points and also analyzed yourself in the situation. And don't worry, because failure is necessary to have a experienced judgment as a project manager. Let's move on to the next. Now, as a project manager, what is the main thing? It is, of course, getting things done from your team, right? So, when we say about getting things done, there are certain principles in project management, like identifying your constraints of the project, how you plan, and why the planning is needed, what to plan. There are a number of things which comes into the mind. Definitely, planning is very important. We all will agree. Planning is the important phase of your project. And the whole thing, if you plan or not plan properly, then the whole project will fail. So the first step is to plan well. So there are multiple things we'll see: why to plan, what to plan, and how to plan. Then comes the identifying dependencies of the project. So when we talk about the project, I'm sure in certain organizations they have the template wherein we have to the project managers have to create planning, and there is certain sections called there is any dependency. I can give you an example for this dependency. What is the for example, you take your project. For example, I have a project which has to be built from the scratch. It is a software product, ERP, with the huge user base. 500 users are using it across the across my country, across various regions. Then what is the definitely in such a huge scale of project, there is to be dependency. For example, if I'm building a new framework in a new technology, then what are the dependencies? Definitely I need to know that the business logic, and whether if I move to the new technology, then how to scrap this old technology. And because already the users are using those technologies which is in the production in the online, so how I migrate from this, these are dependency, right? And how the business logic from the old framework can it be reused. So those are the angles that we as a project manager we need to think, so that our life become easy. And definitely then comes, this was the software part, then comes the resource part of it, the people part of it, that how much you are dependent upon your core resources. What happens many a times in various project in various domains, we have certain experts because they have become experts in your team, because they have spent so much of time in your project. And and then of course as a human tendency will give them more responsibility. So it becomes a people dependent project. So it is must as a project manager that you transfer that knowledge, you always have a backup. If it is a large project, if it is not possible that your project budget is not that much that you can have backup for those resources, those people, then for those team members basically, so then you can have those things documented. That's how it works, because now the environment is highly competitive, and also people leave, they leave to different organizations, so they carry the knowledge with them. So it's very important to document those knowledge. And that's how it goes in large project and complex projects, and even small projects you can you need to have documentation. Then comes the major part of it is estimating time. I'm sure all of you are aware of estimation, but there are certain things that we need to consider while estimating. That's how the expert project management comes into the picture. That what are the dependency, and have you underestimated or overestimated the project, and adding contingencies. This is the basic, because sometimes under pressure of the client or somewhere we are always, because we have to handle n number of things, like whether it's client pressure or team pressure, we sometimes forget all these kind of details. You will be adding contingencies, but it is important to see the practical contingency. Sometimes we overlook issues, that's how the project fail. So these are the main pointers that comes into the planning, identifying dependency and estimating time. Why should we plan? That's the first basic question, right? Why should we plan? We could just get the requirements. If your client is very clear about the requirements, we can just start working. It's very important that we need to plan because there are good reasons. First is to understand your project better, because if you don't plan anything, even in day to day life, if you're not organized, already speaking and theoretically it looks very simple, but when it comes to the actual implementation and execution part of it, I have dealt with the bigger projects, with bigger maintenance projects, and especially in financial sectors like insurance, they always come up because it's not their fault, because the rules keep changing, or the financial, the market is so dynamic. So making those changes in the product, it's important to first of all know what is your project about as a project manager. Then only you can make those changes and argue with the client that it is going to be correct or it is not going to be correct. So that is one part of it. There are certain situation, it's always not that you're involved in that project for from the beginning. I have seen projects, software projects running for years, and certain time people, the project managers come, those who were in the initial phase, they were not in the support phase. So in such cases, to know the client better, to know the project better, it is important to plan that. Then it is definitely to work out the best way to approach things, to communicate to both your team and the client or customer exactly how the project is going to be approached. So at the end, it is about the communication. If I have seen many project managers, I think definitely where they were very good managers, they plan everything in their head, but they don't communicate to the team. And I have seen many people like that who are potential project managers, but since due to this part that they don't communicate to both client and team, they they were not able to, yeah, then it's they're not able to perform in the capacity of project manager. So the basic thing is, yes, you plan it, but if unless and until you communicate to the customer and the team, then how they will understand what you're doing? And especially in software projects where the deliverable comes after you have tested, after your team has worked it technically, coding take place, then after some time only the end product the reaches to in the hands of customer. So it's very important to plan so that you take the client also in confidence. Yes, see, we are doing something to help you get work done and keep track of progress. And again, it is to work out the best way to approach things and to track things very clearly. Because I have seen when I was on leave in certain projects, my project leaders have taken over. So in those cases, the things becomes chaotic, disorganized. So yes, you have issues to work out, you have certain things to work out, but it can happen that it's not yeah, technically you might be providing solution, but if you miss on these parts like communicating to the client, tracking, then definitely your project is going to be failed, because it it has a culminative effect, and your client won't understand what is happening. Then they start making noises, and also it becomes a point of escalation. You trust me, I have seen such projects where the project managers have planned very well, and they were executing, they were doing the work behind, back of the project, but since they have not communicated to the customer, it becomes a very big issues. I have seen such projects getting failure because customer felt that we are not updating them properly, so that these comes. So what, again I'm stressing that as a expert project manager, first you need to understand why we need a plan in place, so that we can track it better and to communicate to the customer better, and to provide direction to the team. Because if you don't have a clarity, then definitely your team won't have the clarity. Sometimes planning is just as about the process as the eventual end result. Planning can be useful simply because it allows you to allocate time to really thinking about how the project will be achieved. And again, it is kind of lean principles that planning helps you to focus on the priority things and leave behind the non, because that's how day to day I usually sit with a plan on daily basis, because it's important. There are projects I have handled where the client changes, they themselves are not clear, they change the requirements so quickly, so it becomes important to maintain the track. This process will help you understand your project better. You will have outlined the biggest chunk of work, you will understand what needs to be delivered, and you will note any dependency to play in the project. Likewise, a better understanding of the project will entail can it can help you identify the best approach of tackling it. Are you going to be able to give estimates because you have done similar projects in the past, or in this project as a whole world of unknown complexities are there? So again, it can happen that you have a plan, then all these comes into the picture first of all internally to you, because it can happen that you have dealt such projects before, so you can take the experience ahead and make those estimations and use those judgments. Or I have handled a completely new project wherein I was not aware of anything, and I have not handled similar project. In those cases, then the planning will help you to ask for the external support, not external, basically external from your project. Actually, in the same company you can reach out to your PMOs. In many organizations there are PMOs who are coming, and they can help you in planning, because that's how it is. Because project management is nothing that you can just sit alone and just plan. It's not going to work out. Plans are often most valuable as a shared understanding how the project is going to be approached. Once you move on from tiny project from which you and your laptop are the only resources required, you will realize how valuable plans can be. So once you have made that, I know initially the people who are in the basic project management, they might be thinking is it worthwhile? I know in my mind what is to be done. But trust me, there are a lot of there are a lot of companies who are coming up with like I mentioned earlier, who are coming with ideas that they have tools, software tools, project management tools, which helps in end to end tracking. Like first you can plan, keep the plan ready in those tools, and then you can track those with your team, so it becomes a traceability kind of thing. And then you can also even see whether you're on but you're operating within the budget of the project. So that's how it is. Of course, again, there is thing we need to have a balance as a project management. It doesn't mean that the plan should be full of minute detail. It isn't a replacement for your personal to-do list. First of all, many project managers, they misunderstand plan. They overdo things. That also becomes overwhelming. Because imagine on day-to-day basis, I can just ask you a question. Like in on day-to-day basis, if you start planning in so detail how your life will be, because there are a lot of dynamics, there are a lot of unpredictability in the world, and in the client's world they will keep on coming and changing the requirement. Then if you start changing it, that is also not practical, that is not humanly plausible. So nor should you spend more time updating the percentage complete figures on the plan than doing actual work. So again, there is a balance about everything. So it's not like you should just keep on updating, then you will be doing just that, you will be only planning. And I have seen many project managers, they are failing because they are not having connection with the ground level. I have read in once Jack Wells and the big leaders autobiography and books, where they have told about how the leadership is. So always in those companies like GE and the bigger companies which are very successful, what they have done is they have a connection, the leaders have a connection with the ground level reality, because that's how. So if you keep planning and just keep updating it, you will lose your touch with the team and don't know what actually is happening. Then you become just a high level planner. So that's also we don't need, right? So it is important to keep a balance. And basically you need to understand the planning is to have to basically provide your team a direction, and so that you also identify what are the constraints in the project, what is the direction you will be going, because without plan nothing is going to happen. And it is a direction which will guide you, your team and client, and you can work collaboratively. I have seen projects wherein I have worked, because that's again a project manager's job. As an expert project manager, you need to talk to the client. I have done in many of my projects wherein I have asked that if this project is going to be successful, and especially in software projects, believe me, if we don't work it collaboratively, the project and product is going to fail. Because the client, we will be developing something and then giving it to the client, it comes back and forth. To avoid that, it is better to talk to the client representative and say that we can make it collaborative, we can include them in the planning stage. Again, it depends on the situation you are in, whether your client is cooperative and you have that kind of a relationship with the customer, and also whether the client himself or herself is very clear about the requirement. So these dynamics depends upon the project, and that's where the expert project management comes in the picture, where you are going to sit and analyze that what kind of approach I have made a plan. So what kind of planning, till what detail I should share it to the customer, whether I should share it to the whole level of detail, so that we can have a collaborative planning. We have done in many projects wherein we since my team was very new to the ERP application, and we have collaborated with the customer, and they used to transfer the function knowledge, and with our technical knowledge we built an excellent product. So in that way, these things takes very much time and efforts from both the team and from the customer team side. So but it, and trust me, it is not that it can't happen. We have a lot of assumptions in as a manager. Trust me, I also had it. So we should forego those things, and just if we keep an open mind, because of the day to day issues as a project manager we face, we always lose this upper, the higher level thing which actually needs to be done. So once we focus on these as an expert manager, our plans and our project will be successful. Now we have seen why we need planning, then we'll see how what to plan and how to plan. So when we come to the point what to plan, this looks a very trivial question, but trust me, these are the small thing which we think it is small, but this plays a major role in project success, and also it makes you an expert or a expert project manager. Because at the end, you need to have a definite scope to plan, right? And also you need to pick which is important and for the project time being for currently, and which is not. So definitely when we speak about what to plan, the deliverables part comes in. Traditional project planning is focused around task, and that basically because there was clear requirement. So when there are clear requirements, you can definitely plan like that. You can just say these are the tasks and it's going to happen. But now the world has becoming dynamic. There are, and I think all of you will agree, there are n number of things comes up in day to day planning. So it can't be just a task focus, and at the end again, I'm just emphasizing on the part that we are dealing with a team which consists of 50 members or 100 members. Then it can't happen that we just focus on the task and things will get done. It is impractical to assume that. So you come up with daily some or the other people issues. The people might be sick, they might be going on vacation. So many things comes into. So jobs that you need to do or actions you need to take, that is just not the thing. At a first glance, this might seem sensible. A task based plan will literally give you a list of items that you need to do, like to do lists for the entire project. But what is the problem with the task based approaches, however, is that they are hard to measure. I think all of us will agree that our day to day life will become easy as a project manager when you split the task. I always say that we need to split the task, the deliverables in such a manner, in a such a manner so that the it is measurable, like so that how you will track if you can't measure those tasks, it will not be easy, right? Like how when you ask a team member, like, have you completed this work or not, that the task should be measurable so that they can say yes, this is 80% complete, this is 100% complete, likewise. So if you have a, because these helps in the tracking, if you have a measurable task, if you have completed 80% of your task, does that mean that 80% of the project is complete? How can you measure whether a task is 10% complete or 90% complete? This problem is particularly common in knowledge work, where there are a lot of there are difficulties in sometimes in developing algorithm or designing the right layout, which can take much more time than we expected. So I agree completely to this, that when we break down the deliverables, when we are planning the deliverables, then it is very important. Again, this all depends on the type of the project. There can be a situation where you are handling a project which is very simple, like you know the project very well, you know the client's business very well, and it is just a simple change request, the project, small project where it scope is well defined, then okay, the task base would really fit in, and also here the team also knows the job well, then it is fine. But when it comes to a large project, when it comes to a highly complicated project where you have to build in from the scratch in the software area, or if you take any other real time project in construction business or something like that, then definitely the task base, yes, this is to be done, and it is not going to be useful because the world has become agile. So you have daily some or the other issues coming up. And also what happens in these task based, when we usually nowadays we have project, because the technology is moving fast, and we have in software a lot of projects where the team and ourselves, we are not aware of the technology, we are not aware of their advantage and disadvantage, how to use it. So in those cases, you yourself, if you're not knowing the domain, if you're not knowing the technology, then how you will be able to plan it, right? And because you're yourself not sure, so if the team is telling it has completed the work or not, you will not be able to gauge it. The similar problem I have faced when I was planning a new project. I was building from the scratch an ERP project, which has to have, first of all, we need to study the old framework, and we need to come up with the disadvantage and provide a solution. In this case, there were a lot of options and available, so we ourselves were not sure. So we have to take the external technical expertise help, and then come to a planning. And in those cases, in those such kind of project, you need to even take the help of the expertise to groom, to mentor your team and yourself to the with that new technology. So that's why the task based approach in those kind of project is not helpful. So if we are not planning tasks, then what we should plan instead? So that is where the comes the part is deliverables. If you're uncertain, I'm sure 80% of the project nowadays, and especially in software industry, we are uncertain because of the lot of complexities involved. So, and sometimes, as I earlier again and again telling, the client itself is not sure, because there is a disconnect between the end user and the client, and it become, then when we deliver the project, then these things comes up in the picture, when it was when the user does not accept the product. So when on such occasion, when we are not sure about the situation, then comes the deliverables in the deliverables comes into the picture. We should plan deliverable, the actual end product of your project. It can be machines, building, cash, or intangible like software, a brand identity, and so on. These deliverables depends on the project you are working on, and also it depends on the situation to situation. As an expert project manager, it is your duty to identify deliverables. When we say deliverables, again, to avoid unnecessary headache and overhead, and it becomes, the planning becomes an overhead, it should not come to a situation where the planning itself becomes an overhead. You should know what are the deliverables, like even in uncertain situation, right? Like we can have, yeah, we are building a prototype that can be a deliverable. So in each situation, there can be deliverables which entirely depends upon your project. The difference between a task and a deliverable is that the task is a job you are busy doing, like building, designing, creating, while the deliverable is a product you end up with, like the end product, a document, a design. So when, as a project manager, when the planning is focused on deliverables, there is high point of clarity, and also the client will also be happy that you're working on something, and it is easy to communicate. With some tasks, it can be difficult to identify the associated deliverables, but you should always focus on the end product rather than the task itself. For instance, in a software project, the team might spend a lot of time on the task of writing documentation, detailing the designs. But what really matters at the end of the day is the documentation or design itself. I have seen lot of projects, and even I have committed those. I'm specifying that in this project manager's course, I want to give you practical examples where, as a manager, maybe we have committed those mistakes, so that as an experienced project manager, we don't repeat it further. So I have done in many project when initially when I was handling a project of a small team. Then I used to be very process oriented, but to the extent that I didn't maintain the balance, and the team always used to focus on the documentation, get the sign off, and then we will start the work. But in actual scenario, I'll tell you what happened if you're too focused on those things. Like there are projects where the client pays you on the fixed big contract, that if you deliver something, then the billing happens. So it's important for the project manager to plan the deliverables, the end product. And if you start focusing too much on documentation also, it's very bad, because in client side also, it's not the only project they are handling. So then it becomes that your team will give the documentation and then they will sign off. Sometimes the rigidity is not possible practically, right? So that's why it is important that we should know how much percentage of our time, team's time, should go in the in the documentation writing, and these things we can plan accordingly. The perils of the percentage complete measuring, if you see the perils of the percentage complete, because when your senior management asks what okay, for a deliverable, which stage you are in, because always you can't, especially in the software products, you can't show them a product because it takes certain time, and if it is a new technology, it takes more time. So in those cases, what you will do, then you will say, yes, this requirement phases this much complete, this much percentage complete. Measuring the percentage of tasks complete or similar technique is an extremely dangerous practice. Sometimes the biggest problem that it is very subjective, meaning that if I say 10% complete, 90% complete, so why is this a problem? It is again, it I'm saying the percentage complete could be definitely problematic in some stages, because it is, when we say 10% complete, it is on a very high level, we are not detailing out. So if we are planning the deliverables, so we can show to our senior management also, I'm sure they will agree that yes, we have completed the prototyping, we have complete. So that become that is more sensible in say than saying yes, the project is completed 10%. That doesn't define anything. The problem of percentage complete is people are over optimistic. How often have you thought something would take half the amount time that it actually took? And sometimes it's not honest, and sometimes when the senior, I've seen in senior management review, and even in your own review, when you are asking your team, I have seen, I'm giving these tips so that we don't make these mistakes again and we learn from these mistakes, is I have seen in many of the projects, in when I used to handle initially, I used to ask the team, okay, this task and the general task, how much is complete? This is especially it happens in the software project team, where they'll say, yes, this product is 50% complete, this product is 60% complete. But that doesn't, because you can't discuss those, it becomes very higher level. So when we talk about the deliverables, then the tracking becomes easier, then we won't have last moment surprises, and actually your project in myself, I have handled such team where then the people come to you and say that, yes ma'am, this is completed, and then again the project has not been completed, or then we have to face the deadline has not been achieved. So all these things we have faced. Then works up expands to fill the available item. Even if a task seems to be half done after 2 days, if you have allocated 6 days to it, there's a good chance that it will take 6 days to achieve. Because when we say percentage complete, it becomes very difficult. And yeah, we will be assuming something, so the tracking becomes very higher level. So we have seen, and definitely the next point will be not to be over optimistic. Now, how to plan? This is a very, very critical part in overall planning. You know why to plan? Then now, if you're very clear about what to plan, then how to plan. Every organization have definitely some template, whether you're following the CMI or you're not following any proper structure like ISO or anything. But every organization may be having certain, maybe some people will, project managers might be doing it in Excel. But what is the basics of the project plan is, you need to break down the complex work into pieces. That's where the whole point is, because so that it is easy to track. So when we say that the whole work need to the complex work, because when we start, if especially in the new development projects in software or in any other construction business, that in the initial phase when the client is giving requirement, it might feel like a ocean. I have dealt with such project, like if you're building an ERP, a huge scale project from the scratch, then it looks like an ocean. Oh my god, like we have to do so many things. But that's why it's a human tendency. So it is better to break down into phases, and that's how the agile project management and all comes into the picture, where the client gets involved and it is built in phases. So iteration after iteration, and then it has been dealt. And if you're following the SDLC methodology, the traditional methodology, then it is better to break down the complex work into pieces. Then comes identify dependencies, focus on true dependencies. See, in a project, there could be n number of dependencies, because when it comes to the real time project, when you're handling a large project, so there could be dependencies on resources, there could be dependencies core. Sometimes it is also dependent on the clients, because the client will have the major functional knowledge and they will dictate your direction of the project. So there could be n number of dependencies. But what are your true dependencies, where if those are not, it is actually, if those are not identified, your project could fail. Here this is a focus point, because in expert project management, if you see the project managers who are mostly successful, they do all these things methodologically. They are organized. When a project comes, they will try to break down the complex work into pieces, because simple tracking makes your life easy as a project manager. Then identify the dependencies and the constraints, and estimate how long each piece will take. The estimation plays a very major role, because if in majorly software projects, the estimation, not even software project, like any other project, the estimation tells you how much time you are going to take, how much cost is involved in the project, whether you will be within the budget or not. So all these things depends on estimation. And I'm sure in practical situation, the estimation never, it cannot be never perfect, because the initial, when we are when in the bidding stage of the project, the client would have given an overall high level requirement. Then comes one estimation, and then comes the next estimation. When you come to know the detailed requirement, then your estimation kind of keep changing. So always you should have a process of convincing your customer that this estimation can change, and the re-estimation needs to be approved if it is logical. Then comes adding, so these all has to be mentioned in the scope of the work when the contract is given, because many a client, they don't feel that they will be estimating, and they have illogical demands that yes, one shot estimation is enough. It's never possible, because estimation keeps changing, because your requirements keep changing, so it all happens. Then adding contingency, it is definitely required for budgeting. Then definitely considering the risk. Why considering the risk is the major part. And yeah, when I started as a project manager at the very fresher level, then definitely I was not able to find risk that much, because I was we overlook certain things. Sometimes the risk comes in many forms. We would think, because sometimes the risk, like for example, I can give you an example that we have identified the risk, but sometimes the risk takes more prioritization because it needs to be handled currently. We need to prioritize this risk and have the mitigation plan accordingly. For example, in software cases itself, sometimes the team, when in the initial stage, the configuration tool or certain tools which your project is using, it might not might not feel, yeah, that tool is required currently. We just say that yeah, we will require it later, in the later phases of the project. But it can happen that without the tool you can't your team can't move forward. So there are certain risks, and the risks considering the people involved, like if this resource takes leave or long leave, then your projects can impact, you can have a high impact, or you in those situations you need to have a backup. So the risk identification and mitigation is the main where the project are failed, or they can be, you can avert or you can avoid failures by identifying the correct risk in your project. So it requires a day to day monitoring of the project. Then also there is representing the plan in a format that the team, board, and the stakeholders will understand and follow. So we'll see all those breakdown, the complex that is your WBS Gantt chart. I'm sure all of you might have used it in your projects, and also it is just a brush up of these knowledge because we are talking about project management. And definitely project management starts with the planning with WBS. And but I will give you tips what can help you, which can help you in practical projects, like identifying dependency. I'm giving you an this end of the session exercise. You just go to your project and see, first of all, are you using a WBS? Are you breaking down your complex work into pieces? If not, start doing it. And second is how you are doing it, like whether you are in the WBS, whether the deliverables are the end product or just you're defining a percentage complete on it. So just analyze it. And second, the main priority point is, have you identified the dependencies on your project? Because I'm sure I can give you an example, but for your project, it might be totally different. It could be a people issue. It could sometimes, trust me, it is sometimes the dependency could be the team dynamics, because the project is so knitted that it is codependent on other tasks, and it needs to have a team dynamics. So that could be also a dependency, that one work needs to be, it's a sequential project, that one team, your project itself is subdivided into teams, and one work has to be completed, then only the other can start. So there are complex projects in the world, so you need to identify what are the dependencies on your project, and then come up with whether it is on track. It is because dependencies we should try to remove the dependencies. If not possible, then it should be under control. Then estimating time, definitely you need to go back to your project, see how you estimate, and have you added any contingency, and how you do a risk management, how you do risk management for your project. Whether we are talking about the basic project management or the advanced project management, or whatever the term we give it, we all need to accept that planning is an important part of project management. And when it comes to the advanced project management and advanced for the people who we call as an expert project managers, they know how to plan very well, and they keep their life simple because the projects are unpredictable. The changes are always the customer will come with a change, and that could be so dynamic that the customer wants it in 1 or 2 days. So all these things, it's important, very very. Let's have first the pointer here so that it's easy for us. So it's very important to have breaking down the deliverables. I'm sure that in day to day life also, when we plan, I think most of us do a family budget, or we uh, we do financial planning. So what you do to see that whether your cost is not, you are not spending more, so you break down into small pieces, right, to track it. So similarly, when you are planning a vacation, then you delegate so that a particular itinerary to someone, or you delegate certain buying or shopping to someone. So likewise, all the task has to be made simple so that it is easy to track. That's how the project management also goes. It's a very simple example, but we will see more examples. But this again, breaking down the deliverables depends from project to project. So let's see the first pointer. The items need to be achievable and measurable. Again, I'm saying that the planning, the breaking down the deliverables, it depends from project to project. Let's see a IT scenario, IT project scenario, wherein you have a just we'll take two scenarios. One is very simple situation where you are the project manager for years in that project, and this client comes with a small change, but since it is not that small, you need to convert it to project. So you can just see that how it can be divided into deliverables, right? So that is one situation. So you are in control of the project, you know about the project very well, and you and your team are very well, because if you're working in that project for years, 4 to 5 years is enough to be functional and technical expert for the project, right? So then you are very clear of the requirement also, and you know the client very well. In such situation, the breaking down the deliverables becomes very easy. You know exactly if there is some change in the existing system, it's very easy. Similarly, when you are construction in the construction business or in any domain, the existing to change, so there are some projects which need changes in the existing system. So those things where which is running for years, and it needs just a small tweaking up of certain logics, where in technical, in IT industry or in other industry, it is you are very well aware of the whole thing, and you are in control of the situation. Then the breaking down of the deliverables, it is very easy, and for those project managers it is easy to achieve, and you can break down into achievable and measurable format. So I will again give you one scenario. Most of you who would have gone for leadership trainings, corporate leadership trainings, they always say that your goal, whether it is yourself, you're setting a goal in your life, or if you're setting a goal for your project, it should be smart, wherein the M, it is the measurable goal. It's always practical. For example, it's important that if you keep those goals or those tasks, the deliverable, achievable, easy to track. Most of the project managers, why they are not able to achieve the plan, or they skip the deadline because of this, because they prepare very high level of planning, even though they were in control of the project. I have seen in many cases that like my project leaders or even my peer project managers, they fail the project even though it is small and it could have been achieved. But since they have unrealistic expectations from the team and they don't set a achievable goal, then you will definitely able to succeed in that project, right? So we need to break down into achievable and measurable deliverables. But again, just consider a situation, and since it is the course about expert project management, so I'm giving an extreme cases where you have to handle a large project. For example, you have been given by your client, you're handling support of a ERP, and you have been given change the whole framework of the ERP. And since you're doing the maintenance for only 1 year, I'm just giving you a just hypothetical situation, how you will handle it, you know. So where your team is new to the function and domain and you're new to the technology, then what happens to breaking down the deliverables? In such case, what happens is, again, I'm giving the example of an ERP where the new framework has to be built. First of all, you need to sit with the client. What are their requirements? What are the difficulties they are facing in the existing old framework for the ERP? Again, this is an IT situation. So then they will come up with that they are facing performance issues, or the user interface has to be changed so that they have a less data entry to be done, so that it saves their business time. And trust me, it saves their millions of cost of the client, right? So then you have to sit with the client for the requirement, and you have to build an iterative model, because in such cases deliverables will be like in the first scenario, because you need to understand the technology, you need to build a prototype, build a transaction screen to the client, give them as a prototype, and if they approve, then go to the next stage. Then here the planning the whole thing and deliverable is not practical one. Even if the client and the stakeholder ask you that, you should say very clearly that it can't be done. And as a project manager, it is our duty to suggest them that we should go about an iterative model. In that way, the client can also see the advantages of the new framework and new technology. You will also get time to mentor your team on the new technology. So it's always important to see an expert project manager knows when to use what kind of methodology, whether it is agile or traditional. And also when we talk about planning, they know how to convince the client and go accordingly. Because just you set an unachievable schedules for your team, then it's not going to help out. Then next is definitely the practical and logical deliverables. Like I have told in the example, if the project is complex, where the situation is like where the situation is your team doesn't know the technology or functional things, then it is always important to make the deliverables logical and practical. It should be achievable. It's not that we are expecting 2 months work in 2 days. It's not possible. So mostly the project managers, they fail in this area. So again, we will just reiterate that the first task you need to work out is how you are going to break the single end goal of your project into individual deliverables that are small enough to be both achievable and measurable. Striking the right balance here is crucial. Deliverables that are too large, they can't be you can't either the deliverables should not be too large, that's again come to the practical and logical deliverable logical segmentation of the deliverables. And it can't be too detailed, because then it becomes a micromanagement of the team. And then comes lowest level of detail is included when your project is very unpredictable. Already it is many projects, they are in red condition. Trust me, I have been given certain projects in IT as a project manager where the project is in a very red situation, where the profit is not coming, the resources are leaving, because then you have to go and see what is the process lag. If the client is not getting any deliverable, what are the streamlining to be done? Maybe there is some lag in the risk management part. So all these things needs a very thorough analysis in case of planning. So a simple example, let's before seeing the next part, we will see a simple example which again will give you a clarity about what is breaking down the deliverables. Like suppose we are developing a website for a local cake shop, one that's never had any kind of online presence before. So nowadays the digital marketing, the digital presence is very important for any startup. So you have a client who have come for a website and the designing, and they themselves are not sure. So likewise, you can have many situations. A client who has never done this kind of project before, then they themselves are not clear of the requirement. And but this project is a simple one, website. But you can also get a client who comes and who don't have any requirement clarity, but they want to execute you a complex project. So all these scenario, as an expert project manager, it's your duty to chalk out, analyze, and then make a plan. So in this case, although the business has sound reasons for approaching the project, the owners believe a website will give them a broader reach and will thereby increase the sales. They are little hazy on exactly what it is they want. So it happens mostly with all the client, because especially in IT projects, because they are not aware of the technical. For example, in some cases, you need to suggest as a consultant to the client the solution, like this technology if you use, you will overcome this performance problem, etc. So it you have to work as a consultant. So this is where you have to do an analysis, and since the client itself is not clear, you need to have first some discussions with the client team, the user team, and the owner and the staff. And you have to first get the basic list of the requirements together, and you need to generate some ideas. Now you will then you have to put all those points, and you make a project plan. So an initial, just a project plan, or for the website will be, like for the cake shop website could be, first interface you can have is about the store section, including contact details, how to find them, the cake shop. Then second could be ordering online. It could be your online catalog page or admin interface, like for adding, editing, deleting products. Or it could be a shopping basket functionality, like adding an item, editing the item, payments, confirmation emails, interface to order or delivery system. Then there could be a page that could be a get a quote contact form for customer cakes for special occasions like birthdays, anniversary. Then there could be a photo gallery, that special occasions photo gallery where you can put a slideshow functionality or a photo upload. And on the technical part of it, it could be like web hosting and domain name registration and email address set. So this is how you should structure down, where all the points I have described, definitely you know that these are achievable, these pages. So first, in the situation where the client is not clear, and in such situation where the website is involved, it is more on the interface level, on the content level. So it is important, the crux of the project you need to analyze and get it approved from the customer. That's the main point. So for this example, we are assuming that you have already agreed whether you are building the site from scratch or whether a particular set of technologies will be used. So again, as I mentioned, all these things needs a thorough analysis, because as an expert project manager, when the project comes to you, if you need to know whether it is from the scratch or what is that, because many times the we will suggest something, but the client restrain from it due to the budget issues. So all these things comes into the picture. At the initial stage, whenever there is so much unpredictability, it is better that you don't need to give some low level of details. But as the project goes, it's very important to break down into details and track them. So that's how the breaking down to the deliverables part goes in. I'm sure at the end of the session, I want all of you to analyze in your project how you are breaking down the whole chunk of the project into logical and practical deliverables. And definitely, I'm sure that you might be doing it. If you're not doing it, then you have to find out the what are the lags there. Is your deliverable not practical, or if the client is unpredictable about the requirement, then how can you have those filled in? Like for example, you can put a diagram. Most of the clients, they are not very comfortable with the technical coding language or something like that, so you can put a diagram and then freeze the requirement and then go about it. So this is not only about the IT domain. This particular thing, breaking down the deliverables, it could be applied to all the general domains wherein a project is about the deliverables. So if you put all the project deliverables into a specific one, your life is easy, because always the dynamics are high. The because for example, the website project itself, the content is going to be changed. The client may not be very happy with the content. They'll say that you keep this content, and your newsletters will come and your blogging will come. So there are so many things which comes into the client mind, and also The digital marketing structure is changing day by day. So all these things, keeping all these things, it's important to have the deliverables logical, so that the changes the client is suggesting is easy to make. After we have learned about the critical point, breaking down the deliverables, now we will see the next pointer. And before moving to the next point, that is identifying dependencies, I want to analyze, do you identify dependencies and constraints in your project before planning? What are the constraints? Everything is not perfect. Like if we take a project, for example, we take a framework, new framework building ERP projects, right? So which is a complex one. ERP itself is huge, so we can't say that it will turn out to be perfect. It is not practical to think like that. So in those projects, you might have certain constraint. For example, there might be certain limit where for the new technology to handle the users. So there could be n number of constraint. And on the people front, on the resources front, you may have mentor the team for in the new technology. That could be another constraint. So every project, some constraints of the projects, trust me, they are like that, that we have to just accept it. We can't have solution for it. For example, the client's VPN for the user testing. So all these things comes under the constraints of a project. So first of all, a very critical, whenever expert project manager gets a project, what they do is they identify the constraints and dependencies in the project. So it's very, very important to identify the constraints and dependency of the project. So when we talk about identifying dependencies, it's very critical that we should know every project. Again, it is different, because when we talk about one project, it is totally different from the other. So it might be a small project or a large project. The constraints and dependency identification is different for different projects. So when we talk about an expert project manager, it's very critical to know an expert project manager knows what to identify the dependency, and they are very practical. Which one we can accept, and which one, if it needs a prioritization, it has to be fixed immediately. Now we move on to the next, studying in detail about identifying the dependencies. First is you need to find out true dependencies, because it could happen that some projects, for example, we are talking about the website project. So it could happen that you are some nowadays the projects are very complex. We are handling one part, but due to certain conditions for the cost basis or for the budgeting, the client can give the content part to the another person or another vendor. So since they don't want to give the whole chunk to you, so it can happen. So there could be a dependency that, see, for website the content is important, so certain crucial contents could be given to other vendor. So it's very important to know what are the true dependencies, and how it can impact your project. So identifying the true dependency is the first step for a expert project, for the expert project management. So it could be which deliverables depend on other and also in a project, identifying dependency is, one is the external dependencies, like for example the other vendor or the third party you are dependent on. In some cases, the project organization, they depend on metrics kind of systems. For example, I was handling a project which was an insurance project, IT project, and it was a huge project for 50, of consisting of 50 to 100 members. But the main part of the project, the core team, actually it was a product, insurance product. It was being built by some other team sitting in some other location, geographical location. So we are definitely dependent on them on fixing certain patches. Yeah, the interfaces and the customization was done by my team, but still, since if there is anything to be changed in the core logic, we were dependent on the core team. So but the core team was loaded with other clients work, so it could happen that they get back to you in 4 days, 5 days, so it happens. So the finding out the true dependency whenever you work in such kind of project, it's very important that you need to have contacts so that you can get the things done very quickly. So all these things happen. Since many of us start out doing projects in which simultaneously manage and do all the work, we need to do all the work. Initially, it also depends on certain projects. We are alone. We don't have, when we are building a project from the project team from the scratch, we are alone. And sometimes, due to the cost issues of the project, you're not being given the team. In such cases, it's important that we need to identify when you were alone handling or you have a small team, you need to definitely start analyzing the dependency. It is easy why the project fails or the project managers fail, because in such situation it is easy to assume that there is no dependency and everything will happen sequentially. Initially, I have done the similar mistake when I was a project manager. For the first time, I used to think, yes, everything will happen sequentially, like as traditional SDLC. That is, first you will have a requirement gathering, then you will have a coding, and it will fall in place. But trust me, it doesn't happen. So, as a project manager, as an expert project manager, the knack, the whole skill goes in that how you identify the dependency. For example, one dependency that I have handled in my project was resource dependency. We can say that it is the most common in all the domain, whether you are working in FMCG, whether you are working in manufacturing domain, whether you are working in IT domain. It's very easy. Yeah, it is more or less, we are very much dependent on the resources to get the work done. But when the project runs for years, the dependency on the resources gets increased. So it is again a kind of true dependency. So when we say that resource dependency, then how you will handle it? Because just keeping the dependency on check doesn't matter, right? You need to handle it. You need to find out the solution, because resource dependency, it could be very risky in certain cases. For example, I have handled a two people project where the entire, which was running for years, 3 4 years, and even though it was a support project or whatever project, but if the one resource gets he or she goes on leave, then the project works get piled up. So in such cases, it's important have the documentation in place and get other, you can ask your management, get a resource and for the temporary basis, and get him or her a mentor. So resource dependency, one another if in large projects, for example, if the reframing of the ERP comes in, so it's always important to divide it and always important to attach one resource with the core person, so that the knowledge does not go with them, because it's a IT. In IT industry, the iteration rate is very high. So it's very important to deal and identify the resource dependency and deal accordingly. When you're on your own, you're typically only able to work on one item at a time. So you work on the one task after the other. So it also happens that when you are handling a project alone, then it can happen that you are there is no dependency. But there are projects where they have multiple project managers. Then, as I told, you are dependent on the other project managers to get the status, to give the status, or you can have a many project leaders and you have a dependency on the project leaders to give the statuses of of individual team to just so that you can present it to the senior manager. So there could be n number of dependency. So when we call a resource dependency, the only reason why the two deliverables can't be worked on in parallel is because you have a limited number of people. So if there is a large number of resource pool in your project, I really hope that it's a actually, when we say that in your team you have such a large number of resource pool, it is a heaven for the project managers, for project managers, trust me, nowadays. But if you have that kind of a pool of resources, then definitely you are luck. But some cases, like I told, you have a very limited number of resources, then the resource dependency increases. You will end up in putting some task in sequence because of resource restriction, but leave that until later. For now, try to focus on the work that by nature demands to be done in sequence. So if you, for an example, you have only two resources in your project, then how you will do it? You have to identify. Again comes the prioritizations in the picture. So you when we talk about the smaller bandwidth team, you cannot have a parallel work, because if you have only 2 to 3 members, then how you will do a parallel work? You can sequence out certain priority tasks and get things done. So identifying dependency, and it all depends that how you handle the whole project scenario practically. Dependency identification can help you recognize holes in your initial breakdown of deliverables. It's only when we look the dependency for each section that we realize that we haven't actually got the site design in the plan. Certain times when we identify the dependency, then it's very important to know, we can just find out the loopholes in our project, because it is human that we have not considered those dependency in the initial plan itself. And it can happen, for example, because we are at the end human, and suddenly the complex structure or the dynamic structure of the project in practical in real time scenario, project managers are given projects which they have not involved in the during in the initial stages. So you're just being given that project in between, and you're not aware of the client, you're not aware of the, I have handled such project. Then as an expert project manager, it is the first thing you need is to sit with the other project managers who have handled the project and understand the requirement, understand the client, understand and identify the dependencies. For example, I have taken over a project where there was 50 to 100 team members. It was an insurance product, and first I did is to identify the resource dependencies. Who are my core team? So that when you're not having that much knowledge about the project initially, it's important that you gain the knowledge from your team members and identify your core member and form a team. So identification of the dependencies helps you to know what are the loopholes. All the sections, like for example, all the sections of the website design that we have seen an example that we were planning to build depend on some agreement on an overall design. So if we talk about the website design, right, so it depends, the whole website design is dependent on the two crucial items, that is, one is content and one is interface. So it all depends whether the whole schedule depends, and you can achieve the timeline only if the client approves the layouts. So likewise, every project has this whole true dependency that needs to be identified. And because before the overall design is being completed, or else you need to uh, kind of redesign the whole thing. And when we talk about parallel work identification, I can give you an example that when we are talking about the large projects, for example, again I'll go back to the example of redesigning the framework in new technology of an ERP. Then in such projects, if the client has given you a deadline, you don't know the new technology, you don't know the old framework very well, then so that you can build those features in the new framework. So what you will do, it is important that first you build a prototype and you identify the parallel work. When you identify the parallel work, when in such large projects the sequencing is not there, then kind of you're able to handle the deadline, and you will save definitely your time from managing sequence work. Many a times I have seen that all the teams, because in large projects when you have a 50 to 100 members, you can divide them into teams, and all the teams, they don't perform in the same level. So if you sequencing out, one team will finish, one team will not finish, then how will you will be able to handle the end project date, that is the deadline set by the client. So it is important to to identify the parallel work. So these are certain tricks and strategies that a expert project manager can make, so that you are able to be on time for the project, you are achieving the time limit, and second is the whole scope is covered, and third is your, if you're, see, it's always like that. For example, if you are going for a vacation, and if you are able to, you have spotted one itinerary, but it could happen that some of them like it, some of your family members like it or not, or there could be a dependence whenever we are traveling. There could be a dependency on the food, that sometimes in the location is exotic but the food is not so good. So these kind of dependency, what we do, We just plan it out to mitigate it, like we take our own lunch or dinner. So it's for short trips, I'm saying. So likewise in project also, it is not that all dependency cannot be handled. As an expert project manager, it's our duty to handle it and form a team, and also communicate to them very clearly that, see, these are the dependencies and we need to get over it. There could be some technical things, then we can go to the client and say that we are going to buy this tool, are you going to pay for it? So there are n number of things, the ways which we can handle. For example, if to increase the productivity, I have seen such clients where they agree to pay for it because it makes their life also easy, that they get the deliverables easily and quality product. So all these things, kind of negotiation also comes into the picture. After talking about the breaking down of the deliverables, then identifying dependency, it's a very, very crucial part about the project is about the estimation. And I know as a project manager, sometimes I really want some extraordinary to get the correct estimation. But in practical, there is nothing to be overwhelmed, because estimation is again about the project to project. Some projects you're not aware, even the client itself is not aware of the requirement, and it takes experience, it takes a lot of practical observations for building the estimation. So estimation is very critical for any kind of project. Let's see the next pointer: estimating time. So it's not very as easy, but it's like we should not be overestimating or we should not be underestimating, because overestimating means we have ample of buffer time, then it's not worth it. And underestimating also, like then your team gets bogged down and you don't have a required time to finish the project. Estimating the time a project will take, it probably is the most and frequently overlooked by the project managers. That's why the project fails. So, but an expert project manager, they spend their maximum time in estimating the projects. Why? Because I'll give you a scenario in IT projects. If you are in maintenance project and you're working on change request, then it's one of the estimating time is very important, because in some projects it's very easy because your team is aware of the project, they are maintaining the systems for years, so they know the knowledge, and they have since they know, they have extensive knowledge, functional knowledge about the project, and so they can do a very correct estimation and it will be approved by the client, because they know them very well, and so you will have a mutual relationship and they will approve those estimation. But the estimation is very difficult when you are handling a from the scratch product. You're developing a whole big project new. For example, you're developing a ERP system application from the scratch, then estimation is very difficult. If you are just acquired or very new to the client, then it's very difficult, because in those cases what happens is, like the functional knowledge is not there, then you will be either underestimating or overestimating. If you don't have an experienced person who is technically sound, then also the estimation goes for a toss. So in such cases, it's very important when we talk about estimation. I will talk about project specific, right? So if you are handling a maintenance project, then what is the process you follow? I always give it to the senior people because they know the system better. But it is important that you get validated from the team member who is going to do the work. So in estimation, it's important because most of the project managers, either they will do the estimation or they will give it to some other team members or project leaders who who are expert. So for example, a project leader can take 4 days to finish a work, but same job will not be similar for any average person who is not experienced, who is not technically expert. So you should find a middle path, right? So that's how it goes for the expert estimation in case. So also when it comes to estimation, it's very important that we consider, for example, if it is software, then how much your going to develop a new project or application, then it's very important that you will take time for the building an interface, you will take time for building the database component. And so when it comes to maintenance kind of project where you have to estimate a change request, it's pretty easy, and usually most of the project will have those processes in place. But let me give you an example for complex project handling. When you have to do from the scratch, you are handling a development project and you have to estimate those. So in those cases, and you are very new to the function knowledge, you don't know about the transactions which run through the application, and you don't know about the technology. In such cases, you have to bring in the experts from your organization and sit and analyze first of all what are the client's requirement. Then you have to do for one particular module and build on those in the phases and then estimate, because in such cases the requirement from the client keep on changing. So it is important to give for a small part. If they ask for a big part, it's not possible. So even though client pressurizes for giving you a big project estimation, it's not going to help you. And again, it's very important to consider the assumption and constraints of the project. So most of the project manager overlook this factor when they are pressed for time for the from the manager, from the senior management or the client. Many projects managers make the mistake of creating them estimate themselves by putting some random numbers, because I feel that it's not appropriate. Because if you put pressure from the customers, and because you need to give some ballpark figure to the customer, it is always, I have done that, trust me. I have given a situation where I have to deal with this client who I know for only 1 month. I was very new and they came up with a whole huge project requirement. Then I told very clearly that we will move in a iterative mode. First, I can give you a prototype, and in on that basis, that estimation, and then we will approximately go step by step by building the transaction masters. So it is a sequential process, an iterative process. So it's the time frame, if it is given by the client, then definitely the estimation should be done by you with the internal team, because it is very specific for your project team. And you need to consider the assumptions, you need to consider the constraint of the project. The point of estimating is to predict how long the production of the various deliverables will take, so that you can build an initial project schedule. Although schedules are often mistaken for project plans, in fact, a schedule is just the one part of a project plan, because as per PMI, you have various other things which comes in the project plan. You have your scope, you have your quality processes which should come in the project plan. So it is one part. The key rule to remember when estimating time is this: the person who will actually undertake a given piece of work should create the estimates. Again, this situation and circumstances is all dependent on which project you are being given or which project you are going to handle. It can happen that when you are being handling a new development, you have to build a team. At those time, on those time, you don't have a resource, you don't have team, then how you will go about it? In those cases, I have handled in such a way that I go to the client, I tell them that this is high level estimates, but when the team comes, we'll analyze the requirements further, and then we can give a detailed estimate which could be revisited. So this one clause should be there in the contract, because what happens in, especially in software project, there is this whole time crunch, this pressure on the team, then the team gets demotivated, and all this happen because the estimation is done on a very high level when the project bidding happens. And at that time, you are being given a team, and those at that stage they do a technical feasibility study, the technical architects. Some companies the process is differ from client to client, and due to competition, the project has been, your sales team get the project, and then they are just given to the project manager for their execution. In such cases, I have handled such projects wherein I go to the client and then I request for re-estimations, and I request a process to be fair. It will be a win-win situation for both client and us. as a vendor team in IT scenario. Actual execution stage, the team can't work on the previous estimates which were made with a very high level when you are making a proposal. But when it comes to the actual execution case, there could be n number of change of requirement from the customer. So those things has to be in the estimation so that your project billing also increases. It is justified. And trust me, if you go and talk to the client and explain them the process and the quality which can get impact, they will understand. So here the project manager has to handle it through their contact and their negotiation skills. So it is as simple as that. If you're trying to estimate for work that will be performed by more than one person, that sub team needs to agree on an estimate together. So I have done it because if you just put an estimation as a project manager, and neither I have seen those project managers that neither you share it with your project leader nor your team members who are going to actually do it, then it is a disaster, because then client, you will be on some page, then the client will be asking you the deliverables, and it is a mess. But you have to come to an estimation. It is a work which is being done by the team of yours, and they should agree with it. Yeah, sometimes at the end we are dealing with people. It can happen that some team members, they won't agree with any estimates, they will come up with new solution. That's not that, but usually it is better to have a team meetings for such things if your team members are really mature to handle it and you have that rapport with the team. So ideally you're already having involved your team in the breaking down of the work into logical chunks and in working out the dependency. But even if you have got it alone on those part of the process, it's absolutely essential to involve them in the estimating process. Trust me, this is how any expert project manager does do it. I have always seen that those project managers who have disconnected the team in the process of estimation, yeah, sometimes project could succeed on some deliverables, but ultimately it is going to fail because you have committed the dates on your own assumptions. But at that end, it's very important to get the team involved in from the initial stage. Trust me, I have done it, because I have done it and I have been successful to achieve having project success with challenging projects with this kind of mechanism, wherein the estimation, because mostly in a complex project the organization will give you a good team, because at the end it is they face, if you deliver them, then there will be more billing will be coming from the customer. So if it is not, then you have to ask for the resources. That is again a resource management part of yours. But when we're talking about the estimation, it's very important that you lay out, whether you are laying out the estimation, whether your project leader is making that estimation, or your team leaders are making that estimation. Again, I'm talking about the large projects handling. Then in such cases, it is important to have, it is better to spend more time and ask the customer that time that you will discuss with your team internally. You need to discuss those estimation once they are aligned, because most of the time I will be really, I'm happy to share this, that sometimes because sometimes we don't go to that detail as a project manager. They also have certain set of insights of the project, like they will give inputs on the assumptions, they will give you inputs on the dependencies. When you're discussing those estimates, it helps. So why is this so important? Because estimates needs to be realistic. More than that, estimates needs to be realistic for the people who will work with them. How would you feel if someone come along and told you that the work you're going to do is going to take 1 week? If your project manager is lucky, then he is magically guessed as an achievable estimate. If he is unlucky, as you feel right now, he's gotten deadlines forced on you and he is going to be unhappy because you are never going to get the work delivered in a week. So trust me, these are the certain things which are overlooked by the managers due to pressure from the client. We are not doing it deliberately, but due to pressure from the client, we always give some ballpark. Sometimes we give some ballpark image, but it is ballpark deadline date. That's not going to work out in practical situation. It is very important to handle the client. If they push for certain deliverables, they say, yeah, certain cases it could be urgent business requirement from the client. That time you need to do it. your team has to stretch and they need to deliver. But certain times it's important to tell the customer that no, this is not going to happen, because they will always, because it's their job from the client side. They'll say, I've paid you money, now you give me my product. But it is important to evaluate the project dates and dates given by the customer. If it is given, it is very important to have them on the same page. So once you get involved the right people on your task. But how this estimating process actually work? So first of all, there are few techniques which work. Like it, all organization have their own template for estimation, and there is certain templates, and also certain projects they use FP method and complexities method. So there are various way. A few averaging techniques are available. You can choose the one you prefer. The options vary in complexity, but two simple equations are, you have to choose one most optimistic estimation and least optimistic estimation and divide it by 2. This is just the average of the longest and shortest estimates. So you can also do that. You can get your expert leads doing the estimation and get this average. Or there is second equation, that most optimistic estimate, it has to be added to 4 times to the most likely plus least optimistic and divided by 6. This point, it gives extra weight to the most likely estimate. Probably a more task once you have obtained your estimate is to work out how you feel about them. Your own gut feeling. As a project manager, you have experience that will also help the reliability of the estimates. Estimation is an art, and when we talk about estimation, it's very important for the project managers and expert for to become an expert project manager, that we tell our client clearly that estimation for more than longer time, like for 8 weeks, 9 weeks, it's not it won't be accurate. Yeah, sometimes the client wanted for an approval of the budget, for the approval of a budget from the user department. But mostly it is better to mention to the client that estimation, if it is more than 3 months, 4 months with a very detailed level, it's not practical, because requirements keep changing. So it's very important to understand these. In fact, it's very difficult to create accurate estimates for work that will be performed more than 6 to 8 weeks from today. It's I have observed that when you're working on a particular phase of the project, you can plan that phase with reasonable accuracy. For example, your team is working on requirement. So on that particular requirement, because usually what happens when we talk about the traditional project management or even agile, so the capacity of the team nowadays is very agile, because sometimes we put more resources, sometimes we keep less resources. So usually in the when you are following a traditional approach, and when again it depends on the project. If you are in a project where you know the client very well, you know the domain very well, you know the technicality very well, then it's very easy. It's not a big deal. But when we talk about a project which is very complex, you have to study. Some projects need external help, like a technical expertise, not from your project. You can have organizational technical experts in your project coming up and helping you in analysis of the project in the requirement phase. So those things, it requires time, and in such cases you can plan only for those phases. So when you're working on a particular phase, you can plan for reasonably with accuracy for that phase, getting right down into the detail of what needs to be achieved. But the phase that starts 3 months from now, I think it is very difficult, because it is the things keep on changing. And why I'm saying this, because estimation, when once we do an estimation, again the time. For example, there is a task A, and again I'm talking about the IT project perspective, that can, for a resource for the task A, it can take some time. But for the same task A, the resource B can take more time. So it all depends on the various situation, and sometimes it also dependent on the external dependencies. The tool, you might have to purchase an external tool and it has not arrived. So there are n number of things when it comes to estimation, when it comes to the estimation, and also when actually we get into details and do it. I'll give you an example. I was doing redesigning of certain framework in a project and in a very large scale application, web application. So initially when my company was in the bidding stage, it has given a very, very high level estimation. And also, it was totally different when we actually start executing the project, when we sat down with the customer. Because usually, when the customer bids a project to the especially IT projects, they some clients they themselves have a very lesser idea of the requirements, and as they choose the vendor, as the team starts interacting, this is more about the business logics. Then the team starts interacting with the end users, then they start developing it. So it's a long process, it's not just a one process in one short scenario. It becomes a long process, so it's very important. But usually client pressurizes the project management, and trust me, I have faced this situation where the client pressurizes, when especially if you're in a, if your client is a public sector client, they pressurize you to, because they have lot of approvals. And so it depends on the experience to experience. But as a project expert, project manager, it's your very duty to tell the client. And if the client is not agreeing with you, then of course you can push the channels through your senior management and say that. Because at the end it is very it will be in good, it will be a win-win situation for your client and yourself, where you have to agree to a process. And once I was handling an insurance project, where IT project, wherein in insurance the dynamic is more, sometimes the rules changes and all. That juncture, if the client is asking an estimate at a very detailed level, it's not possible to plan for 3 months, 4 months for a support team. I'm talking not for a new development team, support team. So in those cases, it's very important that what is the client, if the client wants an accuracy, and if as a project manager, because we need to balance the parameters, it is not only the requirements, but you need to see the customer's happiness, with also we need to see the project budget. So it is definitely, because many a times the team, if they don't have very well function knowledge, it's not about the IT project or any other project. It happens even in all the phases, whether it is a construction project. In initial stage, when you are just after initiation, when you are collecting the requirement, where when you are in a very when you are in the planning phase, so the higher level planning takes place. But it is very important to put a clause to the customer that we will do a requirement gathering stage, we will see the requirement, what are your requirement. It could be in the construction, for example, a painting a particular room. So we need to, once the client start discussing. And here one other important factor is the change. Because any customer, I'm very practically speaking, they don't, it is not possible, because sometimes the customer is very clear, but then suddenly the user requirements changes. And I have seen many times in IT projects, the project gets on hold because suddenly the user says we don't want this feature. So all these things comes up, so it's very important to consider these factors affect the estimation. Instead of planning the entire project in one go, you can use a rolling wave approach that gives a very rough broad based estimate for any deliverable. So many a time project managers use this approach. So for any deliverables, you can use a very broad base estimates for any deliverable that's too far out to estimate, and only putting the effort in breaking down the detail and estimating properly the works that comes in the immediate future. So in the rolling wave, usually I will suggest this rolling wave approach for the projects, especially in nowadays the dynamics are very high. The client keep, because they are not having your project as only project, single project, they handle multiple projects. So sometimes I've seen that customer takes weeks to respond back to your requirement queries. So it's important that you plan for the phase you are in, and do a detailing, you prioritize. So if you are in the current phase, you estimate for it. By communicating this approach, you will definitely, it will help you. And it can definitely give more accuracy. And trust me, there are certain conditions, because if you start giving over estimates to your customer, I have seen many project managers doing it under the client pressure, and definitely it is a thing to avoid, because at the end we will give some estimation, and which is yes, we'll say yes, it can be done in 2 days, but we need to consult to the team, we need to give an accurate estimation because it hits the project. There are certain projects which are fixed bit in the scope, so those project gets highly impacted with this kind of estimation, where if the estimations are not proper, because sometimes looking at the higher details, we will think that yeah, this job can be done in 2 days, but actually when you go in detail, you analyze the requirement, then you will feel that there is loads of work involved in it, and maybe we would have estimated 2 days effort, but it could have been a 10 days effort. So all these things comes in the picture when it is making your life simple. Project management, it's not very complicated if we make it simple. It is including the estimation part. Then comes the adding contingency. Once your estimations are finished, usually you add certain contingency. Contingency is extra time that's allowed. What is a contingency? Have you ever added contingency in your project? I'm sure you would have been, because we cannot be very perfect in the estimations. We cannot be very perfect in the planning. So there needs to be adding some buffer on time and budget also. So it is an extra time that allowed in the schedule to cover unexpected events, such as the milestone that takes longer to achieve that you planned, a problem that's harder to solve than you realized, or certain basically it is a extra time you have added in your planning, as well as it caters to the unexpected event. It is a good way to say that it will be happening as planned, but it is always good to put that extra contingency time. So when you are breaking deliverables into milestones and estimating how long it will take to deliver them, it's normal to assume that everyone will be working a full way. When someone asks us how long something will take, we naturally assume that we are focusing on this alone. How long will it take? Reality could be just something different. So these situations happen, and I'm sure in IT project it happen daily, that you are working on one thing, because of the resource, we can't afford the resources, the priorities keep changing, so one resource may be assigned multiple tasks. So when we say that how long it will take, certain time the resource, and trust me, I have handled a project in my project management experience, had where this client used to keep on changing the requirements. And so then we just collaboratively work out a strategy wherein we have understood that there should be a process. That first there should be a requirement, then you clear the requirement. If you're not okay, if you are having a high priority issues, then there is a certain core team which we have identified, and those will fix the issues, or so we can work out like that. So adding contingency means when certain thing happens, like some priority issues come, you can use this time. So most people are working on more than one item at a time. Some efficiency is therefore lost due to task switching, the time it takes to shift from one job to another. As well as task switching, you will need to take into account all the day to day tasks that need to take care, like checking the email, and in support projects it could be the answering the call, attending the regular events, meetings, and in some cases in some organization there are a lot of HR trainings goes on which the individual need to attend, and other events. And also when we talk about holidays, certain time there is ad hoc holidays which comes in. So the traditional method has always been to estimate tasks, factor in dependency, and identifier where you have inherent contingency. Inherent contingency arises when you have one task that relies on another, and unavoidable time in between the two. So, for example, there is a task which is like we have to develop a new framework, but the coding cannot start unless and until you have a framework ready, because the whole application runs with that framework as a base. So, I'm again talking on the IT product basis situation. So this is an inherent contingency. I can't ask my team to work on coding or transactional scaling unless and until my new framework is developed. So this is a high dependency. So at that time, the project managers can use those time to mentor team on the new technology, ask them to work on the documents, study the existing application and gain the functional knowledge. So if task A is estimated to start on day 10 and to last for 3 days, but task B cannot start until day 16. In effect, you can take 6 days to complete task A before it will start to affect the project. In addition to these cases of inherent contingency, you will also deliberately add some contingency to risky tasks. What are the risky tasks? I would like at this point just analyze about your current project. You see that whether, yes, I have asked this question, that whether you have made any assumptions. Definitely you will have constraints of your project. It could be a people constraint, team constraint, or it could be a constraint related to technology, and different domains, different project have constraint accordingly. So now if you see that, have you ever seen any, there will be definitely in any project, again it depends from project to project. As a project manager, you need to identify, is there any risky task. I can give you an example. When we were working on, just remember this example of new framework, so which we were talking about in the last previous recordings. So when we talk about that, definitely there is a risky task that the team, because it's a new technology, when you are building a new framework, then definitely all the points which client want, because client will have 50 the features to be included in the new framework. But since to be practical, with the given time, also the technology is new, and definitely the team would be new, and on those perspective, the new framework will not have the 50 thing at once. So it is a step by step, phase by phase approach. So it could be one of the risk where the client is expecting at least 20 features in the first prototype itself. It happens in many practical ways. So we should identify those risky areas. Or in some cases, sometimes we have resources not that, who are not skilled, because there are sometimes resources due to time constraint, we won't get that kind of skilled and experienced resources. So in those projects, the area risky task will be mentoring the people and getting experienced people on the board so that they can just review the work of the inexperienced people. So all these things could be a risky task. So another way of adding the contingency is to identify the risky task and add contingency to it. This could either be achieved by increasing the estimate for those tasks or by specifically adding extra contingency in your schedule. Some practitioners suggest automatically adding 40% to any estimate to combat over optimistic tendency and to allow time for things to go wrong. So it all depends. I'm sure in cases of CMI level 5, who the companies who follow CMI level 5 latest version, or different versions of the, or some companies follow Six Sigma. So there are certain estimation template from the organization itself. So I want you to analyze your project and see that what are the risk tasks you have, and have you added contingency, and in your organization what is the percentage of the contingency that is considered. So when we talk about planning, so we are very clear, whenever there is a planning, it has to be planned very well, and it has to be planned on the deliverable wise, and the estimates has to be accurate. So that's the takeaway from this whole session. So because why deliverable based approach of planning? Because deliverable focuses on the end product. So when we talk about communicating contingency to stakeholders, so, like estimates, contingency is another concept that's often misunderstood by project stakeholders. They want predictability, to know that there is a plan and that it will be followed exact. Usually, I think in practical situation, all the customers want a very neat based plan, and they want all the resources on their project so that the work gets completed because they are paying for that. usually there are risk tasks which are there in your plans. So often this need we need to say in different style, we need to communicate the contingency to the customer. So there are certain contingency which can be communicated, and you and your there are certain risk tasks, I can say, that can be communicated to your customer, where you can sit, basically sometimes it is UAT, the user acceptance of the product you have delivered. But there are certain contingency, there are certain risk tasks that you should keep to yourself, which is internal to your team. Because certain times the resources, you can't go and openly discuss the resource problems and all, because at the end client has paid you and you have to work, get things done. So whenever we have a communication of the plan, we have a communication of the dates, so there are certain things that you keep to yourself and there are certain things you present to your customer, that is your stakeholders. We could and talking again about the contingency, choose to add contingency to every milestone and deliverable. Giving an extra day, we can add certain percentage at the end of the estimate. So I want you to analyze that how you have done it for your project. So in certain cases the kind of contingency gets used up on almost every project is when people tend to work deliver a piece of work when it's due, allowing the work to expand to fill the available time rather than trying to meet the original deadline and preserve the contingency. So at the end, yes, we are allocating contingency and all, but when it comes to tracking, there are certain red alert projects where certain times the resources are not available. It is at the end we are dealing with people. Even though I have seen we add contingency, sometimes the project skips certain deadline and it gets 1 or 2 months delay from the actual project end date. So instead of adding contingency at the detail level, it is best to add the contingency at much higher level, like certain percentage. So rather than adding a day or a week in the entire task or something, we can add it on the whole estimate level. These are certain mechanism with which we can be successful, for which the project managers can use, so that we are well organized to prepare for the dynamics. But again, this is all about planning. There are other factors which are getting involved, like communication, and then we are dealing with the people. So there are people issues which project manager handles. So we have talked about the whole estimating time and how we can break down the deliverables. The next session will be on the risk part, which is very very important for today's world because of the dynamics is involved, and there is high risk when you talk about team members. Today you have a team, tomorrow you have the 2 3 people can leave at once your organization, you don't know. So risk are something which is need to be planned very well. The prioritization of risk keeps on changing, so as a project manager it is very important to update the risk sheet. After estimation, we will see about the project risk. But before going into detail how to handle project risk and how to identify first of all the project risk, first I want you to just analyze this question and write down points. How do you handle risk in your projects? Have you ever identified the high priority risk? And the risk priority keeps on changing, because for example currently you will have certain high priority risk, but that could change over the time if you have mitigated the risk. So for example, I can take two examples here. One is if you have a two member team, then definitely the risk is that there could be high dependency on the resources, because only two people are there, you don't have backup resources to handle the task. So then what are the mitigation plans? One is that you could ask them to document all the business core logics, the functionalities. That is one part of it. The second part could be that you talk to your senior management and ask your client for billability, and also you form a backup resource. So that is one part. And another example of risk could be that as a project manager you're new to the project and you're forming a team that is also new. Now, since the project is new, the customer is new, you will take some time to develop the relationship with the customer. So how you have planned, because it could be in some cases risk. I'm not saying risk, but it will take some time. But for the years, if you have spent time in the project for 1 year, but you don't have a good relationship with the client, then it could be a risk due to a number of reasons. Practically, it can happen the client is not satisfied with the quality of the deliverables, the products that we are delivering to them. So, in practical scenarios, there could be a number of situations. So, I want you to analyze how you have note down your risk in your project and what are your mitigation plan. And another thing could be that certain times a customer, from the customer stakeholders point of view, like certain times your project is not priority for them, they don't have time for your project. That could also be a risk, because if you don't follow the process of sign off, then the client suddenly turns up at the deliverable stage and they say, no, this is not the product I'm expecting. Then this is a high risk. So every stage have a different level of risk, and there is a way to mitigate those risks. And as a project manager, it is important to analyze with your team leads, with your core resources, because certain times you have experienced people in your team, so you can sit with them so that they can also come up with mitigation plan. So it's very important to know how to handle risk in your projects. So when we say about project risk, so what are the project risk? And when we consider the project risk, so there are certain times, like we have told that in estimation you add contingency. So that's why you identify risk and certain amount of time in your estimation. So risk management is considered a part of the planning process, because when you are planning at the initial stages, there are a lot of issues. When you are new to the project, when the project is developed from the scratch, then there are enormous number of risks. It could be people risk. It can happen that you are not getting the correct skilled resources for the project, so that could be one of the risks. And second is, there could be a risk that you are skipping the deadline. You cannot complete the project with the mentioned deadline from the customer because you don't have resources. Or there could be a risk of, first of all, certain types of the project have a risk that they don't have a clear requirements. So first of all, you need to identify the potential risk. It is risk is are no more than elements that might go wrong in your project. They could be internal or there could be external risk. So what you do for external risk, there could be certain risks which are not in your hand. For example, you are working on a product, but the core product has been developed by some other team which is not under your control and sitting somewhere else. So in those cases, the identified risk, it has to be transferred to that department, or it has to be handled through your higher management, because you don't have control on those type of risk. And the external risk could be from the customers also, as I mentioned that the requirements are delayed, the client don't have time to sign off. I have seen in a number of cases in my project, IT projects, certain times we have as a team delivered the project and the contract is a fixed bid. You are not getting paid for the idle time the team is sitting. So on those cases, and if you are following an iterative SDLC method, then what happens is the team sit idle unless and until the client says go ahead, and then you start working on the another set of requirements. Because certain times the client gives a very delayed sign off and they don't come up with a new requirement. So these are potential risks, because if you're not generating any money to the project, definitely your senior management will ask why so many resources are idle. So all these things are risks to a project. So what are the stages of the risk management plan? The process is, first you identify the potential risk, then you have to rate them by likelihood and severity and choose which risk to plan for. Because there could be risks which are very severe. Some application has gone live and there could be some defects which needs to be fixed immediately. So they are very, very severe issues. Or there could be a core team member who is leaving and the entire component deliverable is there dependent on him or her, and it can happen that we need to deliver it. Certain cases we need to communicate it to the stakeholders. So certain time there could be some ad hoc situation comes up, and we can skip the deadline of the project. So these are important, that you need to choose the risk which has to be mitigated and make plans for dealing with those risks. The process you use to complete the initial identification step is entirely up to you. So we need to do mitigation plans. But what I am saying is, as a project manager, when the project starts, because each stage the risk needs to be identified on the initiation stage and the planning stage and the execution stage, and each time the risk priority and severity, they keep on changing. So and certain times you need to identify the common risk also, and then you need to rate each risk, first on the likelihood of its occurrences, and then on its severity, how frequently it can occur, those risks that you need to point out. The simply you have to rate it from the 5 point scale, or even a high, medium, low selection to rate the risk on your list. So again, this template varies according to company. So whatever the template you are following, you need to rate the risk. So for example, the risk could be like, for a two team member project, the risk of leaving one resource, what are the likelihoods that's important to rate, and accordingly the severity need to be mentioned. So when the risk is pretty severe, for example, if we are talking about that the new technology has to be learned by the team, and the team resources, they don't have any idea of the new technology, so we need to define the severity high, because your team does not know the technology and the client has given you a deadline. So in these cases you need to come up with a mitigation plan, wherein you can ask your senior resources or senior technical architects to come in, help your team and mentor your team in the new technology. This is how you mitigate the risk. The aim of rating the risk is to allow you to decide which one you are going to plan for. So there is no hard and fast rules for this. The risk you choose to plan will depend on your own organization's culture and your own attitude to risk. Typically, though, you wouldn't plan for risks that are extremely unlikely to occur, but it is better to keep a mitigation plan ready. So, when we call about mitigation plan, it all again depends on how to focus on the current one. For example, your core team member is leaving. Then definitely the mitigation plan should be immediate, that you need to follow a succession plan. First of all, you need to find out a resource who will be replacement for the resource who is leaving, and then you need to have a knowledge transfer sessions. You need to plan the knowledge transfer sessions, and then you need to transfer all the knowledge from the core resource to the new resource. So sometimes there could be a mitigation plan regarding the technology. For example, the server need upgradation. All these, the production server needs upgradation. All these things, the mitigation plan, sometimes we think as a project manager, we think that it is not needed. We can just postpone this course of action. But it is very important. The expert project manager, they always rely on their judgment. So sometimes whenever the team is sitting idle, you always get a sometimes a buffer time in certain projects where the client has not he has not signed off the earlier products. Then in those idle time you can work out on these issues, and you can just close off the risk. So it's very important that not to ignore small issues or small risk which we consider that currently the likelihood is very it cannot happen, but it is important to deal with those and come up with mitigation plan. Risk management is very critical for all the projects, and I'm sure that all of us face some or the other risk. Certain projects the resources risk are high. In certain projects the technology is so complex, and the framework is so complex that the technology part is very complex, so that could be one of the risks. In certain projects the team dynamics can be an issue that we will see later, that how a team building can be handled by a project manager. Because yes, planning is necessary, the technical things handling is necessary, the designing and everything is necessary, but at the end we are handling people. So in certain case, trust me, like I have faced those kind of issues where the team members does not gel with each other. There's always a conflict, and yeah, sometimes the conflicts are good, but if it is happening regularly, then as a project manager, to manage the people, it's one of the tasks. So we need to see why they are not doing it sometimes, and these conflicts, that can impact the productivity of the team. So this could be one of the risks. So whether it is a people issue or a technical issue, or it could be some project specific project issues, as a project manager we need to clearly plan out, prioritize the risk, and according to severity we need to handle the risk and come up with the mitigation plan and close the risk. Till now we have seen that when we say it as a effective project management, then there are a lot of factors involved, and even small things, we think that these are small things, but it has a huge effect practically. So now we will see what are the certain parameters in that. I will use a laser pointer. The first is good administration. Why I am saying administration? Because nowadays the requirement for the project management skill is that we can't do anything. We have to coordinate, we have to make plans, but the major part in many companies, the major part goes as a administration, documentation, getting things done, and also arranging that in the configuration management documentation. So it needs a good administration part, like delegating and all those things. So when we come in practical, when we say that good administration, it is more onto a delegation part as a manager of the team. Because I have seen many managers, they fail because they fail to delegate. It is the truth, because certain times we think we can do it better, but all of the things we can do it better, and certain project manager, they don't know to delegate. They just keep all the work to themselves, delegate a little to the team. What happens as a result is that the project fails, because at the end it is very important to delegate the task very efficiently. And we have to see, because at the end when we are building a team, then what are the behavioral style of the team? They like technical tasks. Certain behavioral people, they are very energetic, and they like to have certain kind of relationship with the customer. They like front ending jobs where, like customer representative, and they want to talk to the client and maintain the relationship. So each person is different. At the end we are handling team, and every person is different, and we need to know how to analyze their behavioral style, that we will see in detail, and how to build a team so that there are no conflicts and we can run. Because already you have client pressures in software projects, the changes are so dynamic that you need to deal with it day to day. So apart from that, if the team is not efficient, if the teamwork is not there in the team, then the project will definitely fail. So good administration is one of the quality. Then prioritization and lean management. Why prioritization? I can give you an example that when I was handling a project, the team was so big. It was a large team consisting of 50 team members. Sometimes it is due to the domain. It was an insurance domain. It was very dynamic and also mission critical, because huge finances were involved in it. It's about an application. If something goes wrong, then client could lose millions of dollars. So that was the, so in those projects where the prioritization is very important, the project manager or the project leader should know which issues to be fixed. And even though you have 50 team members, trust me, in those kind of project, because huge project, they, we feel that the resources are less. So in those kind of project, it's very important whenever the client comes with an issue, and yeah, certain issues you need to handle immediately, because they can break your system. That is in IT scenario, or in any scenario, like if it is a different domain, there are certain issues, if you don't handle it now, the project will be closed. So those kind of high critically alert issues are there. So the prioritization is very important, and here comes the expert judgment and the decision making as far as the project manager is concerned. So prioritization. And what is lean management? If you would have seen in many books, the lean management means it is always customer focused. At the end, your project management, all the certification or whatever the learnings you are taking, they are useless unless and until you have a very good relationship with your customer, because day to the billing comes from the customer, and nowadays customer is the king. So in any company, if you see, they have lots of big companies and who are very successful in their business. If you see, they have a high customer focus. So it the lean management definitely concentrates on the customer and what and all is not needed, because day to day I have seen as a project manager, as a project, we will be some doing some routine tasks which are not at all needed, which are redundant. So lean management means we need to remove those tasks. We need to identify those tasks which kills the productivity of the team. It is redundant and it kills the productivity of the team and it is not required. Trust me, every time and then it keeps on changing, because prioritization and lean management is something that is we need to keep focus, because it keeps on changing. Because today a particular task could be very efficient or it could be very useful for the project. Tomorrow it can be the priority of the task could be very low. So it keeps on changing due to the dynamics of the project, due to n number of reasons, because somebody from your client management side, they would have changed or they would have got promotion and you have to deal with a different customer. And trust me, the customer to customer in the same organization, they have different focuses and different strategies in their mind. So definitely prioritization, it is a number one area. It's a prioritization is something which every project manager should work. It is whether planning, it is whether you're fixing the issues, or when you're delegating the task. It's very important. And when you're talking to the customer, especially in IT project, support project, customer comes with n number of issues and says this is priority, because sometimes they are not aware of, sometimes they want to get things done in a fast manner. And but as a vendor project management, it is your duty to check those issue lists and whether it is feasible in those time limit, and you ask client to mark the priority. If the client is not able to tell it, then it's better to have a meeting with the business users. So as per the business users, they know what is the requirement of the business currently, so they prioritize the task. Then comes effective delegation and administration. Definitely it is a part of monitoring and controlling. When it comes to execution, there are lots of yes, we can plan, yes, we can definitely estimate with accuracy, and we can also have a very risk management plan in place, whatever the case might be. But if you have not formed a team right, if you have not delegated the work properly, then the project is going to fail. And it is, trust me, it is very easy. Some project managers might be thinking it is very easy. You just need to build a WBS and then assign the task. It in real time project, in large project especially, it in complex kind of situation, it does not work. Why? Because in complex situations, client comes with different changes. For example, if you see in a project, in an IT web application development, if there is an interface, then client with come number of 100 changes in the interfaces, so it keeps on changing. So delegation means you need to assign tasks to the expert. For example, I will assign the interface design to the person who is really good in creativity, who has that skill. But in many a cases, in practical scenario, we don't get that kind of resources in our team. Then what to do? Then definitely there are certain things which you need to understand. Maybe certain team members would like to go in graphic designing, they want to make a career in graphic designing. You have to connect with the people, with your team, and assign delegate the job accordingly, so that they are also motivated, productivity of the team is high. Then definitely effectiveness is the foundation of success. All said and done, if communication of the project manager is not effective, overall plan, whenever if there is a meeting also, it's not effective. I have seen many project managers, even I have done it in the initial stage of my career, like as a project manager. I have taken team meetings in hours, and at the end, there were no output from those meetings. Even with the customer, we used to talk about the issues, and so many issues. Meetings and all take so much of long hour, but it didn't have an agenda, and they just it closes off with specific output. So as a project manager, it's very important when we are conducting meeting with senior managers, because they are the one who sanctions your project budgets, and they are the one who listens to your concerns and get more resources if you need for a project, and you need to alert them whenever there is a red situation in the project. So all these things can happen when a proper agenda and proper presentation of your whole project, like the scorecard and also the issues in a proper format, it is presented to the senior management or the stakeholders, they will understand. So effectiveness is the foundation of the project success. Let's move on to the next topic, which is representation of the plan. So how you have made a plan, you have made estimates, but how you will represent it, that also matters a lot, because according to the representation, maybe I'm repeating this, and in each domain it is totally different. In each domain, it happens that like whether you are in manufacturing or real estate, the clients sometimes they are not functional, and also they do not understand the technicalities of the project. Then this representation of the plan plays a very important role, because for the project, certain project they have a very long duration. So till the final outcome is produced, the client has to wait. So in those cases, the representation of the project plays an important role, because many a times, and it has happened to me in one of the project, if I go on leave, so certain times the client comes with an escalation that your team was not communicating to us. The representation of the plan goes wrong, and client misunderstands certain things. They also have concerns. So the representation of the plan, it should be very proper to the customers and the stakeholders. So with all the work we have done, like estimation and planning, now time is to represent the plan in well formatted way. We need to understand schedule is not the plan. If you go to the PMP certification books, PM book, it's PM project management plan constitutes schedule also and other things also, which is a huge template, and it is organization and project specific. So the schedule represents a group of timings that you are going to, that you have planned for your project. The total project plan comprises literally everything you have done in the project's planning phase. So when we say that, when we are representing a plan, what are the key items? What are the key aspects? So the first one is your deliverables and the milestones. The items you are actually going to deliver, broken down into logical, manageable chunks that we have already spoken about. Then comes the schedule, the goals that will be achieved on given timings based on the estimate you have compiled. Because I'm again reiterating the fact that these are the estimates which are approved by the client, and definitely it will be a baseline. These things, so there are various version of the plan. So as I told, if you are working in a very large project, if you are working in a huge project, then the first step is you will have a baseline. Then it keeps on changing, because trust me, it is not practically possible if you're working on a new development project, and it is not practically possible that you can just give the customer in one shot one plan and the team will stick to it and it will be as planned, the execution will also go. It never happens. So the client also keep on changes the requirement, and sometimes it is our understanding also changes. We might would have thought that task A will take 10 days, but it could be different. So it is always there will be a scope of re-estimation. So that's why in certain terminologies like CMMI and certain methodologies, it is termed as baseline, and the version keeps on changing. Then comes the risk management plan, and risk management plan is the risk you have anticipated that we have seen and the step you will take to mitigate them if they materialize. And with this, there is one extra item which is about the assumptions and constraints. The circumstances or factors you have assumed to be true and that you have identified as limitations, combined to explicitly state the framework or context you are operating within. I can give you an example of assumption that when we are developing an application, for example, we are developing a website. So certain times the content like newsletter or press releases, the client says they will give you. So these are certain kind of, it's a simple assumption. And there could be another assumption that when I am developing our team is developing an ERP system, then certain times since we are new to the system and it will take years to understand the system which is already running for 20 years, we are going to upgrade it. It is better to get the knowledge from the customer itself who knows it very well. So in those cases, it is assumed that the knowledge will be transferred or we will be using certain existing business logic. So these things are the assumptions in a particular project. So when we represent a plan, there are certain items which come from the initiation. And depending on the project, it may well be sensible to reiterate the reasons why you are undertaking the project, because it could be from the contract, like what is the purpose of the project. That's very important. That is called as the project goal. At the end, what this project should achieve. For example, if it is a website, then it could be that it should achieve, or if it is a digital marketing project, then it should be like, if it is a website, okay, we will go back to that example of website, that if it is a website, then what the client's goal will be, definitely to that more and more people come and visit their website. If it is a startup company, they want to build an online presence, they want to increase their brand visibility. So for those clients, it could be having more hit from the users, internet users. So that all these things are very important to note down in the plan, because unless and until as a project manager we are sure about the goal, we won't be able to achieve that. And also when we say about certain assumptions and constraint, so when we say about assumption and constraint, I want to detail out one thing, that assumptions and constraints can be different for different projects. And usually project managers, they forget to mention that, but it is very critical to the project, because sometimes the project manager, they don't run the project for years. So certain times the new project manager comes in and they handle the project. So they should, if it is documented somewhere, it is easier to handle the project, that what are the assumptions and constraints of this project, why this project was built. So these details helps the new project manager to get in to execute the project. So because many a times it's not practical, right? Like you have got the project and you will be there till the end. It's not possible if it is running for years. So these are the reasons. So now we have seen how to represent a plan very effectively, so that it is easily understood by the customer, it is easily understood by the team leaders and the team. We have seen in detail about the risk management plan and how to represent a plan. Now we will see in detail about the WBS, the work breakdown structure. A work breakdown structure is a representation of the scope of the project. So I'm sure all of us know what is a work breakdown structure, and these things, the template of the work breakdown structure, it depends upon the company to company. If it is a small project, you won't go in detail. We will use a different template of WBS. And if it is a huge project, what processes you are following, it all depends on that. So it comprises a tree structure that hierarchically represents the project and its component deliverables. A WBS project, it should include 100% of the scope, because it helps you for tracking. And the deliverables, literally everything has to be, whenever there is written in the WBS, it has to be delivered to the client. It is shared with the customers. To construct a WBS, start with the overall project and break into component deliverables. Then break each deliverables into component part. For example, if it is a requirement gathering stage, you can break down into what are the outputs deliverable. The end product of the requirement gathering will be the requirement document. Likewise, you should keep breaking that parts down into smaller levels of detail until the pieces are both achievable and manageable. And my personal rule of thumb for this task is that the smallest node should comprise deliverables that won't take longer than 2 or 3 days to achieve, because in that way it is very easy to track. And again, a rule for large and complex projects is whenever you talk about the WBS, because your large project will have very small teams, it can be broken down into small team. One team may be working in some component development, the other team in some other testing team, it could be a testing team. So it's better to have WBS ready for large. You can't have a WBS for 4 to 5 months and 6 months down the lane. So it's better to have WBS for 1 month. So that's how it should be. Equally, you don't want to plan milestone that takes mere hours to complete. For example, 2 hours, 3 hours, that we can't include in the WBS. It will be difficult to manage. And also it will affect your personal productivity as a project manager or as a team lead to track the things hourly basis. A WBS can be represented in number of ways. So one could be through PowerPoint, one could be through Visio. So it also depends upon the company to company. Some company, they have project management softwares. They would have purchased management software, and they tailor according to the company's need. The project managers can start from planning to till the tracking can be done with a singular project management tool. So when we talk about choose software that you are comfortable with, that and that you should choose the software. And but in some companies, they give the convenience to you. We can detail out the WBS contents in an Excel. So or using Microsoft Project. It also depends on your comfort level, which tool you're comfortable with, and that allows you to draw boxes and arrows quickly, or offers inherent tools for creating hierarchical diagrams. Once you have become used to drawing WBS diagrams, you may find that you can just as easily plot them on paper and turn them into deliverables in the normal text. So I would highly recommend you to at least start with a hierarchy. So it is a tree-like structure, and I'm sure all of you will be using it. So it is just a brush up sessions for the project management. It's on the basic level of project management. Then comes Gantt chart. A Gantt chart is the diagram most people think of what they think of the words project plan. So mostly it is used by all the companies and by most of the project managers. Traditionally, it lists the task involved in the project on the left hand side, with bars representing each task duration overlaid on a calendar to the right. As we know that the things are changing, so nowadays the Gantt chart is available in the Microsoft project software, and it can be easily used. Here you can clearly see the dependencies in Microsoft project software. And also when we talk about the Gantt chart, then it will be easy to depict in using software tools like Microsoft project, because you can put various it allows you to put various buffers, so many things you can use, and various view also it provides you. And it is easy to communicate those charts to the customer. It is easy to communicate the project schedule through these Gantt chart to the customer. So it is very visible and it is very easy to use. So here I'm assuming that some of the tasks won't be concurrent. So then the Gantt chart looks very proper. But there are certain tasks which are very concurrent and parallel. Then you have to figure it out how to represent those. So traditional project management techniques would have you assign each deliverables to the team member who will be working on it. Then perform what's called resource leveling. This is the process by which you identified that some people in your team have a daily workload of 200%, whereas others are operating at 20% of capacity. And this is the idea. Once you have identified these discrepancies, you can reallocate the task. Because whenever we do a Gantt chart, whenever we do a scheduling, it happens mostly that, and that too in large teams, some of the resources are overloaded, some are not having work. So resource leveling is one part that Microsoft project software can easily help. The reality with modern knowledge work, however, is that specific skills are usually required for particular tasks. Reallocating coding work to a design specialist isn't very likely to speed up the project. But perhaps more realistically, bringing someone into the team for 2 weeks when there is intensive coding to be done may also slow the project down rather than speed it up. I have seen in practical situations where clients come to me and say that we want this project to be delivered within 1 week, 2 weeks, and you can just speed up the work by putting more resources. Usually, this is not a good idea because just putting more resources does not guarantee the work to be delivered very quickly, because the new members take a lot of time. And second is, whenever there is a lot of people in the project, then it's very, as the 80-20 principle goes on, so that is very difficult to allocate the work. And because when they are new to the project, they will take some time for them to be productive. So all these things has to be taken into consideration. So usually a preferred approach to resource allocation and leveling is to manage these functions on short term rolling basis within the team. Team members can often figure out a smarter ways of helping each other. Then you can predict weeks ahead time on your own. That's why the agile methodologies, if you have handled agile projects, they have iteration basis, and the estimates are based on that, because it current demand of the customers of changing requirements frequently. And when it happens, it's always better. I have seen the client comes to me and, yes, we need to plan for 1 year because they need that planning for budgeting purposes from their side. But it is always better to tell the customer that there are chances of re-estimation, and this could be a higher level of estimation only. And because at the end, due to the changes, it's better to plan and create all these things on a short term basis. Obviously, if the initial plan proves that you need an extra programmer, designer, or skilled resources, you can expand team. And it is my personal experience. For example, when again I take the redesigning the framework example, where I have to design the entire framework in the new technology for an application, then initially whatever my estimates, my WBS I have created, it has to be taken step by step. I'll take a simple transaction and master screen. For example, for the financial module, I can take one master screen, I can implement in the new framework and give the estimates, give the WBS to the client, and then I start expanding once I have a confidence in the team that yes, they can achieve it, because one prototype, one functional module is already ready. So this is how you should go about it. I have seen many project managers, many project fails due to the client pressure that they want to go live within certain date. So they just say that we want the product by this date. But it is always better to know that how deep the work will be. Even though having technical experts doesn't guarantee the execution, because it's not, we need to understand the complexities of the software system, the business logic. So it takes certain time. So if we are going to deliver within 2-3 months, which are going to take 6 months, 7 months, then we need to understand that it has to be planned properly. And we need, as a project manager, we need to understand the team can expand. Certain times there are in most of the projects in the service industry, for the software project, the project managers put more resources while execution. They take more resources, and then afterwards, definitely in the closure or the next support stage, the resources of the team size get reduced. So this is how it is done. Then comes plan reviews. More a technique than a tool, plan reviews help you to keep your plan alive. A plan review is a short meeting. It should not take more than 30 minutes, in which you review the project plan within a group of people. I always do it because it's very important that your plan, because 1 week before you have made a plan, but it should be in current situation. Certain times it needs replanning, and most of the time in practical scenario it takes that much of replanning. If your customer itself is not clear of the requirement, or the clients have got new requirements, then the plan keeps on changing. So you can review the plan with a group of people. And I recommend that you conduct separate plan reviews for different group of people. For example, your project team will have different interest from the project's keys holder and from the project board. It is humanly possible that project teams will be definitely looking the whole project on the technical point of view. Yeah, these are the screens, this is what I need to deliver. But when it comes to the stakeholder, they have the overall perspective of the project. They want to make it live to the end user for certain dates. So when we review the plan, it has to be a different meeting. You can't have your stakeholders meeting and stakeholders and team members meeting. This is, I'm talking about the SDLC. If your project is following the traditional approach, a plan review consists of taking people through the plan at a high level and only going into detail that's relevant to them, because at the end the meeting has to be effective. Your key stakeholders, for instance, may predominantly be interested to know when you will want their involvement. I have seen in most of my clients will have a different experience that some of the clients are so interested to collaborate that they keep on asking, so when you want our in, they want to see the screen. So certain, it all depends on which project you are working on, or on which project you are going to deliver, because certain projects are very highly business critical for the client. So definitely they want to be involved from the requirement stage itself. So all these things also matter, that how visible that project is in the client's organization. So without plan reviews, confusion may arise about when the teams is working on and how the project's progressing. So we need to take advantage of these meetings to clear up the confusion and also building client relationship. I want you to do an exercise that you just jot down a point. You need to analyze that if you are using WBS, then is it aligned with your scope? Then is the WBS you're using, the all the task deliverables are practical and it is measurable and achievable? Then when you go back to your these exercise, you just see the gancha using and how effective it is and how you're representing it for your client. Then definitely I want to just analyze that you review your planning meetings with the customer and how it is going. In some projects it might be in the red condition, so client is not happy with the planning. They are not sometimes happy with the resources, or the sometimes they are not happy with the timelines. So whatever the case is, when the customer is unhappy, because always definitely the customer will demand more. So but the you need to fit in, because as a project manager you need to liaise with the customer, you need to liaise with the team members. So for that, the best part is like you have a separate meeting with the customer, get their requirements, get their expectations, and just align them that this much can you can only achieve, because certain times the client might be expecting more. Then you align the team members and get things going. This is how it works. So I'm definitely I'm sure that you might be doing risk management plan and all these things. Just go through the recordings once more and see how you connect to it to your project. When we talk about expert project management, again I'm just reiterating this phase. This is just not only to make plans. Definitely this planning is one critical point of a project manager. With the current scenario, when you go take any companies like Deloitte or Accenture, what are the big companies, they require the project managers to handle any kind of project, and they require delivery leaders who can motivate the team and to achieve the most and serve the clients as consultant. So yes, the planning and the tools, usage of tools is one part of it, but there is the next part. We see that how to motivate your team, because at the end, one part is the technicality of it, you are planning and estimating, that is one part. But at the end, when it comes to execution, you're dealing with the people. When it comes to the client management, you're dealing with the people. They are different people with different expectation. So here a lot of theory will help you. You want to become an expert project manager, then you definitely need to be expert in all the field on people management, on how to become a leader, how to motivate, how to have goal for your career advancement and also for your team. And next part comes in is the execution excellence, because yes, we have done a planning, but the main project success is mainly dependent on how you execute it. Because if you compromise on quality while execution, or if your team doesn't deliver, then the project will fail. So we'll see all these things. So let's go to the next slide. I want to understand, have you ever failed to achieve the timelines of your project? Just analyze this question. And if you go through my previous recordings, where about the estimation. So when it comes to the timelines and estimation, because when we have estimation, then with the resources we have, then we will give the timelines, the schedule of your project. So I want you to analyze why you have failed. That could be various reasons. One, definitely the resources are not skilled or they are not able to perform, the performance is low. Third could be the technical reasons, internal reasons, external reasons. The team does not liaise with the customer taking the requirements properly, and the project the timelines have not been achieved. And or it could be another reasons that the client has put your project on hold or on the back burner, so that they are not giving you requirement on time. So in this cases also the timelines of your project is not achieved. Certain times it could be the technical reason, that we are not understanding certain technical issues of the project, so that the timelines are not achieved. So there could be n number of reasons. As a project manager, it is very important as an expert project manager that there should be a proactive approach then to be reactive. Proactive approach in the sense that you need to understand the issues and then provide solution to the client, instead of after the issue has occurred then providing solution. In today's environment, it's not going to be sufficient. So just analyze what are the failures, why the project has failed on achieving the timelines. So when we talk about dealing with deadlines, so I'm sure, especially in IT project, the customer always give a very short bandwidth of time. So then they want certain projects to be rolled out in 2 months, 3 months. The timelines are very, very strict. So dealing with deadlines and technically providing a solution and managing the team could be very difficult for the project managers on those bases. Ideally, you will work out how long on projects going to take, having gathered estimates. That is on, usually we say that we have to gather requirement and then estimate. But in real time scenario, some many a times client gives you the deadline. So it is ideally you will work out how a project's going to take, having gathered estimates, added contingency and considered the risk. Then define the schedule and derive the estimated project deadline. The sad reality is that often projects don't work out in that sense. If this is the case, management is very easy. The client gives you the requirement, you estimate, it is easily executed and delivered. But many a cases it is not the case. We have all been in a situation where we are given a project after senior management has announced it that it will be on certain date, and it could be within 2 months, and next big thing. So certain times you are given a project which is highly visible to the organization, that is very business critical to the customer, and it has to be given in 2 3 months. And whether the team was there not there, you have to build the team. Certain case you have to build the team from the scratch. So these things happen. So whenever such cases happen, when you get such kind of project, then how you deal as a project manager? As a project manager, you are very likely to have to deal with this kind of situation. You will find yourself in the midst of a project for which no planning has been done, but a final deadline has already been set. Not only that, but the assumption is that you can deliver it with the deadline. For example, I can give you my personal experience that I was a very new to the project management field. Then I have immediately given a project which was highly visible to the organization because it was having good revenue. So in that project, when I just entered the project, the client told this is the new project we want to build and you have to give me this project. The last deliverable should be within 2 months. And it was very huge task for me because the team has to be built, and then we were not having, the team was also not having that much experience because at that time I was not getting resources. So you have to deal with these situations where it is dealing with the deadlines. Then first and foremost thing you do it, like you have to analyze your strengths, what analysis has to be done, and you need to understand that what is the requirement of the project, and know the assumption and constraint, and build a team which are with a mixture of technical experts and functional experts, so that the project can run smoothly. So utmost important for dealing with deadline is emotional stability of the team. So you need to make processes in such a way that, or build a team in such a way that they can help each other out, and you have to plan the task in task deliveries in parallel, so that we can achieve the target deadline. So whenever we talk about emotional stability of the team, it is about enhancing the teamwork and motivating the team and assigning the task properly. So if you don't assign tasks properly, definitely the team won't be able to deliver it, and the project end date can't be achieved. So if you're in a wonderful, usually ideally the all, I will be blessed to be in that situation, that where we imagine that we will have a wonderful team, we will have a supportive team, and we can just deliver this project on the date which client has given us. But ideally it never happens, because you have to build team, and there are various stages that a team goes through. When it is a new team, just they don't gel with each other in one shot and start working. So there are various efforts that project managers has to put in. Then definitely, whenever the deadline is given by the customer, the project managers lose focus on quality. So it should not happen, because whatever the stage we are in, we should be committed to give utmost quality to the customer. So when we talk about the deadlines, it's the main thing that we need to understand is that whenever the client has given you a deadline, it is better to plan it very well, to set out the clear deliverables, and have high amount of teamwork, and motivate the team to deliver the product. Certain times, due to the deadline, due to certain team members can't take the pressure, it is the duty of the project manager to motivate the team and get things done. So whenever we have a time constraint, it's very important to have team motivation high, and all these things we'll see in the later sessions, wherein I'll talk about teamwork, team building, and how to create a effectively highly productive team, and so that it is all is aligned, they are aligned towards the project goal.